Good morning to all of you from Luxembourg, the headquarters of the European Court of Auditors. Let me express my appreciation straight away to all in the court who have contributed to preparing the event during the last couple of months, and also to our distinguished speakers, panelists, and moderators who agreed to participate. I'm also truly delighted to be able to open the conference to the broad and very diverse audience, who I'm hopeful will be active throughout the day. The conference will be in three parts, in 2 parts and 3 sessions, and we have excellent keynote speakers to initiate the debate and experienced moderators for each session to lead the discussion. Now, let me give you a couple of housekeeping remarks before we start. So first of all, for all those who do not speak, for the participants, please keep your cameras and micros off all the time, so that we avoid all the background noises and ensure better transmission and video. We will have a Q&A session after each panel. And during the panel discussion, those participants who joined us from Microsoft Teams will be able to write their questions, comments, and also during the actual Q&A session, they will be able to connect, basically to switch on their Microsoft Teams cameras and microphones and ask a question live. So I think this is the way to make the conference more interactive in these difficult environment. And finally, just to remind you that the conference will be recorded and then it will be put on our website here at the Court of Auditors. Well, now when the rules of the game are clear, let us open the event. I think the global financial crisis has exposed serious weaknesses in the design of financial governance in the European Union, with broader implications for the image of the European Union as such. It gave, on the other hand, an unprecedented impetus to more integration. Since then, we would like to discuss the following questions. Has the EU managed to learn the lessons, and is there any unfinished business for the short and medium term? At the moment, is the EU banking sector resilient to deal with any potential new crisis in a way to prevent systemic disruptions and, importantly, to ring-fence the taxpayers' money? Is the EU financial sector ready to support the economic recovery? These are the main questions of interest for numerous stakeholders and indeed for the international audit community. Now it's time for me to give the floor to the President of the European Court of Auditors, Mr. Klaus-Heiner Lehne, for a welcome address. He has been very supportive to the organization of the conference. Thank you very much, Klaus-Heiner, and please, the floor is yours.
Thank you very much, Michals. Dear ladies and gentlemen, on behalf of the European Court of Auditors, welcome to our live conference on financial governance in the European Union. The conference is hosted by the Court's 4th Chamber, which deals with the regulation of markets and competitive economy. It is organized by my colleague Michals Koslovs, member of the Court and one of its experienced reporting members on questions of EU financial governance. The question we want to discuss today is more relevant than ever. Is the EU financial sector ready to face the next crisis and support economic recovery? I welcome all our participants and I thank them for having accepted our invitation. It's a particular honor to welcome the Minister of Finance of Slovenia, Mr. Andrej Šircelj. He will address the priorities of the Slovenian presidency in the field of European financial governance. And of course, I'm very glad that the Executive Vice President of the European Commission, Mr. Valdis Dombrovskis, will give us the Commission's take on today's topic in his opening speech. With the help of distinguished speakers and panelists from the EU, international institutions, and from the financial sector, as well as academia, we will look into the resilience of the EU financial sector. We will examine its readiness to face the next crisis and to support the economic recovery in light of the comprehensive measures taken in response to the last global financial crisis and the lessons learned in implementing them. Since 2014, the Court's fourth chamber has done significant work in the area of EU financial governance, and its members will contribute to the discussions with the Court's own audit findings. I believe that especially in the area of financial governance, an EU-wide perspective is vital. Indeed, the EU financial sector is highly integrated. The ability to transact effectively is one of the foundations of the European Union's internal market. Yet, the process of putting together all the necessary administrative, regulatory, and supervisory building blocks has been ongoing. And not just since the last financial crisis. That the European Court of Auditors played an important role in improving the performance of EU policies, ensuring adequate accountability and making the European financial management more efficient, while upholding transparency for institutional stakeholders and the public. We will continue to do so with regard to the next generation EU instruments to make sure it will have the biggest possible added value for the citizens of Europe. Now, I'm excited to hear our speakers and panelists' views on the priorities for further action in the EU financial sector, and wish you all a rewarding conference and thought-provoking insights. Thank you.
Thank you. Thank you very much, Klaus-Heiner, for having started our ambitious agenda. Indeed, I agree with you that the EU-wide perspective is vital, and that the European Court of Auditors' role is important in upholding transparency for institutional stakeholders and the public as such. In the domain of EU financial governance, obviously, the involvement of the EU budget is rather limited. Yet, on the other hand, the EU relies on a very serious regulatory instruments and tools, and it is very important to assess the effectiveness thereof. I hope that, Klaus-Heiner, you will be able to stay with us for a while, although I know that your agenda is very busy these days. Thank you very much. Our next distinguished speaker does not need much introduction in the financial world. He and his services in the European Commission have been instrumental in putting together, block by block, the complex policy agenda to strengthen the EU economic and financial sector and to enhance their resilience. At the national level, he has a first-hand experience in crisis management too. It is a great honor for me to invite Executive Vice President of the Commission, Mr. Valdis Dombrovskis, to deliver an opening speech. So please, Valdis, the floor is yours.
Honorable President Lene, dear Michaels, ladies and gentlemen. First of all, thank you for invitation to the European Court of Auditors to speak in this conference. And I would like to particularly thank Chamber 4 for hosting us, since its work focuses on regulating markets and competitive economy. Before we look on how we can deal with any future crisis, it is worth looking back to see what we learned in 2008 when the global financial and economical crisis brought widespread disruption. In Europe, the financial sector proved itself rather weak to cope. It was undercapitalized, over-leveraged, and not properly funded. As a result, and unavoidably, it suffered serious stress. Financial activity contracted sharply and had negative knock-on effect on the real economy. We learned a lot from this traumatic and costly experience. Since then, the EU and its financial sector has come a long way. The 2008 crisis showed us several things. For example, why we need an integrated and stable financial system, why we should work together to reduce risks, why we need a strong banking sector to fund jobs and growth, and why our companies need more diversified sources of financing. The special reports in this area published by the European Court of Auditors has helped to assess developments in the EU's economic and financial architecture over the past decade. They have pointed out unresolved challenges, potential risks and policy gaps, and helped to improve the financial framework. Over the last decade, we carried out wide-reaching reforms that also helped us through the turmoil created by the pandemic. It has been a major overhaul of financial sector regulation to make the EU institutions and markets more resilient in the face of the future crisis. Another lesson that we learned from 2008 that the finance is truly global, and financial regulation therefore requires a coordinated international response. So we undertook many reforms, partly in tandem with our global partners in a context of G20 and in a Basel Committee on Banking Supervision. Europe's financial companies made deep adjustments to their business models and balance sheets. Today's bank prudential ratios look much different and greatly improved when compared to 2008 or 2009. The European banking sector is now in a much better position than a decade ago, better capitalized and more resilient in terms of liquidity. We set about a comprehensive EU institutional reform and also created the banking union. We set up the single supervisory mechanism and the single resolution board, and we created the 3 EU supervisory authorities for banking, securities markets, and insurance and pensions. Creating these EU authorities led to higher quality coordinated supervision of our financial institutions and markets. When the pandemic struck Europe early last year, the ensuing crisis acted as a sort of a stress test for the financial sector. It has shown that all the hard work put in to carry out the early reforms paid off. Banks entered the coronavirus crisis in a stronger and better capitalized position, able to withstand bigger shocks. Capital markets showed their resilience during this time despite the market volatility. In fact, banks, insurance companies, other financial institutions and markets performed well, even through the very tense months of March and April last year. Not only did the sector avoid disaster, but it was also able to help offset the wider economic crisis by increasing lending and capital markets finance and by providing stable market infrastructure. The public sector helped decisively too. We used full flexibility of EU's fiscal, banking and state aid rules to tackle the immediate socio-economic fallout. However, we should not forget the significant contribution made by the European Central Bank and by other central banks to keep monetary conditions conducive to borrowing and lending. Put together, this provided significant fiscal and financial firepower to help health systems, companies and workers through the crisis. Early on during this pandemic, the Commission presented a banking package to facilitate bank lending and then, of course, a recovery and resilience facility. At a tough time, we acted quickly and decisively, both the EU institutions and member states. Our coordination has been shown repeatedly since the global financial crisis. This was not always easy to achieve when it comes to the European financial sector. Ladies and gentlemen, the many reforms put in place over the years were not only important to get through the worst of the crisis, but also to finance Europe's future. Throughout the last year and still now, it has been crucial to keep supporting people's incomes, keep them in jobs, and keep businesses afloat, businesses of all sizes. And we have largely achieved that. The impact of the crisis would have been much worse without the unprecedented efforts that I mentioned earlier to provide strong fiscal, monetary, and financial support. But this is not only about funding the economy. This is also about building a strong financial sector for the future. In turn, this will help us to achieve the long-term strategic objective to strengthen the international role of the euro. This is part of Europe's broader commitment to the open global economy, a well-functioning international financial markets, and rules-based multilateral system. It can make the global economy less dependent on a single currency and less vulnerable to shocks. It can make it easier for EU companies to trade around the world. A globally stronger euro is not only in our interest, it's also in the interest of the global community. Of course, there are other challenges to face in medium term once the recovery is properly underway. This is an area we could discuss for hours, but let's just to mention a few areas. We still need to widen financial sources for companies to promote capital markets financing. This is why making more progress on Capital Markets Union is so important. We must finalize the institutional reform relating to the financial sector and complete the banking union with a European deposit insurance system. We need to keep an eye on the role of non-banks as lenders to the economy. While this may be a welcome development, it may create extra challenges in preserving financial stability. Our financial sector must gear up and embrace the transitions towards a more sustainable economy and digital society. We're already helping by putting the right regulatory environment in place, for example, in the form of taxonomy of green economic activities or a regulatory setup for crypto assets. Ladies and gentlemen, I believe that the EU has learned the lessons of the past. The EU has developed a resilient financial sector that performed well under the strain of the crisis resulting from the pandemic. Banks are under much more scrutiny in terms of their operations and have more capital and liquidity buffers to absorb losses. The European Court of Auditors itself has recognized that the EU has put measures in place to make the financial sector more resilient, and the Commission very much welcomes this. However, we cannot afford to sit still. There are new challenges facing the financial sector that will require it to adjust and adapt, and it's also true for policymakers regulating the sector. I look forward for continuing our good cooperation with the European Court of Auditors. Thank you, and I wish you a very successful conference.
Thank you very much, Executive Vice President. Thank you, Valdis, for setting the scene for our event. Indeed, you have covered the whole spectrum of our agenda, the banking union issues, the crisis management framework, the capital markets union, and I am also glad that you outlined significant improvements that have indeed been made since the previous financial crisis, but you also kind of outlined the important policy agenda that is in the future in front of all of us. That's what I have called an unfinished business that we have to finish as soon as possible. Thank you very much again. I'm sure other duties call you to leave the conference, although you are welcome, more than welcome to stay. But I know some of your collaborators will stay and contribute during the day to the conference. Thank you. Thank you very much again for your participation here. Thank you. Now, sometimes our stakeholders or even the auditees actually wonder if and what the supreme audit institution of the EU, the European Court of Auditors, has to do with financial sector governance. I myself, I have to admit, have faced similar questions while working on several performance audits in this policy area. Indeed, how can the European Court of Auditors contribute to delivering upon the objectives, for example, in the field of crisis management, state aid, or anti-money laundering? We thought in the beginning of this conference, it would be very fitting to explain the rationale for the external auditors' involvement. My colleague, Ildiko Galpelj, will share with you the ECA vision and also her thoughts on the matter. Ildiko has been a member of the court since 2017, and before that, she held a position of vice president at the European Parliament. So, Ildiko, please, thank you very much for joining us, and the floor is yours.
Thank you, Mihály. Good morning, ladies and gentlemen. I would like to add a few short remarks. ECA's mandate, what we actually do, and how our work is connected to crisis and economic recovery, especially in the financial sector. Our mandate comes from the treaty and the functioning of the European Union. ECHA is the EU institution responsible for carrying out the Union's audit. Our mandate is to examine the accounts of all the institutions and its bodies set up by the Union. We report if all revenue and expenditure of the Union have been used in a lawful and regular manner with sound financial management. We provide a statement of assurance for the European Parliament and the Council about the reliability of accounts and the legality and regularity of transactions. We submit special reports focused on specific questions and reviews on broader themes. We deliver our expert opinions at the request of the other institutions, and we report any cases of irregularity. We work by applying internationally accepted audit standards and in close cooperation with our auditors. We work in 5 independent chambers depending on specific areas. Our chamber 4, is responsible for carrying out audit tasks related to the regulation of the market and competitive economy. Among others, our scope includes the financial and economic governance. Over the past years, our role has grown significantly to include more work on performance issues. Our special reports and reviews are very important additions to the SOA because they have specific scopes in which they identify deficiencies, performance issues, and anticipate risk. This is very important for paving the road for the EU as a whole to reinforce the integrity and the resilience of the economy. But how are we involved during a crisis and the recovery? During a given crisis, we respond rapidly. We adapt our annual working plan to focus on important issues which are fundamental to help the EU to navigate and ensure accountability even in challenging times. We collect and analyze the events and actions to flag risks, challenges, and opportunities that will provide EU's leadership with information to act, such as our recent publications on the EU's response to the COVID-19 crisis and our ongoing audit on the NRRPs. We reviewed the recovery of the 2009 crisis, how the developments unfolded, and we pointed out remaining challenges, risks, and policy gaps. We have issued a number of special reports and reviews. Among others, we have assessed as well as examined the Commission efforts towards fiscal stability, the EU-wide supervision and stress test of banks, insurance, pension, and credit agencies, the control and enforcement of state aid rules, the management of the financial and technical assistance to member states in difficulties, the Commission's intervention in the Greek financial crisis, and several reports about new mechanisms such as the European semester, SRM, SRB, CMU, AML, or the ECB single supervisory mechanism. We continue to look towards the future. Our role has grown significantly in tandem with the EU. Due to the restructured MFF and the Next Generation EU, we take our role to protect the interests and rights of the EU citizens and stakeholders very seriously. I'm happy to be a part of this, and it's with great pleasure that I hand over the conference to Michal, and I wish you all a fruitful discussion today.
Thank you, Ildiko, very much. And I'm very glad that you joined the conference. I think it's very good that you have underlined why it is important also for the Court of Auditors as an EU institution to be involved, and more importantly, what value added it can add. Thank you very much again, and I hope you will be able also to stay with us today. Well, let us now proceed further in line with our agenda. We have a lot to cover as we plan to discuss two important and relatively broad topics. the lessons learned from the previous crisis, and the resilience of the EU financial sector to face current challenges. Both are linked, obviously, as we can already see from the previous interventions, most notably by the Executive Vice President Dombrovskis. We become successful through continued learning, and no organization, including the European Union, can afford making the same mistakes over and over again. It is simply too costly for the Union as such, but also for the public, for the taxpayers' purse. Capturing important lessons learned and making effective use of these is key. Luckily, the European Union learned from the global financial crisis, but has it been a thoroughly good student? Have we missed opportunities post-financial crisis that would come to bite us with the new COVID crisis? So these are the questions that our speakers and panelists will be dealing throughout the day. This will be the topic of the first part of the conference, and I will have an honor to moderate the first session. So let us now start the first part of the conference. And on behalf of the court, I would like to sincerely thank Ms. Irene Tinagli, the chair of the Committee on Economic and Monetary Issues of the European Parliament, for having accepted our invitation to share with us her views on these matters. The Econ Committee is in the leading seat when it comes to shaping the policy agenda. I think we are all looking forward to your keynote address, Ms. Tinagli. So please, the floor is yours.
Okay, thank you very much. I didn't realize I had to switch on both microphone and video camera. Can you see me and hear me okay?
Yes, yes.
Yes, perfect. So first of all, I really want to, thank you and thank the European Court of Auditors for organizing this event. I think it's a great opportunity to, take stock of the initiatives that the European institutions have already completed, as Vice President Dombrovskis also highlighted. Also, the things that are in the pipeline with regard to the banking, financial, and insurance sector, and also to think about, to reflect on the challenges that we still have ahead of us. These first 20 years of monetary union have brought enormous benefits. I mean, we need to recognize those. The purchasing power of over 300 million European citizens has been protected thanks to a stable and a moderate inflation rate, as financial stability, although, with some exchange rate risk between a euro area member states has been eliminated, helping to promote economic growth and maintain financial stability. And, finally, the single currency has simplified and stimulated both trade and labor mobility. So I think this is something important that we should never forget. However, despite these undoubted advantages, the euro area, we have to recognize, as you said, we have to learn some lessons, did not manage to prevent the financial crisis from hitting his members very heavily. The most acute episodes of banking turmoil and subsequent sovereign debt crisis have shown that the monetary union was, and unfortunately still is, largely incomplete. Suddenly we realize that the monetary and financial integration that we have, observed in the first 10 years, on some aspects was more apparent than real. And so we need to reflect on this. You know, the increased possibility of borrowing on interbank markets has for sure facilitated the funding of local banks from foreign markets. But in many member states, this money has ended up being used largely in specific sectors of the national economy, such as real estate and equity. And so paradoxically, instead of observing a progressive disruption in the link between national banks and the national economy, we have observed exactly the opposite. So financial integration, rather than diversifying the risk, has ended up concentrating this risk even more. On the other hand, the massive use of the interbank channel for funding meant that the bank's foreign liabilities consisted mostly of short-term and debt-based liabilities. So the outbreak of the crisis and the consequent block of the interbank channel was enough to put the financial sector in serious difficulty. Now, so the combination of these two elements had a third consequence. The poor geographic diversification of risk made the impact of shocks even stronger, and the absence of a true proprietary integration has made it more difficult to distribute losses across jurisdictions. So the cost of consolidating bank balance sheets thus fell almost entirely on national governments, and the result was the infamous bank sovereign debt link, which further aggravated the fragmentation of the euro area. Now, breaking this link and working for an authentic and sustainable financial integration has thus become the compass of the EU after the financial crisis. The banking union, of course, is key and is part of this journey. Two were our aims. First, to ensure that the banks of our member states are considered the banks of the euro area and no longer the Irish, the Italian, or the German banks. And second, ensuring that the credit conditions within the Eurozone were no longer linked to the geographic location of the potential borrower, but exclusively dependent on the creditworthiness. Now, to achieve these two objectives, we introduced the single rulebook and we established the SSM and the SRB. These steps were a fundamental condition for increasing the efficiency of the financial system and for relaunching the integration process on a more solid basis. However, you know, they pose many challenges. And then just mention 2 or 3 of them, and then I finish. The first challenge is to have an effective level playing field. Having a level playing field is important in all markets, but especially in the financial one, because regulatory arbitrage not only has consequences in terms of distorting competition, but can have a negative effects that go beyond the banking and financial system and can also affect the real economy, as you know, we have seen, with significant negative spillovers also on other member states. So we experienced before the crisis how damaging the consequences of a highly heterogeneous regulatory system were, and how this situation deeply undermined the economic and financial stability of the European Union. A gradual harmonization of areas where the national options and discretions apply, including in the area of insolvency, would be key in order to encourage a sufficient cross-border consolidation process between banks. The second challenge is to assess the adequacy of the EU Banks Crisis Management Framework. The need to review the crisis management framework has been accelerated by the COVID-19 crisis. And indeed, it is reasonable to expect that we will see an overall increase in banks' non-performing exposures in the next few months. And we cannot exclude that these may cause difficulties for many credit institutions. We hope not, but it may happen. And one issue is whether the rules and the institutions that we have built over the last years are really capable to effectively manage a system-wide crisis. This is the question that we have to ask ourselves. In its EU Financial Sector Assessment Program of 2018, the IMF raised serious concerns on exactly this regard. and claimed that the EU bank resolution framework does not allow for the type of flexibility that is needed to preserve financial stability in a widespread systemic crisis. And this could make authorities prefer to use national procedures to reach some other outcome. So I think this is something we really need to think about. And on top of that, we have another issue, namely whether the BRRD framework is suitable for handling the crisis of small and medium-sized banks. The experience of the last year cast some doubts on this regard. A reform of the crisis management framework is not only necessary, but I believe it's really urgent. An approach based on a partially harmonized insolvency framework with an enhanced role for the national DGSs could deliver some benefits, but it also risks producing an inefficient and ineffective results because national frameworks would undermine one of the main aims of the banking union, which is the cross-border market-driven consolidation process between banks. So in my view, an FDIC-like formula managed by the SRB, implying the creation of a united bank-specific insolvency regime, looks to be the ideal option for the full development of the banking union. Now, these considerations, take me to the last and third challenge, that is the completion of the banking union. It is often said that EDIS is the only way to guaranteeing that each euro on deposit would carry the same value, irrespective of whether the bank and the customer are located in the EU. But for me, I think that EDIS is actually much more than this. EDIS is the institution that can ensure consistency between the responsibility of the decision-making process and the level where the costs are borne. And therefore, EDIS is the key element that allow us to overcome the two challenges that I mentioned before, the harmonization of the EU bank's resolution liquidation regime and the cross-border consolidation process between banks. Now, I spoke a lot about banks, but let me just conclude with a consideration on insurance market, because that's important as well. The entry into force of Solvency II represented a critical shift in the assessment of solvency. And last crisis, as a result of COVID pandemics, showed that the overall resilience of this new framework. So it was a good initiative. European insurance companies arrived capitalized and well prepared to this crisis, and they have been able to go through this crisis on a strong basis so far. Now, Solvency II has two challenges ahead. They need to be integrated in the overall European strategy of sustainable finance in order to create the right framework to equip insurers with the tools to evaluate their portfolio and investment decisions against the challenges of the Green Deal. And moreover, Solvency II should be able to capture also a low interest rate environment, which became the reality for many investment decisions. And this is clear by looking at the Euro swap curve. The capital and prudential requirements should be calibrated accordingly. So Solvency II review is the right opportunity to ensure that those changes are included.
Non, j'ai mis dans la cave ici.
Now, in conclusion,
Comme je ne savais pas d'où elle venait, qu'elle était.
The financial crisis forced us to better structure our financial system. The COVID crisis has confirmed the goodness of what has been done, but also that much needs to be done. So Parliament is ready to continue this journey towards a stronger and more effective union. And I really thank you for the opportunity of speaking this morning. Thank you.
Thank you very much, Mr. Nagler. Really a very quick and comprehensive overview, and I took some notes of your very interesting thoughts. For example, that the European Monetary Union is incomplete, and there is sometimes more appearance than real functionings of the rules and the institutions that we have. Also that financial integration unfortunately did not lead maybe at the extent we wanted to diversification of risks, but to concentration, and this is still certain risk as we speak. Finally, you mentioned three important points that our panelists will discuss later. Basically, you pointed out at the unfinished business, and this is from the course perspective very important, that the expectations the European institutions raise in the public are actually met by implementation on the ground, and sometimes the court has seen certain divergences in this respect. As I said, many of the points you have mentioned will be addressed during the conference. Maybe a brief follow-up question to you, if I may. Basically, how to build more trust among member states to convince them to move forward on the most difficult part of the puzzle that are still not there. Of course, we cannot say that everything that has been done since financial crisis are low-hanging fruits, because these are major decisions without any exaggerations, and difficult decisions. But still, maybe more difficult decisions are still in front of us. So, from your perspective as member of the European Parliament, how to build this trust among member states to move forward?
Well, that's a very difficult question, because building mutual trust is part of a broader political relationship between the member states, and it's always also difficult to isolate and separate banking and financial matters from other issues. So it's very complex. However, I think that we can build on the experience of the past 10 years, for example, and to realize that when we set too many conditionalities or a very precise sequence of reforms that were set, normally we bumped into obstacles and few progresses have been made. And even when they get done, then they got stuck again because new conditions, new strict conditionalities were set by some, and others didn't like and lost faith in their, on the seriousness of the commitments. So I'll just give you an example, the eternal debate between risk reduction and risk sharing. So I think we could spend hours listing all the risk reduction measures that have been taken over the last decade. But I could get away in a few seconds listing the measures on the risk sharing. The only result of constantly subordinating the risk sharing measures to the risk reduction, and then moving the goal of these, the former, further and further, has been that those who wanted more risk sharing are now beginning to, despair and no longer want further risk reduction measures. And this has created a block situation. So they lost faith, they lost trust, and we ended up in a block. And the same consideration can be made with the home host issues and so on and so forth. Therefore, I think that in order to move forward with the reforms, it's necessary that the roadmaps foresee the fair progress for anyone. And and to return to the previous example, risk reduction and risk sharing should proceed in parallel. So everybody feels that there is a serious commitment, there is a fair way of approaching it. The second consideration is that we should avoid transforming a problem into a solution, because more often than not, the origin of the problem lies somewhere else. For example, the bank sovereign link is a problem recognized by all. However, I think that the idea of solving the problem simply by telling banks not to buy national bonds, I don't think it's will solve the problem. As I said at the beginning, in my speech, the liberalization of capital movements has not significantly affected the purely national nature of the banking systems of the member states. And the solution to this problem is to, Europeanize our banking system. advancing further with common institutions and with regulatory reforms that favor proprietary integration. And so in this way, we can really, truly contribute to reducing the link between banks and sovereigns. So we need to really look a little bit forward and look at the origins of the problems and think about the truly European solution. So I think these are a couple of lessons that we can learn from our past experience and hopefully move forward in what we all agree is our aim and objective for the future.
Thank you. Thank you very much. I think a very interesting perspective on so-called unfinished business. And I think that the weaknesses that we all recognize do exist in the current system should better be addressed before the removal of the current massive support measures to the economy at national and at the European level. And this is where I think this risk-sharing kind of element comes in the form of Next Generation EU, which is an unprecedented example of this risk-sharing at the EU level. And also before we see a potential deterioration of the asset quality of the banks, because for the time being it's recognized many banks have been shielded in a way from the adverse economic effects by support measures. Well, thank you very much, Mr. Nagli. Really glad that you were able to come and share with us your thoughts. Hope we will continue our cooperation in the future. But before you go, and without offending any supporters of the English team, I would like to wish the Italian team, your countrymen, good luck in the football final on Sunday.
Thank you.
Thank you. Thank you very much, Mr. Nagli. And now I see Minister of Finance from Slovenia, Mr. Andrej Šircelj, has already joined us. And I would like to really thank you, Minister, for your availability, knowing how busy your agenda is. We know by experience that building a European project is a journey, and each presidency provides its own contribution. So again, I'm very grateful to you, Minister, that you have agreed to outline the presidency priorities in the field of EU financial governance. And that's, I think, when you speak right after the second leg of the legislative authority, the European Parliament, we would certainly see some synergies in the work of the European Union. So, Minister, please, the floor is yours.
Thank you very much. Thank you very much for the invitation, and I'm very glad to speak here today. Let me begin by saying how specific the crisis is. It is different than the financial crisis that we experienced in 2008. The source of the current economic crisis is the pandemic, and this is also not a general crisis like the one in 2008, but a sectoral one. So I would like to stress that there was also a major difference in response regarding this crisis. In the current crisis, countries supported their economies with sizable measures. In 2008, fiscal consolidation was the main approach, which led to a double-dip recession. The common EU response is also of high importance. Our response at the EU level was coordinated, and the EU and international institutions agreed with the approach of supporting economies. The monetary and the fiscal policy work hand in hand. Last summer, the agreement on the Next Generation EU was reached in spirit of solidarity. This summer, the European Commission went to the market for the first time in history to support the implementation of the national recovery and resilience plans in all member states with grants and loans. Here, however, I think that we still need to be aware that this crisis is a global crisis, just like the financial was in 2008. Hence, we need to start working on a better crisis response to be prepared in the future. So this is, I think, a very important message. We did respond to the crisis as a union, and we should be proud of that. But this pandemic caught us all by surprise, and we should not encounter such surprises in the future anymore. We need to gather knowledge from the experience. We need to see what the crisis has taught us and find solutions for the future challenges. We need to have answer before the question even arises. As the presidency of the Council of the European Union, we will first focus on the recovery and the exit from this crisis. We are also aware that working on the longer-term priorities to help the EU out of the current crisis is now more important than ever. To turn to the financial area, this includes deepening economic and monetary union, addressing shortcomings in the regulatory banking and insurance framework, further harmonization of anti-money laundering framework, and work on legislative framework that supports sustainability and transition to digital finance. A stable and well-functioning banking sector is a great importance of the European Union and also each individual member state. This is especially true in times of economic crisis. Therefore, the Basel III standards could address several shortcomings in the regulatory framework. This would allow for a flexible banking system capable of supporting the real economy while preventing the accumulation of systemic vulnerabilities. Due to the comprehensive reform of the EU banking sector in the period after the last global financial crisis, with special emphasis on the establishment of a banking union and the introduction of additional capital and liquidity requirements for banks. The effects of the current health crisis on the economy are milder than in 2008. New capital and liquidity requirements have made European banks much better prepared for the health crisis. Consequently, banks are able to service the economy much more effectively, making the global economic recovery faster. The current health crisis has shown that the EU response in the financial sector has been effective and appropriate. However, the work is not yet complete. We are facing challenges on how to deepen the economic and monetary union so that the European Union is even better prepared for possible new financial and other crises. With coordinated policy responses, the EU has started to put in place the framework to facilitate the change of past financial practices and health systems. I would like to emphasize once again that dealing with all difficulties led to solidarity, sharing best practices and joint cooperation also on the global level. Security and anti-money laundering, one of the EU's priorities to make our economies more efficient. I would like to welcome ECA's performance report on anti-money laundering in the banking sector, which contribute to preparation of more coherent EU legislation. The Council is strongly committed to fight against money laundering and terrorist financing. This will be a high priority during our presidency. We therefore welcome the forthcoming publication of legislative proposals by the Commission. One of the key actions under the EU resilience and recovery initiatives is to support the green and digital transition. The recently adopted renewed sustainable finance strategy will improve effectiveness of recovery, transparency and inclusivity. The renewed strategy will also address economic, social and governance initiatives in finance to promote sustainable growth and digitalization through investment. The process of setting high standards and benchmarks will be tough, but the efforts will pay off to create a carbon neutral Europe by 2050. The digital finance package is priority and opportunity to contribute to the development of European approach in this area. With developing legislation in this area for crypto assets and digital operational resilience of the financial sector, the EU is in the process of setting not only EU but also global regulatory standards. Our ambition is to set EU regulatory standards high enough for others to follow. Our goal is also to improve capital markets union, effectiveness, and increase resilience to become more attractive to market participants. The EU wants to become a global issuer of green sustainable financial instruments. The EU proposal of green bond standards will create a highly quality voluntary standards, a new tool to support the green transition available to all issuers and help reduce greenwashing. The EU wants to provide the real economy, including SMEs, with access to various inclusive sources of finance. The revision of Solvency II framework is among the most important steps toward the completion of the CMU, as reinsurers, with their long-term business model, are committed and well placed to play a major role in helping to address mentioned challenges. As Europe's largest institutional investors, insurers have the financial strength to provide widespread benefits for the economy, acting in counter-cyclical manner and investing with sustainable long-term perspective. I hope that we will continue to work in a spirit of cooperation in such a challenging COVID-19 environment. Compromises will be necessary. However, I believe that we will soon be able to move to more ambitious targets, standards, and a higher level of sustainable and digital finance. As we move towards our goals, we will need the support of supervisory authorities. Only if the relevant data are properly assessed by the relevant supervisory authorities, the EU can better exploit the potential within the existing and newly designed legislative framework. I therefore welcome the proposed policies and legislation, in particular to strengthen the financial system to support its member states in achieving resilience and the transition to a green and digital Europe. As the Greek philosopher Heraclitus said, change is the only constant in life. Much like the saying goes, we could say that crises are also part of it. If we accept them and respond to them appropriately, we overcome them faster, become stronger, and are better prepared for new challenges. The consequences of these actions bring us closer to the reality that we experience every day. We went to EU to be inclusive, safe, green, social, and with a digital technology framework that supports the transition to a sustainable European Union. Thank you very much, Chair.
Thank you. Thank you very much, Minister. You covered a very broad spectrum of policy agenda that is on your plate, and really I wish you all success for the purposes of this conference. I think you mentioned importantly the need to deepen the European Monetary Union and Banking Union especially, and you also mentioned, for example, a more kind of specific risk coming from, for example, from the money launderers using the EU banking system for their purposes. I would like to really thank you again for joining us, and hope we will continue our cooperation, and you will use the contributions of the court in the work of Slovenian presidency. Thank you, Minister, very much.
Thank you very much again for invitation and all the best.
Thank you. Well, I think now it's time for us, the participants, to move to the first panel, session 1 of the event, and to address in more detail the lessons learned from the previous crisis. By now, we have been inspired by the intervention of the ECA President Klaus-Heiner Lehne, the Commission's Executive Vice President Valdis Dombrovskis, the Chair of the Econ Committee at the European Parliament, Ms. Irena Tinagli, and the Slovenian Finance Minister Andrej Šircelj. Let us now press on with our agenda. Here in this panel, we would like to cover a broad range of issues. For example, the EU institutional and policy response to the financial crisis, and most notably remaining institutional and policy weaknesses. The tools at the disposal to deal with distress in the financial sector, and their potential effectiveness, the synergies among them, coherence of implementation of the current legal framework, which is very important. Importance of completing of the banking union as a whole, that obviously is not only about the crisis management framework, but the crisis management framework is an important part, and maybe if not even a precondition to complete the banking union. And the importance of policy evaluation, especially from the perspective of the Court of Auditors. This is important. So let me now turn to, may I ask all panelists now to switch their cameras and microphones on, so that we all see you on our screens. The European Court of Auditors has published a number of reports on various aspects of financial governance, and more recently we published a review led by my colleague of the member of the court, Ivana Maletic. So Ivana, may I now turn to you and ask you basically what has the court observed in its review on financial governance in the European Union? Overall, has the EU response to the global financial crisis been effective? Ivana, please.
Thank you very much, Michael. Good day, everybody, distinguished guests and dear participants. So I will a little bit reflect on our review, which was published in September last year. And it was about how the EU took account of lessons learned from the 2008-12 financial and sovereign debt crisis. I was happy to hear the speeches given by Vice President Dombrovskis and also President of Econ, Ms. Irena, and Slovenian minister, because they all refer to and actually underlined elements which are highlighted also in our review. So basically, of course, we all see and feel the same challenges, and we all can agree that Europe changed a lot. And when we compare Europe now and then in the period before the crisis and after the crisis, we can see really a lot of developments in the last decade, but also remaining challenges, and we all agree around this. So in our landscape review, we have highlighted that in response to the crisis, the EU started intensive reform agenda to address its weaknesses in the financial, supervisory and banking sector. And everything was said about establishment of the European system of financial supervision, creation of the single supervisory mechanism and single resolution mechanism within the banking union. I think that we can now not even imagine how we were able to function without all these mechanisms and the institutional setup. But this was our reality before the crisis. We reacted on and improved the system. We, of course, worked on strengthening of the crisis management of the banks, regulatory reforms for the non-banking sectors, and also set up of the state aid framework, and many other elements were also dealt with. We also dealt with during and after the crisis. The EU fiscal policy also underwent significant changes. Member states reached record high excessive deficit and debts at the outbreak of the crisis, and the EU turned to ensure fiscal sustainability and introduced austerity policy, which later on showed to be not the best one. And then we started and we completely changed our approach from austerity to investment and introduced a new investment fund and many other elements to boost investments and to overcome huge investment gap, which actually raised during and after the crisis. But of course, at the beginning, we focused on lowering excessive deficit and debts. In this period, a whole set of fiscal, structural, and macroeconomic rules and coordination mechanisms has been put in place, such as the reform of the Stability and Growth Pact, introduction of the macroeconomic imbalance procedure, and of course the European semester as a whole with annual country-specific recommendations. So everything actually was done during these last 10 years after the crisis, 2008 crisis. Progress made since the financial and sovereign crisis resulted, of course, in better fiscal position of member states, and by means of structural reforms, mostly in labor market, taxation, and public administration, most member states reduced their budget deficit, public debt, and unemployment, and also boosted their investment by 2019. But this was also very much supported by the measures taken at the EU level, which European Commission introduced, such as I already mentioned, the investment plan for Europe. And this investment plan was actually more than just supporting the investment. It was also about the reforms. And now we see how important reforms are because during this new crisis, we realized that without implementation of the reform, we cannot actually strengthen the economy and improve the resilience. And because of that, the major part of the recovery and resilience facility, actually major aim, is to boost reforms all over the Europe. So with the investment plan, we definitely succeed to overcome the investment gap and remove also obstacles to investments because reforms were also supported, and through the fund, visibility and technical assistance to investment projects were provided. So the fund mobilized more than 400 billion euro in investment, which was really significant contribution. And now it will continue with the new MFF through the InvestEU program. Overall, institutional and regulatory measures introduced in response to the crisis created a robust and more resilient EU system. However, despite the significant progress made, some challenges remain, and speakers before underline many of them, such as low profitability of banks in this, of course, in a low interest environment, high level of non-performing loans still in some member states, even though we started with lot of measures were introduced in respect to this, sovereign exposures, completion of the banking union and development of the capital market union, everything what you actually said. Now here we can really think, okay, what to do? Your question was also for Ms. Irene Tignali about this. It is always very very questionable, actually, because when we think how to deepen banking union, capital market union, how to deepen market in general, we always then face this main question, okay, we need more Europe, and then we always have some voices against, some voices for, and a lot of difficulties in really moving ahead. And we have to find solutions which will be acceptable for everybody. I do know also these huge differences in the level of the development between the member states are probably huge obstacles to move further. So we really have to find good solutions how to strengthen further. Definitely, the Recovery and Resilience Fund is one excellent new instrument, and of course it was started because of the crisis. But again, with this, with the specificities of this instrument, I think that we can expect the EU path to recovery and resilience, but also to further deepening of the European monetary and fiscal union and improvement in single market. Thank you very much.
Ivana, thank you. Thank you very much. Clearly, a lot of change, a lot of positive change has been induced by the global financial crisis. And I think the EU citizens and businesses overall benefit from much more stable and predictable environment now. And I agree with you when you asked how was it possible to live, to function before and without all these helpful changes that were induced by the financial crisis. On the other hand, obviously, we are not yet there, and I can only add to what you said from my own experience in the audit report on the control of state aid for financial institutions. We concluded that there was a need for much more consistency between the EU resolution framework and the state aid provisions. I would not go into detail now, but I am glad that this has been taken up also in the ongoing crisis management and deposit insurance framework review. Ivan, I would like just to ask you a very quick follow-up question so that we are on time. From the perspective of the external auditor, do you think that we are in the European Union being complacent, being driven only by the crisis and basically repeat the mistakes of the past all the time?
Can you unmute, please, Mrs. Maletic?
Well, can you hear me now?
Yes, Ivan.
Because I didn't mute myself, so I don't know what happened, but it's always like that with them. with technology. So this is very good question, because definitely when we talk about crisis, of course, crisis is a crisis because it is unexpectedly, and we cannot actually be completely prepared for the crisis. And so we can always say that we more react on the crisis than that we are really prepared. But of course, everything what was done now after the 2008 and 12 crisis show that we can always work and try to find good solutions. And the problem, for example, what we can see from the 2008-12 crisis is the fact that the negative effects were boosted by existing weaknesses in the EU financial system. So this is, and also EU fiscal and monetary framework. So this is definitely something what should be taken into account. And because of that, as I said, we really have to think how to move forward and not because some decisions are now blocked for ages to move forward. Even though we face the crisis, we are now facing another one, but we are still not ready to move forward and to say that some things must be done, like all these linked to the capital market union, to the finishing of the banking union. So it's really something what we have to look on in a broader content and try to overcome the differences and find good solutions. As Ms. Irena said, we have to be innovative and a little bit with more solidarity within the European Union, and thinking more about overall effects and not only about sole member state one by one and what I can get from the solutions at the EU level, but also how can I contribute, and then what we can achieve as a system in a synergy, and then find within that yourself.
Thank you very much, Ivana. I think very interesting points emerge from both from your intervention, but also from the previous speakers. But let me now come to our next panelist, Director General of DG FISMA at the European Commission, John Berrigan. He has an impressive career record in the European Commission in financial policy development. The Commission, as the only EU institution having the right of initiative, has a lot of influence, obviously, and can exert even certain pressure on the member states, also on the Parliament through its legal and policy proposals. Thus, in general, one might even say that, at least initially, the level of ambition depends on the Commission. I know that you might disagree with me to some extent, but I think it is the case. So, Mr. Berrigan, based on your institutional and personal experience, what the European Union should or could have done differently in terms of design of its crisis management framework, and also in terms of implementation through regulatory tools or specific practices. Please share with us your views. You need to unmute, yeah?
I'm trying. Yes, can you hear me now? Very good. Okay, well, thank you very much, Mihai, for the opportunity to be here. And before I talk about what we should have done differently, maybe I need to contextualize a little bit by briefly reviewing what we did, and not to repeat what the Executive Vice President has said or what Ivana has just said, but we did quite a lot in 5 years, and we did it by historical standards in the EU very, very quickly. So it's perhaps not surprising that we may need to come back to look again to see if we got everything right or not. But in a 5-year period from 2010 to 2015, we put in place the banking union in large part. So this was a missing piece of economic and monetary union that we identified. We put in place the rule book. So this is the BRD, the Deposit Guarantee Scheme Directive, the Single Resolution Mechanism Regulation, and of course, we'd already put in place the SSM regulation. So we had put in place the rule book, and then of course we added that the state aid framework. And this was all done in a 5-year period. From the point of view of institutional architecture, we put in place the SSM itself, so the single supervisor, where Eve, I'm sure, will say some things later, and the single resolution board. So in a 5-year period, quite a lot was done. What was not done, of course, is we did not put the third pillar in, so we did not put EDIS in. And in our view, this means the framework is not finished and therefore is not optimized. It does not mean it does not work, but it does not work to its full potential. And there I agree with Irena earlier that we should have introduced EDIS by now. You know, the Commission has had a proposal on the table since 2015. A lot of technical work has continued, but really there has been no progress in the co-legislation process. So this is a gap for us, and we would like to move ahead and fill it. EDIS is, you know, when we talk about banking union, not described as part of the crisis management framework by some, but we see it really as fundamentally linked to the second pillar, which is where the crisis management framework is more often discussed. But I think without EDIS, we will never quite get the second pillar working well. In terms of the second pillar and the crisis management framework itself, well, the first thing to say is that the resolution element, the resolution tools in that framework have not been used very often. In fact, they were only used once, and that is in the context of Banco Popular. This does not mean, however, that the framework has not been tested, because there have been many cases where banks have been in difficulty and the resolution tools have not been used. So this means that no banks failed, so this is a good thing. So the framework worked. But the process was tended to be long, the process tended to be stressed, and taxpayers' money is still being used. So clearly the framework, again, as I said, has worked, but in our view has not been working optimally. And we need now to understand why the framework is not working effectively, and why, and if it is not achieving its key objectives. The key objectives being to preserve financial stability and at the same time protect taxpayers. And could it be that these two objectives are not always aligned within the framework, but sometimes they're conflicting, and that is where some of the stresses are coming in. So this conference is not only well focused, it's also well timed, because as you said, the Commission is in the process of internally reviewing the crisis management and deposit insurance framework, and trying to work out where the areas where we think we need to look to see if we need to make changes. I will very quickly go through these and then we come back on them later. As I said, the process tends to be too long and too stressed. So we think there's a need to look around the early intervention framework. Are we getting in early enough when banks are in trouble, or are we waiting too long? And of course, the longer you wait with a bank in trouble, the more difficult it is to actually implement the crisis management framework. I think we also need to look at whether the tools we have and the funding mechanisms we have are optimally designed, and are they available and accessible enough to handle all banks with all size and all business models. So here I refer back to what Irena said. You're thinking about an FDIC approach, where the FDIC use administrative procedures across the full range of banks. They don't distinguish between big and small, they simply handle them. The outcome can be different, but the process is the same. We also need to look at some of the consistency and the predictability of the framework. So without getting into details, we have what's called the public interest assessment. This is a decision, the basis for a decision on whether a bank is resolved or not. We need to check whether that is consistently used across all cases. We also need to look, again, as others have mentioned, at national insolvency frameworks, the way in which they establish their creditor hierarchy. So are differences at national level complicating the application of the EU framework? And then lastly, as I already hinted, we need to have a look at funding. And let me be very clear here, we're not talking about taxpayers' money, we're talking about the common safety nets. So the SRF, deposit insurance, to see whether or not we again have the right balance here in terms of accessibility to those funds and how they are used. And whether deposit guarantee schemes, which are still national, even though there's a DGGS directive, they're still essentially national with different rules and different uses, to see again whether there's an incoherence here between an EU resolution framework and a still very national based deposit guarantee scheme system. And here, of course, I repeat, EDIS would be very helpful because this would be a European element of the deposit insurance scheme. So I'll stop here and just say that in sum, we want to look at the crisis management framework. It's time. It's been there for 5 years now. We want to make the rules more efficient. We want to make them more proportionate, more consistent, if that's needed. At the same time, we want to fully preserve the two key objectives of the framework, which is to preserve financial stability, so we will take no risks with that, and to protect taxpayers, we take no risks there either. But we do think that there may be ways, as I said, of not fundamentally reforming, but optimizing the framework so that it works better. Thanks.
Thank you. Thank you very much. I think interesting point in the beginning that you made was that the changes there were a lot and they were done very quickly. And I still, I think, happen to remember that the deal on the SRM came at around 5 a.m. in the morning in 2015, and I happened to be in that room. In some capacity, so I think in terms of speed, really, that was very quick, and therefore, obviously, I agree with you that there's always a risk that, for the sake of compromises, we omit some important elements, or we delay them to a later stage. You also mentioned an interesting point that's also very close to the European Court of Auditors' heart. You said that yes, the system works, yet the taxpayers' money have been used, and that's what we came across in our state aid report, whereby, of course, the use of taxpayers' money was much smaller than at the height of the financial crisis, but still, in our view, it was unreasonably high, and then we went on to analyze why it was the case. And this brings me to a point that you made about two objectives, basically ensuring financial stability and protecting taxpayers' money. There is a third objective if we talk about banking sector, basically talking about competition, and that's what I think one of the drawbacks of the EU banking sector is still that this level of cross-border consolidation is not that one would have desired in the past. But maybe you mentioned yourself the ongoing review that the Commission launched, and now I think the deadline for submission of the contributions is already over, and I'm sure you already had a glimpse on what's in there. Does this consultation give you any indication in which direction to make your proposal on some crucial points? Do you get inspiration from this public consultation?
Well, the short answer to that is yes. We always get inspiration from public consultation because we make sure they're sufficiently wide. And on this one, as you'll probably recall, we had both a general consultation and a technical consultation. So we allowed people the real experts to come in and give us some very detailed technical input. But we also had a consultation which allowed people to kind of put the crisis management framework in the broader context. So I think what we're getting from the consultation is both those things. We're getting confirmation, I think, that most people see banking union as incomplete, and therefore, what we're doing to improve the functioning of Pillar 1 and Pillar 2 will always be a little bit suboptimal unless we have Pillar 3, and that is coming out very clearly. And this is not rocket science. I mean, when we put forward the banking union project, there were 3 parts of it, and we explained how the 3 parts interact. Not having one of those parts, it's a bit like the famous two-legged stool. It's difficult to sit on a two-legged stool comfortably. So we want to get the third leg of the stool in place. That's in the general. In the more technical one, yes, we are getting inspiration. But what's very interesting, and this is what you're going to hear perhaps in the question and answers, is that while everybody is sort of converging on the issues I've just mentioned as the places we need to reflect, the proposals of what we should do vary. This is not unusual in a public consultation, but there's not a single view of how you should approach the public interest assessment. There's not a single view of how you should handle access to funding. So we are getting a broad range of views. Our job is to sort of assess those and try to come up with what we think is not necessarily the common denominator. This is not what we do, but what we think is the most effective solution based on the problems and the sort of analysis that people have given us. But the areas that I've just listed for you are pretty much coming out from the consultation as the ones where those consultants think we should work.
Thank you very much. I think our audience will like to press on some of these points, but let's see. Yes, by the way, to all our audience, please, you can now post your comments, questions via Microsoft Teams chat, or you can also ask for the floor, ask for an opportunity to pose a question, but then please indicate in your post who you are and which organization you eventually represent. Now let me turn to our representatives of the International Monetary Fund. I think John mentioned himself the US solution, and in audit we always look for good benchmarks for analysis. And similarly, I know that in policy development one always attempts to see what has been done elsewhere and how it has been done. Therefore, I'm very pleased, very thankful actually to Mr. Ashok Bhatia, Director of the IMF offices in Europe and Senior Resident Representative to the EU, who has agreed to tackle several questions. IMF has a profound knowledge and experience when it comes to addressing the root causes of financial crisis. So, Mr. Bhatia, Ashok, what makes the EU approach to crisis solution in Eurozone different from that in other parts of the world? Are there good lessons the EU could have taken in terms of design and implementation of the crisis management framework? Please, Ashok.
Thank you very much. It is truly a privilege to be invited to speak at this excellent conference and as part of this formidable panel. I'm tempted to say the sort of very short answer to what makes the European experience different, or the European challenge different, is the multi-country nature. But let me sort of take a step back. I will try to bring in indeed a bit of an international perspective. If you permit, that will be focused today on the United States, not only because the US is sort of a natural comparator, and in some areas, including bank resolution, seen as a bit of a gold standard, but also my personal experience. I had the fortune of working on the IMF's US team during the global financial crisis, and as part of our first ever financial sector assessment program for the US. And that was done in 2009-10, when the embers of the GFC were still hot and the Dodd-Frank Act was being drafted. So, you know, a very interesting time. Just coming back to Europe for a moment. I mean, Sean has reminded us that banking union dates back to perhaps 2010. For presentational purposes, I was going to say, you know, it was on the 29th of June, 2012, that Euro area leaders issued their famous statement about breaking the vicious circle between banks and sovereigns. And, you know, so for my purpose today, I think of that as T equals 0, you know, and in so doing, they put in motion this endeavor to create a banking union, a profound endeavor to create a single banking space to match the single monetary space in the absence of a single fiscal space. So, you know, necessary and complex from the get-go. In terms of the international perspective, I think it's useful to sort of remember that this is not the only banking union effort we've seen in the world. The US has been engaged in a very long process of creating a banking union of its own. You know, it was in 1864 that the US created the National Bank Charter, and for the first time had sort of banks that were countrywide rather than state charter. In 1913, they created the Federal Reserve. Despite that, a history of recurrent financial panics continued. In the 30s, they created the Federal Deposit Insurance Corporation, and that was sort of a profound step that I will come back to. What followed were decades of relative financial stability. 1956, the Bank Holding Company Act, introducing consolidated supervision by the Federal Reserve. It wasn't until the 1990s that we had the Regal-Neal Interstate Banking Act, which sort of eliminated most of the remaining interstate branching restrictions, you know, so again, this sort of banking union theme at work. And then finally, of course, we had the global financial crisis. I can't resist saying that, you know, it was said at the time that then too, there was a virus at work. It was a virus in the form of subprime and other substandard loans infecting highly rated collateral, resulting in funding runs. I think one of the key lessons of that crisis for the US was that, you know, while the system for banks had held up relatively well, there were these sort of gaps in terms of large systemic non-bank financial firms, and the Orderly Liquidation Authority of the Dodd-Frank Act was very focused on that. So the sort of the Bear Stearnses and the Lehmans, you know, large complex financial groups where the flagship entity was not a bank, but a broker-dealer or an investment firm in the European parlance. So just a quick overview. Let's come back to Europe. Europe has been at it for 9 years and 10 days. The US has been at it for 157 years. In both cases, it's a process, not an event. I think Europe, you know, as we sit at a moment where we fret, we worry that banking union may be a little bit stalled. Sean has again flagged some of the unfinished agenda. I think it's worth sort of remembering how much has been achieved. To me, the sort of golden chariot of banking union is the single supervisory mechanism, which shows that it is possible to have an effective network arrangement, you know, with a strong ECB supervisory function at the center, but also participation from the national competent authorities. And this, plus forceful actions by the ECB and forceful actions at the international level, have brought us to a place where today, I mean, the book isn't written yet on this crisis, but thus far, banks have been more a part of the solution than the problem. So I think it's important to sort of have an optimism and as one recharges to take this endeavor to completion. Completion is in very large part about the crisis management and resolution and deposit insurance pillars, indeed. And here there's a whole host of issues. I think in a nutshell, what Europe needs to try to create is a single legal rule set that will indeed cover all banks, large and small. You know, the BRRD sort of created this European carve-out from national insolvency procedures for banks, but only for banks that passed the public interest test and still left the smaller banks to national processes subject to different state aid rules. And I think it is indeed very timely that the Commission should be having its rethink on this. I hope it will be a fundamental rethink that will look, among other things, at this sort of mass of funds we have in Europe, national deposit guarantee funds, national resolution funds, a single resolution fund, and talk, of course, of a single EDIS fund. I mean, the US has one fund, one resolution agency, and at least conceptually, that should be an end point, although I have no doubt that, it'll still be a network arrangement. Let me stop there.
Thank you very much, Ashok. Thank you very much. You put it all very nicely in a context, meaning mentioning that the European Union is a multi-country kind of area with various degrees of integration in various policy areas. It is, I mean, its governance and regulatory arrangements in the financial sector are very young. I mean, at the European level, they're very young, and that's, I think, what is important to have in mind when we talk about progress. I think from the perspective of the single financial space, you also mentioned single financial space, and here really we made a lot of progress in these 10 years in terms of liberalizing capital flows, whereas probably in terms of regulatory, administrative, supervisory practices, we lag a little bit behind the level of liberalization, the level of integration of in this single financial space. So I think this is what I can take away from your intervention. And yeah, I think your nice comparison with the virus is really pertinent. The virus that you mentioned of I remember myself, there were many warnings by the Commission, also by the IMF, of this build-up, but the action prior to 2007 was unfortunately not taken, or not to the extent that would prevent. Now, in this particular, in tackling of this particular crisis, we are so far doing better, but obviously we are not out of the woods yet. I think I will keep one of the questions I had to you on the details of the financial system stability assessment of 2018. It was also mentioned by the Econ chair Tinagli for a later stage, and now I will continue by addressing our speakers. And I would like to welcome Mr. Yves Mersch now. Mr. Mersch, are you there? Yes, you simply now.
Yeah.
Yes, you are there. I think we need to all put our cameras on. I mean, the panelists. Mr. Mersch is a former member of the executive board of the European Central Bank. While at the European Central Bank, Mr. Mersch has always been very outspoken and clear on numerous matters, including the need to address the weaknesses in the financial governance and crisis management framework. Once you said that Europe has no problem with identifying the issues it faces, but it has a problem with implementing solutions. And it is difficult, obviously, to disagree with that. So I would like to ask you, Mr. Mersch, what the EU could or should have done differently. What are the main weaknesses of the EU crisis management framework, and didn't the compromises in the EU decision-making led to inbuilt ambiguities that pose certain risks right now and in the future. So, Mr. Mesh, please, the floor is yours for introductory remarks.
Thank you very much.
Please, Mr. Mesh, could you put your camera on also so that we all see you?
On off. Okay.
A camera, yes.
Okay, that's fine. The microphone is on, the camera is off.
Yeah, but could you put also camera on?
I have it on. Okay. I need to be connected. I'm connected from my point of view.
Yes, we hear you. Okay, I think you could start delivering your introductory remarks, and hopefully we will also see your picture on screen. So please, Mr. Mesh.
Okay, from my point of view, the camera is connected, so it must be in the network. But again, thank you for also having a has-been of your panel, and not only active policy shapers and makers. And I would start by saying that I have hardly had any disagreement with what I have heard. And but I would again insist on the weaknesses very often come from the fact that what we would like to see or like to have is a big gap from what we can have. The reality, sometimes we need to focus on the reality of the difficulties in order to overcome them. I give some examples. Yes, the US system is very complex. The regulatory system, the institutional system is complex, but it is more or less mature, while the European system is even more complex. And it is also permanently evolving and thereby not mature, and it is very dynamic. For example, we have today European competence that is exclusively at European level. We have European competence that is shared with the national level. We have European competence for EU regulation, but even today, in some cases, for national law. And we have a treaty provision, and we all abide by the rule of law, that says that the default competence is a national competence. We have heard several speakers deal with the question of bankruptcy. But bankruptcy can touch on public order regulation, which in many countries is of a constitutional nature, because it touches upon basic human rights, among which property rights. And history and experience in our different countries has shaped different attitudes and cultures, and therefore progress to share competence at EU level is only achieved in ornate compromises. And let me look at bankruptcy. In some countries, this is in the competence of the ministers of justice and not in the Minister of Finance. And if we were to create a 28th regime for banking bankruptcy, it would leave out areas where the risk has migrated, like investment funds, which would remain still in national regimes. And will we create less complexity by adding an additional regime? On top, I think we have not only a very big divergence of attribution of competence, but also who exercises it at the institutional level in all our countries. In some countries, we have agencies which report to the Minister of Justice in some areas. In others, it is the Ministry of Finance. The attitude of finance ministers vis-à-vis the European construction is very different from that of ministers of justice, which are much more in a mode of what I would call the third pillar. That means in the intergovernmental coordination mode, while the finance ministers are more at ease with a mode of functioning which is closer to a federal process. So all this needs to be taken into account when we make adjustments. And it was, at one moment, it was said by, I think, the Minister of Finance from Slovenia, that if Europe makes the same analysis, it is able to move forward. If there is disagreement on the analysis, we do not move forward. But that is very true. In the oil crisis in the 70s, there was disagreement as to the response, and there was great havoc. In the financial crisis, there was, to some extent, agreement, because it was acknowledged that this was also a structural crisis. And a structural crisis you do not solve by simply financing. You solve it by having adjustment and structural reforms. That was done at European level or even at international level, and that brought us forward. The COVID crisis, the pandemic, on the contrary, everyone agreed that this is of a temporary nature, and therefore it was easier to agree that we should finance it, and that there should be ample liquidity, and that we should. The danger was only that every country would do a solution at its level, and we managed to keep everything together. And therefore, by and large, my analysis is the same as that of Sean or the Vice President. The response was appropriate. And I think what was very helpful was that we were able not to throw the existing structural reforms overboard, which had not yet been implemented to the full in many countries. We gave some more extension to some countries. We gave some postponement of implementation, but by and large, we preserved the framework which had been decided at Basel III. And I think time is coming soon to continue the implementation. The question is, there are countries which have not fully implemented, and they accumulated, and Mrs. Tinali has rightly said so, there is now focus on risk which has accumulated, especially in the institutions which are lagging behind. But that is not the European problem. I think that is basically a national problem of lack of implementation again. So I think those are the main weaknesses that we have seen at European level. We also see that at European level we have undue complexity because we have to some extent a direct supervision, but we have also keeping a banking coordination institution in a different institution. And that creates unnecessary duplication, and therefore, for me, predictability and the level playing field are, for me, in these circumstances, the real supervisory challenges. What should have been done differently? I think, by and large, we have seen that there might have been a little stronger consolidation in Europe. We could also, in some cases, have a higher degree of unity among the different agencies, but some were new and they were necessarily trying to stake their competence in a new field. You can also have examples of less than perfect coordination in the wide complexity that I described. One could also ask whether we have not seen that risk is migrating from areas with the EU supervision to areas which remain at national supervision. And how can we then extend EU supervision to those areas when the treaty does not allow it? So, as to the trade-offs, let me state that not everything that is done at the superior level is necessarily better. Knowledge also exists at the local level. The principle of proximity in supervision is still a valid one, but we have seen the disadvantages of. If we have more concentration of competence at EU level, we also need to reinforce the control level, the checks and balances at the EU level. And I think that is where the role of ECA is coming in. I think we should refrain by creating new areas of competence which even blur the image further. I give one example, macroprudential, where we have had very worthy analysis in this area. But if we are now trying to operationalize this area by breaking away the tools that exist in the microprudential area in order to give it to a new macroprudential area that sits in between microprudential and monetary policy, I don't think that we necessarily add to higher efficiency, but this is to be discussed. I also think we should be very careful to add new competencies at EU level if we do not have treaty provision for that. For example, in securitization, we should not mix up product supervision with prudential supervision. That could also create difficulties and tensions down the road. But these are just a few examples. By and large, I think the financial response during this crisis at EU level, between national level, EU level, and EU institutions, has by and large been quite constructive and hopeful. We have not yet fully solved the home host problems. We still need to have EDIs. I agree with all that. But on the other hand, I think if today we can close a bank, punish the savings or the account holders at national level from an EU perspective, but on the other hand, we are unable to have a common attitude vis-à-vis our enemies. We do not have a common attitude vis-à-vis our neighbors. We do not have a common attitude vis-à-vis our future energy provision. I think we should also have a slightly broader vision that we need to make progress in other areas of policy making than just finance, because otherwise finance is running ahead compared to other policy areas. Our union must progress also in more policy areas than it is right now. I stop here.
Thank you very much, Mr. Mesh. I think you added to this debate some interesting concepts. For example, in terms of, on the one hand, managing expectations between what we have and what we can have, but also at the end of your remarks, you called for a broader vision at the EU level. A very interesting comment, I think, on picking up on what Slovenian finance minister said on the need to agree on the analysis of the underlying problems, whereby before the global financial crisis, this analysis obviously differed, and that's, as you said, led us to divergent policy responses, maybe especially in the beginning, whereas now in the COVID crisis, everybody agree on the underlying analysis, and this, in my view, creates maybe a better momentum for making these last important steps, or not last, but to solve at least some of the unfinished business that we have, and I think this momentum should not be wasted. I would just like to ask you, briefly comment. I think you touched upon to some extent already, but if you can single out maybe one or two key factors or policy trade-offs that affected the ultimate design of the framework in the European Union. What basically is the major obstacle to moving forward? We spoke with Econ Chair about trust among member states, which is important. What's in your view really is the major obstacle that one would need to address using the current momentum that we obviously have in the European Union?
I think the central element has been risk sharing and risk reduction. And as long as we see that the national reforms are implemented, we should also proceed with a higher degree of risk sharing. We have done it during the crisis, not necessarily with EDIs, but with fiscal risk sharing. We made some progress, and I think this was the result also of some agreement of risk reduction. On the other hand, I think we should have been a little bit more determined in weeding out unviable institutions. We still have some very weak institutions in some countries, and we see again in the crisis, of course, they did not have the comparable buffers, and therefore they are suffering again, and they are focusing on risks again at the national level. And the longer we keep these institutions alive, or the less we are able to consolidate them, the more there will be resistance to achieve also the banking union as it should be achieved by now. Therefore, being a little bit more determined on consolidation, I think, would be helpful. I think by and large, I would say we have a good degree of exchange of information among the different institutions. In the few cases, we have managed to establish processes which are viable. It remains, and it has been mentioned by several, that death in some countries for a bank is still a national issue. And we have to overcome this, but as I said, this is not only a pure financial issue, it is also a legal issue. And how to achieve this, I think we have to be imaginative. All the Commission, the legislators need to address this. And I think we have to fulfill Capital Markets Union, as the Vice President has also said. And let's not forget, we also need to strengthen the control mechanism, the accountability. And that is transparency, but it might also involve the role of the European Court of Auditors.
Thank you. Thank you very much, Mr. Mesh. Really, yeah, this risk sharing, I think, is mentioned already for the second or third time, and I think the EU made certain progress in this respect, and that also might help dealing with some backlogs in terms of structural reforms and boosting the growth potential in various member states that would probably create a better environment to move on issues in the financial sector. Thank you very much. Let me now turn to last but certainly not least, Mr. Gorsos. Mr. Gorsos is a professor of public economic law and also he's a president of the European Banking Institute's academic board. Professor, you recently co-edited and contributed to a book on pandemic crisis and financial stability, which is very fitting to our today's debate. And we are truly delighted to have an opportunity to benefit from your participation at the conference. From an academic point of view, what are the main strengths and weaknesses of the EU crisis management framework? Mr. Gorsos, Professor, please share with us your views.
Good evening, and thank you very much. It's really a pleasure and a privilege to participate in this high-level panel. And after all these points that have been raised, yeah, I don't think there is too much to add to the discussion. But nevertheless, I will try to make some specific points. financial stability has been enhanced during the last 12 years. If there is one comment which I would fully share, at least from what I have heard before by John, was that, of course, the European Union has taken a lot of measures in terms of financial stability. These measures were taken, I would say, in different waves. The first wave was in the aftermath in the wake of the global financial crisis, 2007-2009, and the European Union framework in that sense was heavily influenced by international developments, meaning that, for example, the CRR and the CRD4 on the one hand, the BRRD, to a lesser extent, the GSD directive, but also the MiFID II, the Solvency II, because it's not only banking, it's the entire financial system which has been enhanced, plus legislation on payment systems, because the standards have also been raised, have been heavily influenced by international developments, by work conducted in the Basel Committee, in the Financial Stability Board, in the IOSCO, in the International Association of Insurance Supervisors, in the CPMI, in the Committee of Payment and Market Infrastructures. And then we had a second wave of measures, which were the banking aspects, the banking-related aspects of the response of the European Union to the sovereign crisis in 2010, because there we had an enhancement of the economic policy framework, with the establishment finally of the ESM and other measures taken. But then a child of these developments was the creation of the banking union, which correctly remains incomplete because the third pillar is not there. But I believe that there are some other aspects which are equally important and need to be developed. I will come back to this in 1 minute. And then we had a third wave, which was confined to the capital markets. And this was mainly driven by European initiatives, the creation of the Capital Markets Union. And in that sense, we had a lot of legislation in the field of capital markets, well and beyond the previous one, if you only take into consideration the fact that sustainable finance had never been discussed before the establishment of the action plan, before the publication of the action plan of the Capital Markets Union, and now is in place. And finally, the fourth wave, which did not prompt a lot of legislative action, but again, it was legally important, is the current pandemic. Because on the one hand, we had the application of any kind of flexibility, which was embedded already in the system, while at the same time, some quick fixes have tried to foster the financing of the real sector of the economy by the financial system. Having said that, one conclusion that can be drawn, I will end up with 4 conclusions. One conclusion is that our system has been enhanced. There is no doubt about this, not only in Europe, globally, but especially in Europe. If you compare, if you go to the thematic and the cross-country reviews conducted by, for example, the Financial Stability Board, and you check where the EU stands with compliance with the rules, you realize that the European Union is on the top. This is one major conclusion. A second is that despite the fact that the single rule book, as we call it, the substantive rules on the harmonization of different aspects of financial regulation has been enhanced, when it comes to the institutional structure, we have created a new asymmetry within an already asymmetric economic and monetary union, if this is the broad picture. Because on the one hand, when it comes to prudential supervision, we have some banks being supervised by the ECB directly, the others being indirectly also supervised by the ECB within the SSM. When it comes to capital markets, mainly supervision has remained at national hands, with some exceptions. And when you go to the insurance sector, there you only have national supervision. So in terms of the internal design of the institutional architecture of financial supervision, there is a definitive asymmetry, which is further highlighted by the fact that in certain cases you have conglomerates in which banks and insurance companies are participating. So this is an aspect which I would like to stress. A third aspect which I think has been discussed already concerns the crisis management framework. And we are in the middle of discussions. We had the questionnaire of January by the European Commission on enhancing the crisis management framework. The EDIS, the absence of the EDIS is one element. In my view, nevertheless, there is another element which is even more important. It is much more difficult to achieve, not from a political point of view, which I understand is the reason why the EDIS has been delayed, but from a legal point of view. And it refers to the harmonization of banking insolvency rules. Yeah. We have seen, for example, in the case of the several bank resolution tests, yeah, which were conducted by the SRB. We had 5 or 6 of them. In one case, correctly pointed before, we had the resolution of a bank. In all other cases, the public interest criterion was missing, and the decision was taken to close down the banks, to wind them up, and then national rules would apply in this case, not in violation of EU law, but in the absence of EU law. And then the results were different. So in that sense, in my view, this is one of the most important missing elements of the banking union, and we need to enhance it. Another element, which I would also consider as important and very important in my view, is a fourth pillar of the banking union, which would be the centralization of the emergency liquidity assistance. As we know, liquidity assistance as lending of last resort is provided mainly by national central banks within the euro system, yeah, albeit within the limitation set by Article 14, Paragraph 4 of the statute of the ECB and the European System of Central Banks. But still, I do believe that it is for the European Central Bank to take this role, but again, this is an open question. Concluding, in the middle of the crisis, and this is the fourth, the current crisis, the pandemic crisis, and this is my last remark, it has been remarkable that the banking system was not involved as a sinner, but as part of the solution. And this was definitely to be attributed to the fact that the building up of capital buffers throughout all these years, especially the last 4 or 5 years, and the higher liquidity levels in the banking sector have allowed the banking system to enter this crisis in a much robust situation, even though one major problem that we will face again, unfortunately, in the European Union is the rising again level of non-performing loans, which this time will be caused by the consequences of the pandemic crisis in the real sector. If you check all the recent, and when I say recent, even of this week's reports of the ESRB, of the ECB, of the BIS, we realize that the tackling of non-performing loans is again one of the most pressing issues that we will have to face, especially when the moratoria have been lifted and we have fully returned to the new normality. I can stop it here. Thank you very much. I'm terribly sorry if you could not see me. I have tried for more than an hour to fix my camera, but I could not. Thank you very much.
Thank you very much, Professor. I think the fact that we don't see you is of course unfortunate, but I think I think your intervention is what really important and what adds value. So really, thank you very much. I think you identified both the malaise of the current system, and you also, in a way, proposed certain ideas. For example, the fourth pillar of the banking union. Can I conclude, Professor, from your intervention that the European Union preparedness for the crisis in the financial sector can be tested very soon or relatively soon as a result of the pandemic? Here, the assessment of various institutions, stakeholders differ. But from what you said, I understood that we better be alert and we better be prepared.
I think so. Yes. We are not in an alarming situation as we were in 2007, 2009. And obviously, we do not have the same ignorance of consequences of a crisis as we had in 2010. Because in 2010, the sovereign crisis revealed some weaknesses even within our treaties. The fact that we didn't have any sovereign crisis management framework, and then this has been gradually been built, with a modification of the treaty, Article 136, paragraph 3, and then the resort to intergovernmental agreement for the establishment of the EFSF and the ESM. These days today are different because the framework is there. And even though it can be improved and the lessons from the last 8 or 10 years have tested also this framework in real time and real life conditions. I do believe that the alertness should be there. This is correct. And it's not only the NPLs. It may have also to be linked, but at a later stage, with developments in capital markets, especially when the monetary policy stance all over the world will change and interest rates will gradually increase again, which on the one hand would restore the transformation function of the banks, but on the other hand, we have lived for a longer time in zero, very close to the lower bound of interest rates, and the reversal of this may also have to give some alert signals. So to put it short and in a nutshell, yes, I do believe that we are in difficult times, but again, these times are different in the sense that both the monetary union and the banking union and the capital markets union are stronger today than they were 10 or 12 years ago.
Thank you, Professor. Thank you very much. Yes, I think certainly these days we are less complacent than before the previous financial crisis. So we have concluded basically the first round of remarks, comments, and follow-up questions. I would like to invite our audience now, especially to ask for the floor, to ask a question, or to put a comment in Microsoft Teams in the chat. So feel free. I see we have more than 200, I think 200 participants on Microsoft Teams. So I think we would benefit from your active participation too. For the time being, I don't see any posts there. Let me probably turn to our panelists and really ask you to comment on the following questions. Several speakers spoke about various types of unfinished business, and some of this business can be sorted out quicker and easier, and some, such as insolvency, for example, legislation, as I think Mr. Mesh put it, sometimes ministers of finance and ministers of justice do not understand themselves. And while this understanding is coming, in the meantime, probably there are other tools, other solutions to improve the functioning of the current system. And one of them, I was thinking when I think John Berrigan was speaking, he mentioned the early intervention measures, because I think in the past financial crisis we saw that we intervened in many cases too late. And on the one hand, and on the other hand, these early intervention measures could also prevent the potentially failing banks or failing banks from really entering the situation when it's too late, and when unfortunately the use of taxpayers' money sometimes is necessary. So, dear panelists, I don't know who would take this question, really, how to improve the early intervention tools from the point of view of their existence, but maybe more importantly from the point of view of their implementation. Is anyone on the panel who would like to tackle this question?
May I have the floor, Mr. Kozlovs?
Yes, Professor. Yes, sure.
Thank you very much. Let's first clarify the point on improving this framework is very correct, and I would fully agree. Nevertheless, I think that when you dig into this discussion, there is an overlapping, first of all, between the early intervention powers and the specific supervisory measures given to the supervisory authorities. And as we all know, the early intervention measures, even though they are included in the BRRD and then reference is also made in the SRMR, yeah, they are supervisory measures of last resort, if you wish. So in my view, in this context, a streamlining between the specific supervisory measures that, for example, the ECB can take under Article 16, and then the early intervention measures that it can take in accordance with the BRD needs to be taken into account. If you check them, you will realize that, with the exception of one, they are similar. So the question arises when a bank is close to a situation where the next step would be that the bank would be considered as failing or likely to fail. Is it specific supervisory powers that should be taken, or the very similar early intervention measures, which nevertheless are to a certain extent harsher? So this is an aspect which, in the review of the crisis management framework, will also be included in the discussion. Thank you very much.
Thank you. Thank you very much, Professor. And anyone else from the panel who would like to tackle this? Since John, you mentioned these early intervention measures and basically preventive measures. Would you like to add anything on that front?
I'm having difficulty unmuting. Can you hear me?
Yes, we do.
Okay, that's good. I want to come back just on the 2 points. I will start with the early intervention, because what Christos said is, of course, is exactly right, that there is this overlap between supervisory powers and resolution powers, and we needed to streamline. And that's something we spotted, relatively early on, and we have been working with both the SSM and the SRB to sort of see how that could be streamlined in a way that doesn't impinge on the powers of either side to an extent that would make the system inefficient. Another area we have to look at, of course, are the triggers for failing or likely to fail, because these are not always entirely clear. And that, of course, creates certain legal issues around the timing in which you can actually declare a bank failing or likely to fail, and therefore the timing at which you can start taking these early intervention measures from a resolution perspective. So these are the kind of two areas that we have to look at, the streamlining of powers and the fault triggers. On the insolvency framework, I mean, I'm in the sad position here where both Christos and Yves are right, in fact. I mean, Christos is right, this is one area we have to look at, and we should look at, but Yves is also right that insolvency in general is a very tricky area for the union to work because it interferes with broader issues, constitutional in some cases, but even though not constitutional, they go beyond the competence of the union. That being said, we have already to some extent interfered with national insolvency law in the BRD. So this sort of taboo has been broken because we in fact changed the creditor hierarchy and harmonized the creditor hierarchy to some extent in the BRD. So what, if we were to work in this space, we recognize that it's something that has to be done, but we also recognize that we probably have to be fairly targeted because this is how we will find the balance between Christos and Yves, that Christos is right, we need to change certain things. Yves is also right, we can't do a whole-scale reform. This will never be achieved, not in my lifetime. So we're going to have to be, just as we were in the BRD, fairly targeted in what we want to do there. And two issues you'll want to look at. One is complete the work on the creditor hierarchy, because the creditor hierarchy in resolution is now harmonized, but the creditor hierarchy in insolvency is not. And the second is to look that in some member states there is the possibility of administrative procedures for insolvency. This is particularly important around banks, but in many member states this doesn't exist. So you have a sort of dichotomy between an administrative resolution for banks that fall within a public interest test, and then judicial insolvency or atomistic insolvency, as some member states call it, for other banks. And there's something missing in the middle, which is again harking back to the FDIC scheme, which is an administrative insolvency regime, which does not rely on a judicial process, which can be quite difficult in a bank's context, but in a sense replicates the resolution framework we have in Europe and applies it to these smaller banks, with the fundamental difference that in the resolution framework, a failing bank is resurrected, and in the insolvency, that failing bank will exit the market. But they would both be fixed, settled through an administrative arrangement, an administrative procedure. Thanks.
Thank you very much. I think we have one question from the audience, at least one, and I would like to put it in a broader context of this IMF's financial stability assessment of 2018, where the IMF has proposed a number of recommendations to the European Union. I would like to address this particular question from the audience to Ashok. Basically, the more specific question is about the fact that the SRM regulation allows the SRB to declare a bank failing or likely to fail. Would you agree that the SRB should actively make use of this right, as it is the SRM who finally has to deal with the problem of a failing bank, and not the ECB or national competent authorities that are potentially procrastinating in terms of failing or likely to fail decision? So this is a more specific question, but I would like to put it in a broader context of your recommendations of 2018, where this actually was, I think, one of the ideas that SRB is more empowered. And this question comes, yes, from Sebastian Mack. So Ashok, could I ask you to deal with this?
Yes, sure. I think this question sort of meshes well with the issue of the timeliness of interventions as a bank's financial health fails. Sort of best practice in a bank resolution is that you intervene the bank on a Friday evening, and by Monday morning, a new entity has been created, and for the retail depositor, nothing has changed in terms of his or her access to their deposits. This, of course, begs the question of, well, what do you do if the run on deposits or whatever failure event inconveniently were to happen on a Monday or a Tuesday and not a Friday? And the answer there is the bank should have been intervened a week earlier. That makes the question very relevant. Sean will correct me if things have changed since I last looked, but my information is that the failing or likely to fail determination is subject to a dual trigger. Normally, it's made by the ECB after consulting the SRB, but it can also be made by the SRB after informing the ECB of its intention and waiting 3 days. Now, one could perhaps consider eliminating the 3-day wait, but there are limits to how much one can legislate proactivity. I think there is a broad sense that one needs to grapple with failing banks sooner rather than later. The fund had raised a number of other issues in 2018, including a systemic risk exception and so on, but let me not stray right now.
Thank you, Ashok, very much. Let me probably put a question now myself to our panelists, because this is also important from the perspective of the Court of Auditors. In all these discussion, there is always an issue of consistent approach, equal treatment of financial institutions in various member states. And this is important, especially from the perspective of the court, from the point of view of protection of the single market and competition. And it certainly cannot be a secondary issue in all this debate. We will see discrepancies of the approach in supporting the economies also now as a result of the COVID crisis, where support intensity and types of support differ, that might lead to further divergences within the European Union. Probably I would like to address this question to Ivana. My colleague Ivana Malecic from the court, member of the court. How do you see the importance of really ensuring this equal treatment, consistent treatment from the point of view of the internal market, of integrity of the internal market, and then indirectly also integrity of the financial sector? Because as I said myself, I think this objective of competition or safeguarding competition might have been neglected in favor, or neglected to some extent in favor of financial stability. Ivana, would you like to briefly comment?
Thank you very much, Michal, for this question. So definitely equal treatment is extremely important, but the problem in Europe is in this such diverse economic situation in different member states. So basically, what does it mean to apply equal treatment? It means also to take into account specificities of each and every member state, and then based on that define what are the best solution for the Europe as a whole and also for individual member states, which is of course in theory easy to say, but in practice almost impossible to implement. And this is why we have the problems with the further deepening the single market and also monetary union, and not to talk about fiscal union. So for example, when we think about capital market union, we all know that this is needed. All member states are very much aware of the advantages for the businesses, but at the end, we cannot move forward because we need structural reforms at the national level to deepen capital markets at the national level before we really can have like a unique solution and then also equal treatment all over the Europe. So this is really very, very complex, but definitely in terms of some policy, we already started, and we have a lot of regulations in place, like for example, without state aid regulation implemented equally all over the Europe, we cannot even talk about fair competition and single market. So it's but again, we have difficulties with the state aid in the financial sector. You know that the best because you were dealing with that. You just recently published the report. So this is definitely, this is very, very, very challenging, taking into account specificities of the Europe, which also all other speakers during our panel underlined.
Thank you. Thank you very much, Ivana. I think, yes, I think you're right that not only declaring, but making sure that there is a genuine internal market, single market within the European Union, also in the field of financial services, is really important. I think we still have time for one question, and I would like to pick it up from the chat. I think we have a question from a colleague from DG ECFIN, and I would like to address this question to Mr. Mesh. The question is as follows: is there a political momentum for setting up an automatic risk-sharing facility, like an updated USF, triggered by country shocks? Mr. Mesh, would you like to address this?
Obviously, we are not that far for having automatism because first we would need to have objective criteria all throughout, and as it has just said, the criteria are very often very country-specific, case-specific. If you would have, in the name of equal treatment, closing down all the banks in one country, would that be equal treatment? Would that be a viable solution? So I think there are more specific considerations to be taken into account before we can move to an automaticity. Automatic risk sharing would be like having a prepaid check signed up by every government and distributed to the weakest member. I think that will, at least from the present functioning of the Union, not be possible.
Thank you very much, Mr. Mesh, and also I'd like to really thank to all panelists. Just we still maybe have a couple of minutes left. I would just like to ask you before I conclude whether any of you would like to contribute or to make any or to say anything that you wanted to say but haven't had time until now. Probably, I think it's very important, at least from my perspective, also from the perspective of the court, is to really have more clarity on do we have time and how much time to deal with all the issues that you have identified in your interventions, especially because until now the tools that we have not been tested in full, and we have difficulties to understand or to assess their potential effectiveness in case of a broader based crisis that we hope will not occur, but the risks are still there. So if any one of you would like to intervene on or around this question, by way of kind of concluding remarks from any of you, please.
I can have a stab if you permit.
Yes,
think,
yes, Professor Ron.
Sorry.
Yes, go on. Go on,
okay.
Professor.
Sorry. I can have a stab. I think that we do have this precedent now of creating a carve-out from national insolvency for banks via the BRRD. But it's limited to banks that pass this public interest test. Now, one could argue there is a public interest in administrative processes to resolve or wind up all banks. And indeed, this is the approach taken in the United States. So I think a possible sort of widening of the scope of BRRD is something that warrants a good look. And also equally, that deposit guarantee funds should be available to finance resolution operations. It should be possible to do purchase and assumption transactions for all banks, and often that will be the cheaper approach, the cheapest approach. So just those are a few closing words from me.
Could I maybe
thank you, Ashok. Yes, yes.
Could I maybe just add on to what Ashok has said, because I think it makes a lot of sense, but then it links to the discussion we had just a minute ago about equal treatment. Because equal treatment is not only a problem across countries, it's a problem across banks in terms of their size, in terms of their structure, in terms of their business model and their liability structure in particular. So we will, if we extend resolution across more banks, which I think would make sense, we have to understand that while the equality of treatment principle is, of course, accepted by everybody, we are often left with the less attractive equivalent treatment principle, and this is one, of course, where the equivalence of treatment becomes a matter of judgment. But I think what you can't have is a one-size-fits-all approach to the use of resolution tools, and you need a more flexible or proportionate approach. And therefore, you don't look to apply exactly the same rules in exactly the same way, but you focus on the end objectives. And the end objectives must be the two big objectives of the BRD, which is to maintain financial stability and protect taxpayers' money. And you can have different solutions which achieve both of those objectives using different approaches. And I think we will have to reconcile in our head, and this is where we will have to discuss among member states, that you focus on the end objectives and you focus less on this, I think, unachievable principle of entirely equal treatment across a range of banks which are entirely different in terms of their structure, their business model, and their position in the economy. And that's where I think the big political discussion is going to be around how you measure the equivalent treatment of banks across a continuum of different solutions that deliver the same objectives. Thanks.
Thank you very much, John. Yes, I agree with you that devil is always in the detail, and these are the details that you pointed out. Obviously, have to be addressed and taken into account in the forthcoming discussions. I think the panelists, I need to sum up now, unless any of those who didn't speak want to conclude on any point. Then I think I will just conclude by really thanking all of you for participation. I think you all have been unanimous that the EU has learned a lot of lessons, and that our post-crisis reforms and quick action have certainly softened the blow or the potential blow to the sector. And the banks, you said, have been part of the solution and not part of the problem as it was in the past, although here I also note that some of you said, and I also see this from the contributions by other institutions, I mean, by the written contributions to the public consultation of the Commission, that there are certain risks still persistent in the financial sector, and they might be building up when some conditions fulfill simultaneously. I think in many respects, or in some respects, yes, new measures have not been tested fully to full extent. That's important for also for the court to see not only the rule book but also its implementation and effectiveness on the ground. And there are views that some of these tools might be difficult to use if and when the time comes. So there is a risk that one of the key objectives, meaning as little as possible recourse to the taxpayers' funds, may not be achieved. And I think this is one of the most important points if we in the near future have several banks that would need to be solved or saved by using taxpayer funds. It will deal a serious blow, I think, to the credibility of the crisis management framework. So I think we should do everything to avoid this. And I think as a last remark, I think in several interventions I heard the ideas of solidarity, and I think Econ Chair Tinagli mentioned this concept of Europeanization, meaning the need for common approaches. And not only in the financial sector, as some of you mentioned, but also integration and common understanding in other areas of importance for the European Union are also very relevant for further progress in the financial sector specifically. So sometimes it's not a financial issue, it's a legal issue, and this is obviously, this will take time at the EU level to solve. So dear panelists, again, and all participants, thank you very much for your contributions, for your interest. Also thanks to our participants for being, I should say, less active than I expected, knowing that there are very good experts in our audience. But I hope you will pick up later during the day. And I would just like now to tell that we will close this session soon. We will resume at 1:30 p.m. With the next panel, whose task will be to discuss the resilience of the EU financial sector to face the current challenges from more kind of operational, practical point of view. So there you would see colleagues who are basically in the driving seats of the reform agenda. This session will be moderated by Nicolas Veron from Peterson Institute and Bruegel. So I'm very excited to participate in this session. So do come back to what promises to be a very interesting continuation of the day. To connect, you will need to use the same link as you used to connect to this session. Thank you very much again, and have a nice lunch break for those who are in Europe. Thank you. If I may to pass over to Nicolas, the main objective of this session would be really to focus on how to solve the unfinished business, how to address this unfinished business in the field of banking union, crisis management framework. This is what actually transpired from the first session, where we looked into the past. Even a representative from the IMF looked as far as 150 years ago, when the roots of the current American system have been created. So that was very interesting. A couple of housekeeping remarks very briefly. All participants, please turn your cameras and microphones off, except our moderator and our panelists. Whenever you want to ask a question or put a comment, you can write in the Microsoft Teams chat, And the same if you want to ask a question orally. So if you want to connect and switch your camera and microphone on, also please write this, and we will try to accommodate this. Also, I think Nicola would do that with pleasure. I am very pleased that we have experienced panelists, and especially Nicola Veron from Peterson Institute, who kindly agreed to moderate, and I'm really thrilled to listen to this session. So, Nicola, please, over to you.
Thank you very much, Michal, for the invitation to moderate this panel. I'm Nicolas Veron, as Michal just mentioned, from the Peterson Institute and also from Bruegel in Brussels. But indeed, I'm in Washington, DC right now. I will not make lengthy introductions of the panelists. I will just ask them to put their cameras on so that we see them all, unlike the other members of the public, according to Michail's instructions just delivered. I would also ask the panelists to make short introductions to our topic, which is indeed how to finish the job. And I will be grateful if they can be succinct, because we want this to be very conversational, as Michail said, to take as many questions as possible from the audience, and therefore to use our time, which is always limited, as fully as possible. So with that, I think we start with Mr. Satsius, right?
Yes, Nicola. Thank you for giving me the floor first. I'm in a bit tricky situation because on one hand you want to speak about the way forward. This is not the thing that auditors would like to speak about, because they are coming to very unhappy institutions. They are auditees. They are putting administrative pressure on them, clarifying things that have happened long ago. And this is what we did on several occasions in the banking union. And another issue is that in the first part of this conference, we already discussed quite a lot about the state of the banking union, about its completeness, about efficiency of, to some extent, of the first two pillars, and the absence of the third European pillar, although it was mentioned also that there is, in fact, third pillar unfinished, but third pillar exists already for some time. Deposit insurance is something that is common for Europe. The only problem for me is that we never audited deposit insurance. Still, probably this is ahead. But I will try, to serve as a bridge between the first part of the conference and the second part of the conference. As I said, auditors are a very odd player in the banking union. In fact, our work started in this area, in financial economic governance area, in 2014, where we touched upon one very important agency that should be also present, that was led at that time by Andrea Enria, the European Banking Authority, and it was not before 2016 when we went to see how single supervisory mechanism functions. And the particularity was that the auditee was the European Central Bank, which at that time, by the way, quite distinctly refused to give us all the documents we needed. The rest of the documents were black lines, and I would say that at that time, really, this was far beyond even normal, well, to put it mildly, normal relations between the auditor and auditee. From that time, the situation much improved, and now I can tell you we have a memorandum of understanding, which makes for us it easier to go and to audit operational efficiency of the management of the European Central Bank as it belongs to us by legislation. And The trick is that this is really a performance audit because European Central Bank gets none, not a euro, not a single euro from the European budget. So this is really a performance audit. I think that in single supervisory mechanism, and Andrea could add to that if he wishes. I think we made our contribution because in 2016 it was completely fresh. And we had an insight into things that the auditors only, or the auditors like the most, to see into like conflict of interest, separation of functions between separate departments. One of the principal issues that we looked then was relation of the European Central Bank with national competent authorities in the banking sector, national supervisors. This is, to my mind, what remains also to be resolved in the future. I'm happy that we already planned quite an interesting audit that will be looking in another issue that's, and this is the second part of the bridge, on development and management of non-performing loans in the ECB. But this is a work in progress, and auditors do not like to talk much about work in progress. Single resolution mechanism, the second pillar, which appeared, was created under, I would say, dramatic circumstances. I still recall these days. It was 2013, when everybody was already keeping in mind the overall picture of single resolution mechanism, but there was no political will, as we call it, and as journalists like to call it, before there was an extraordinary event in Cyprus, when the rule of 100,000 euros was for the first violated, with good reason, to try to save banks, Cypriot banks. And this was the moment when everybody understood if we don't create something very fast, then we will be in trouble. Just to make a short notice about this creation, since so it happened that I saw it quite from the close distance, I would see even at that time there was a fight. There was a fight between the European Union European idea to have something European, well, Eurozone-wide at that time, and big and very complicated national interests. When the first compromise was put on the table, how to form this single resolution fund, next day everybody was counting with a pencil on the paper what it will mean, these all national compartments and the possibilities to borrow money from other national compartments, what it would mean for national banks of those member states. I think this particularity has already almost gone to history, because if I'm right, in 2023 we should have the single resolution fund already fully mutualized, and this particular circumstance will go off. But what we can see, I think national interest is still there, and other participants of the panel will be talking about that. Our findings. The findings, we audited Single Resolution Board very recently, and we looked at resolution planning in the banks. And not only those 100 something that are the most significant, but we looked also to the planning in other less significant institutions and supreme audit institutions of other countries. I think 7 member states of the European Union undertook this in parallel. We found that there is still much to be done, although conditions for this doing are still very good, very good. So coronavirus to some extent helped to make this plateau where the risk is not too high, and we still can improve resolution planning. What Single Resolution Board is investing quite a lot. But we saw also gaps that appeared not only because of, as one could assume, bad work of bureaucrats or whatever. There are gaps, as I said, in one area, the trend to tier all this mechanism between the member states, the national interests. There are also lack of some general rules that should be in place if we want that these resolution plans would be realizable, would be easily employable. So first of all, of course, financing in resolution. Liquidity in resolution is one issue. Early intervention measures were discussed in the first part of the conference, by the way. We recommended that that these early intervention measures should be made more accessible for the institutions, including Single Resolution Board that has an exclusive right to use it. For that, we recommended that probably some quantitative criteria for triggering at least procedure of consideration, which finally anyway will be decision making by professional decision, professional judgment of supervisors and resolvers. So let me use this bad word. But still, to our mind, this could have helped. But of course, other issues, we found other issues that should be improved, like communication strategy is still at the very beginning, and substantive impediments. Substantive impediments have not yet been determined for any bank, and this is probably something that if we want to ensure ourselves from big adventures, we should do now and try to resolve, if possible, these substantive impediments. And what indeed changed, cardinally changed, this is my observation, which changed also the landscape that we should build for the resolution, is the change of the paradigm. When people are now talking about resolution that was supposed at the very beginning only for the largest, too big to fail. Now everybody is discussing, and it was also touched in the first part of the conference, but slightly, that probably we should provide with the resolution possibility almost any bank that could be to at least some extent important, not Europe-wide, but nationwide or even region-wide. And this complicates issues very much. But we must prepare for future possible growth in NPL ratio, future decisions on future of the banks, and probably this is the issue that other panelists would disclose much better than me. Thank you.
Thank you so much, and I think this was a great way to set the scene. I noted that you said we're at this point despite the coronavirus, at a plateau where the risk is not too high. So now that's a good introduction to what Andrea and Ria will tell us. I want to remind the panelists to keep their remarks succinct so that we have time for conversation. And with that, over to you, Andrea.
Thank you, Nicholas, and thank you to Rimanzas for inviting me here, but also for the words on the cooperation with the Court of Auditors, with the European Court of Auditors, that I'm glad has been put on a good footing, and we are indeed benefiting quite a lot from the findings of their audits. Now, I think my task is to give a little bit the flavor of where we stand at this moment with the banking sector. It's indeed the case that the extraordinary, let's say, support measures which have been deployed by both supervisors, monetary and fiscal authorities have definitely avoided a procyclical reaction in the banking sector. I hear recently industry participants arguing that the supervisory measures have not been particularly helpful. For instance, that the dividend constraints are going to be removed without having had material losses materializing in the bank's balance sheets, that the capital buffers that have been made available for use have not been used. I tend to disagree with this assessment. I think that we have evidence that there is also interesting research that shows that banks which have been, say, under our recommendation to constrain dividend payments are also the banks which have expanded the lending more than others. There is an interesting analysis in Spain where our recommendation hit in the middle of the AGM season. So you can see banks that distributed and banks that did not distribute. And that's interesting to show that the latter have been growing loans much more. And also the capital buffers, let's say the availability of capital buffers has increased the distance to the regulatory triggers and has enabled the reaction to the pandemic shock to have a much lighter tightening of the credit standards than in previous crises. So I think that all in all, this has helped quite a lot. Now, in terms of the situation, the snapshot right now of the banking sector, first quarter 2021, we published the results recently, capital ratio 15.5%, 1% more than 1 year ago, before the when the pandemic struck, basically. So there has been a further strengthening. Capital position is strong, and all the indications point to a stable and resilient banking sector. The uncertainty, which has been a defining feature of this crisis, has abated quite a lot. And we are also more certain in terms of the capital trajectories of the banks. We will publish the results of the stress test in a few weeks. So this means that we are on track also to possibly remove, we will decide also at the end of this month, the constraints to the recommendation to constrain dividend payments and share buybacks. Now, if you look at the view of most market analysts, the impression is that banks have increased provisions last year, that the risks have not materialized, so that the future is rather rosy. So the expectations is that banks' profitability will increase, banks will be able to reduce and even release provisions, and that therefore that there is a positive, upbeat sentiment in the markets. I don't want, of course, I'm happy about that. Having a good boost to the market valuations of banks, of course, is a good thing. And indeed, there are signs that the return on equity has increased. First quarter this year, 7.2% against 1.5% in 2020. So, I mean, there has been indeed a positive increase in profitability. It is true. And also, if you look at the asset quality, there hasn't been any major uptick. Actually, the NPL ratio has continued decreasing. We now register Q1 this year again 2.5%. So has continued going down. Now, our point is that, of course, there is still some uncertainty. Of course, let's say, usually provisions start being reduced when you are at the peak of bankruptcies, and this time we are far from having achieved the peak, reached the peak in bankruptcies. Actually, bankruptcies have declined so far. So of course we hope they don't surge again, but still this we think would recommend some caution. What we have done so far is to focus very much on credit risk controls, as the credit risk levels are very much backward looking. We look at the credit risk control, so how the banks classify the loans, how the banks move them from one stage to the other, how they assess the unlikeliness to pay of the counterparts, how they do the sectoral assessment, which type of early warning systems they use. And we have seen that some banks indeed have shown some weaknesses for which we have asked them to remediate. So that's the key focus of our supervisory action right now, because we think that having strong risk controls is what will, let's say, prevent a new spike in NPLs if eventually the situation deteriorates contrary to the expectations which are being developed in markets right now. Finally, let's say there is besides, let's say, the plain vanilla credit risk linked to the recession, we also noticed that in the environment of course, necessary and very supportive monetary and fiscal policy measures, there are growing signs also of risk complacency and excessive search for yield, which have been developed in financial markets. We have seen especially an increase in mostly in the non-bank financial sector, so what was called the shadow banking sector until recently, of increasing in leverage, increasing complexity, in financial complexity, increasing in opaqueness. And of course, these, if risks materialize there, they can also, of course, bounce back in the bank's balance sheets, where there is a strong interconnectedness with the non-bank financial sector. We have focused, for instance, very much on the leverage credit segment of the market, on equity-related derivatives. We've seen prime brokerage activities coming to the fore in the recent Archegos case. And we come to the conclusion that if there are major asset price corrections, that could be indeed be risks also for our banks. The asset price correction could come not only if there is a negative development in the pandemic figures, so let's say the recovery being hurt by a new surge, a new wave of infections, but also if instead there is a positive development, but there is a sort of expectation building up in the markets amongst investors that inflation is going to be more persistent than currently monetary authorities estimated to be. This could also drive important adjustments in asset prices. So we see this issue as relevant going forward. And what we are doing here, of course, is we are trying to deploy our, supervisory toolkit. We have focused on the leverage finance market, where we have already issued guidance some years ago, which has not been so much followed by the banks, I would say, so far. So we are trying to go a little bit deeper there, and but we are also trying to, look into these issues more carefully. So these, I would say, are the two major points: risk controls to avoid, to cover the tail in terms of traditional credit risk developments, and exuberance in financial markets and possible repercussions on the banking sector. Thank you very much.
Thank you so much, Andrea. I have many questions, but we'll leave them for later. Elke Rimantas did allude to the ongoing debate on the tools for dealing with failing banks, including resolution. Do you have everything you need?
Well, you can always ask for more. But with that, first of all, good afternoon to all of you, and thank you to Rimantas to invite me to this panel. Let me perhaps build on what Andrea said, because I think, just to make the first statement, there is excellent cooperation between the two organizations. And I would just like to add one aspect to what he said on the state of play. I think this is also proof, or the state of play could not have come without all the regulatory reforms that we had over the last 10 years, and without supervision by the ECB. And I'm sometimes asking myself, when I hear about it's all too much and we should change this and that, can anyone imagine where we would have been or where we would be today if we started COVID at the end of, let's say, 2006 or 7 on levels of capital at that time and on all the tools at hand. So I think first and foremost, the current situation is basically proof for the reforms and that they were working and fit for purpose. But I would also be fair to say it's also proof that the banks have really done their utmost to cope with the crisis. We have all done a boost in digital working and the like. So I think on both sides, we should be a bit proud of what we've have achieved. Are we already there? Of course, I could now immediately start to talk about EDIS, but I leave this first and foremost to Thomas afterwards. I would just say, where are we currently? The SRB has started from scratch in 2015. We have till now had 2 performance audits by ECA, and I think we would be able to show them dramatic or really substantial improvements, in particular, might be sounding strange, in 2020, because what we decided very early in the crisis is that, of course, we try to react to the supervisor. We try to be flexible where needed or where possible. But we also at the same time said that we would really move ahead with resolution planning, move ahead with setting MREL targets and the like. But let's also be clear, MREL has to be set up till 2024. There is a trajectory in the BRRD2 for MREL. And we have put out a document on which I think our team should be rightly proud, which is called Expectations for Banks, where we have also spelled out our expectations along all dimensions of resolvability to be reached to the same time, so early 2024. I know that, I think, Rimatas, you said in your audit report you don't see any reason, any legal basis for putting this out to 2024. I see a very pragmatic one. I can clap my hands and say, now you are resolvable. This is not how it will go. Banks need the time and need to involve, and we are, and I've said that several times already, we are currently also working on something, how to ensure that our internal assessment of banks' resolvability is getting more and more consistent, so that we can challenge our own teams, that we have the same yardstick. For this, we will work with a heat map, and I've already promised, I've made this promise, I think now twice to Parliament, that once we've gained a bit of experience with this heat map, we will also publish it. We will not publish it by each and every bank, but we will publish it, and I hope that the banks also get this as a message to stay ambitious. So where do we are and what is the work that is still ahead of us? And I think there it's very easy. We have still to finalize this trajectory to resolvability, but I'm convinced that we will get there till 2020. But we also need to see that we have various resolution tools, and that we have recently, I think over the last year, it started a debate about how to deal with certain types of banks. So there is this famous debate about a resolution framework for the big boys. Very small banks should go into insolvency, and this should be the end. And insolvency for me meaning without any state aid. And then there is the famous middle class.
Sorry, let me stop you there. You said without any state aid, that's what it means for you. But does it mean that for the rest of the stakeholders? We've seen insolvencies with state aid.
Of course, but I think we're also growing up. I'm sure that we will still have the debate about aid, and I would not rule it out 100%, because there might be the one or the other case where an insolvency needs support on the liquidity front or the like. But there's one topic which I've always said, we cannot have two competing frameworks. We cannot have...
But that's what we have, right?
I'm saying you're talking about what we need to address. And I think one topic we need to address, Nicola, is the fact that for the time being, and for good reason in the past, we have a framework which is our resolution framework, but we also still have the so-called banking communication, which is a framework by DG Comp, which is setting out under which conditions state aid can be granted to banks. And the unfortunate part of this is the state aid framework is from 2013, so pre-BRRD, that they have different thresholds in, which gets you into a bit an potentially wrong incentive. So if you talk about finishing the job, one thing is we need to address this. I perfectly understand that at the heat of a crisis, you don't touch anything, but now we need to address it. And second, and I think that's what we also see, but let me go back first to my middle class. I think we need to acknowledge that there is a group of banks which finds it incredibly difficult to raise MREL, but nevertheless, you have either banks that can be resolved, and for resolution you need MREL, all banks that can go credibly into insolvency procedure. Then you need less MREL, but then also your destiny is clear. And I think what we can't afford is a group of banks which somehow gives me sometimes in asking the feeling too big to go into insolvency, but too small to go through all the pain of resolution. Here I would make a clear message. I think the banks need to be resolvable. They need to issue MREL. And we've said several times, the market is very accommodative today. So let's go there. But there's also one argument where also we are still working on, and that's you have different ways of resolving a bank. Open bank bail-in is always been the idea. So you would recapitalize and then restructure over time. This is clearly the strategy for the vast majority of the large banks. For mid-sized banks, perhaps asset separation, slicing, dicing, sale of business could be a top discussion. But this is also not risk-free and it's not cost-free. You need to be prepared for this. Otherwise, you come to the point of no return and then you realize it will take you 1.5 years to move on. So this is one topic which we are working on the tools, but also the banks need to make themselves resolvable. Mm-hmm. The second part, and that's the part on really dealing with a topic which I think is probably a good introduction to Thomas. We are constantly referring to the fact that we have a European resolution framework, but the counterfactual to this European resolution framework, or the alternative for less significant, smaller banks, are 21 plus insolvency frameworks. They are partially perhaps not yet fit for purpose. Mm-hmm. They are all national, so member states to deal with. And I think here our constant plea had been for stating that such a resolution framework should be a holistic framework. And I'm not saying that each and every bank needs to be resolved, but I'm saying that we need a administrative bank liquidation framework to avoid the creativity that you are constantly spotting, Nicolas, and to say we should have one, and I would say European framework, kind of FDIC, European style, which has then also administrative bank liquidation powers. And
sorry, I'm not sure I understand. So question for clarification. Are you implying that insolvency of banks should be fully harmonized into an administrative regime, or are you advocating a regime that would sit somewhere between insolvency and resolution?
I would argue for an administrative liquidation regime at European level. I'm realistic. This is not coming within the next 4 weeks or next year.
Yeah, but what I don't understand is, does that come in substitution to the national insolvency regimes, yes, or in complement to them?
For me, it would be a substitution, so that banks would be basically under BRRD, SRMR in different forms. But it's only one idea, and I'm pretty sure that Thomas is even better placed there. My argument is just for the time being, we have a bit the problem that national insolvency procedures are different in different member states, and they allow for quite some, I would call it also creativity in going forward. And I would like to have one European approach for also the liquidation of banks, one efficient, proper approach. I could go on, but I think—
But please don't.
No, I would just like to mention one topic. I think we are hearing so often that we have a fragmentation of our banking market, that a lot is national. We are hearing that you don't see cross-border consolidation and the like. There are a lot of reasons for that, but one reason could also be that we have a fragmented legal system to this extent. And there I would stop.
Thank you so much. I have tons of questions here too. I already couldn't resist asking some, but let's move on to Christian. Christian, we've heard all the good things that have happened. Are the banks happy?
Well, that's a very difficult question to start with, but let me first thank you, Nicolas, and the organizers for inviting me to speak with such a distinguished panel here and distinguished moderator. And I would like to, before getting back to your question at the end, start with 3 quick reflections with my opening statement. What's the current shape of the banking sector? What are the policy measures needed now? And a couple of thoughts on the EU crisis management framework that Elke just referred to. Quickly on the risk situation, Andrea already alluded to that. I would like to add a few aspects and maybe give one or the other additional number. Banks are a play on the economy, and the European economic outlook has continued to improve. IMF expects Europe to go back to pre-crisis level next year, and that is all good news for banks. Furthermore, and Andrea alluded to that, as I said, banks entered the pandemic very well prepared with strong capital and liquidity positions. They had achieved now a 15% CET1 ratio, as Andrea said. That is twice as much as they had before, 10 years ago. Same picture as far as NPLs are concerned. EU NPL ratios peaked about 10 years ago at 7.5%. They are now down to 2.5%. Italy has seen a reduction of 16% in NPLs, down to 4% NPL ratio now. Germany is down to 1.5%, down from over 4%. All that shows the good progress, which was, and Elke and Andrea said that, the result of a very joint effort between policymakers, supervisors, and the industry. Now, let's quickly look at the pandemic, and I would like to take a very quick look there at insolvency rates. In some countries, insolvency rates have been hitting historical lows, and we all know that this has been to some extent artificial. That's the case also for Germany. We all expect insolvency rates to increase, but I would strongly argue much less pronounced and stretched over a much longer period than some observers at the moment suspect. For Germany, we expect insolvency rates to get back to levels that we have seen 4 or 5 years ago, but no more. In Europe, of course, the picture is patchier. I find a good indication for what to expect are the usage of loan moratoria in different countries. In Germany, that is, the usage of loan moratoria is below 1% of total loans. In Europe, on average, that's 3.5%. Some countries are higher than that. Bottom line, I find European banks are well prepared for the COVID-related challenges, and I don't see any challenges or any signs for that to develop into a systemic banking crisis. A big issue is the low level of profitability, but that has been there before COVID. And Andrea said, some observers say the future is rose. I would say there is much to do in order to see a rose future. Very quickly, what are the policy measures needed from my perspective? The COVID-related crisis has not been a banking crisis. Instead, banks have been part of the solution. They have done well in supporting clients with funding and liquidity. And I also must say, I'm pleased to see that there is recognition for that. That banks can fulfill this role also by funding the recovery. That is the challenge ahead. So what we need now are not measures to stabilize banks, but to enable banks to continue to be part of the solution going forward. And let's not make a mistake here. The challenges ahead in that regard are really substantial. Right now, the demand for lending is low, driven by COVID, but all signs are. Look at the growth numbers that I just quoted. Think about inflation, that the demand for credit is going to increase near term. And we need to make sure now that banks are not only part of the solution during the crisis, but part of the solutions funding the recovery, but also funding additional investments when we talk about financing change in terms of sustainability, digitalization. That is a huge challenge, and there are a number of things that I find policymakers could do in order to do that, help banks to fund that. There were a number of measures introduced last year that were temporary. They should be extended. And beyond that, there are a number of other issues. For example, banks are paying 10 billion to the Single Resolution Fund this year. They're paying over 15 billion to the ECB in terms of negative interest rates. These are all examples for capital that is missing to fund the recovery. Furthermore, after the summer, the Commission is going to put a proposal on the table how to implement the missing bits of Basel in Europe. My clear message here is this could hurt the bank's ability to fund the economy. We need to make sure that the impact of the Basel implementation stays below the 10% increase in capital that was envisaged. And the levers to achieve that are on the table. They have to do with mitigating the impact of the output floor, mitigating the impact on unrated corporates lending, as well as operational risks. So as far as my second point, policy measures are concerned, this is not about stabilizing banks, but these measures should be addressed in order to strengthening banks funding the economy.
So to be clear, you advocate a transposition of Basel that would not be necessarily fully compliant given those constraints you add in terms of impact, right?
Well, different reflections here on what is compliant or not compliant. For me, the key message is we need to introduce it in Europe in a way not to harm European competitiveness and not to harm the ability of funds to fund the recovery. If you refer to parallel stack approach, output floor, etc., some people might argue this is not Basel compliant. I would say there are legal opinions on the table which would prove the opposite. Let me conclude quickly with some quick thoughts on crisis management framework. Overall, and I'm putting a European hat on here, we welcome the Commission's objective to further strengthening crisis management for banks. Take into account proportionality on the one hand and subsidiarity on the other hand. What not to do, in my view, is bringing into being a European FDIC, a sort of super authority. And in my point of view, this also includes an FDIC-inspired orderly liquidation tool. The advantages of a US-inspired OLT, in my point of view, are unclear, and I think that the Single Resolution Mechanism regulation already provides for what is needed. Instead, what should be done, in my humble point of view, we should strengthen the existing structure of national deposit protection systems and not give the DGSs a pure paybox function, but give them the tools to implement preventive and alternative measures for non-systematically important banks. And all of this could also well include a European deposit insurance system based on liquidity support between national DGSs, maybe something that Tuomas is going to relate to now. Thank you.
Thank you very much. Tuomas, everybody's putting pressure on you because this panel is about finishing the job of the banking union, and that's what you're in charge of, right?
Yes, thanks, Nicola. I did indeed notice that people were raising expectations about what I would say, and I'm afraid I will not be able to meet those expectations. I tried to be brief, but we can come back to these questions in a discussion. So let me start by saying the obvious. We are a bit stuck with the banking union. We were not able to, the Eurogroup was not able to agree on a work plan in June. And crisis management being part of that package, we are also a bit stuck with that. It's partly because of differing visions of what the banking union should be about. And we already heard a couple of visions in this discussion. It's partly and importantly also because of electoral calendar. Now, the issue related to electoral calendar will go away. And maybe after that, we are in a better position to tackle the differences in political vision. This is what we hope will be the case. I could bore you out of your wits talking about the banking union. I'm not planning to do that. I'll leave that to the discussion. I'll concentrate on giving you on a bird's eye view on what I see the issue with the crisis management framework being about. And so we have a fairly recent crisis management framework, the BRRD framework, negotiated in 2013, 2014, much under the chairmanship of Rimantas, who's sitting in this panel. It was a response to the financial crisis, and it was based on the bail-in principles, the famous 8%, intended to protect taxpayers. It also had a means to provide European funding to protect financial stability without needing to resort to taxpayer money. So that's a theory. So what's the practice? You all know the answer. We have not really been applying the framework. Someone counted that over the last number of years, we have invented around 15 different ways to circumvent our resolution rules. Taxpayer money has remained a key way, or one would say primary way, to deal with ailing banks. And this has much to do with what Elke referred to, the state aid framework that was used instead of the BRD framework. Now, it's fair to say that this circumvention has taken place with national money. No European money has been used to it. So, but clearly, still something is not working. And the question is the framework wrong, or did we just leave too many loopholes? And broadly speaking, member states can be divided in three different camps in the way they answer to this question. One group thinks that the framework is just fine. We just have to apply it. And we have to apply it more broadly. We need to close the loopholes and stick to the 8% bail-in and apply it to just about everyone, except those that are liquidated in national insolvencies. At the other end of the spectrum, there are the countries who think that the 8% rule was misguided in the first place. It ignores the realities of resolution. And instead of extending the regime to a broader set of banks, we should revamp the whole framework to allow much more flexibility and remote ourselves from this religious connection to 8%. And between those two extreme camps, there's a third view that considers that the regime as such is broadly right, but there is a hole in the middle. That we need a third regime, a European insolvency regime with some resolution-like toolbox for mid-sized banks that are too small to meet the public interest assessment and be resolved by the SRB, but on the other hand, too large to be liquidated by national insolvency procedures. Now, not surprisingly, the way countries fall into these three categories has a fairly clear link to the structure of their national banking sectors. Those that think that the framework is right and just needs to be applied tend to be those countries where the market is dominated by large universal banks that can issue subordinated debts, bail-inable debts, and in a way fit the ideal model underlying the BRRD vision. At the other end, those that think that the framework is broken and needs to be fixed to allow more flexibility, these tend to be countries where a large part of the market is served by small regional banks that rely on deposits for their funding. And these banks have difficulties to issue subordinated debts or would have to issue it at a price that would be prohibitive. And when there is trouble in those banks, there's usually very little to bail in. There are large deposits that exceed the protection limits, and there are company working balances that would be the first in line to be hit, with all kinds of unfortunate consequences. And the third group of countries is then somewhere in the middle. I think Germany could be characterized being there in the middle. So deep down, the discussion about what kind of crisis management framework we need boils down to the question of what kind of a banking sector we want for Europe to come. Should the framework be adapted to the existing realities of bank business models? Or should banks rather adapt their business models to the framework, with those that are unable to do so gradually exit the markets? So this is the question to which we will be struggling with in the in the years to come to answer. And I think it's a crucial question that we to some extent need to answer to achieve a stable equilibrium in crisis management. I stop here.
Sorry, I should probably unmute at this point. Thank you so much. That was extremely clear and also succinct. Elke, you told us that for the middle class, you're thinking of using other resolution tools than bail-in. I hear that as meaning for the middle class, we would go for resolution. We would declare a public interest. Is that a change of position of the SRB? Can you elaborate? Did I hear you well?
I don't think that it's a change of position of the SRB. You are referring now to our so-called public interest assessment, but let me perhaps take even one step back and thank you, Thomas, for elaborating the differences between framework, okay, just some holes in the framework or loopholes or the other way. I fully agree, and we need to address the topic. But to Nicola's question, the first question is, what's the middle class? Is a middle class a bank below 100 billion balance sheet? For some markets, this would be more than the entire market. But for me, what I would address it is, it's a bank that's significant in this country, but that is mainly funded or has a liability side out of two components, equity and deposits. And here I think we need to see, of course, equity is the best quality of capital. The disadvantage could just be that equity is gone at the point of failing or likely to fail. So there is no debt component that is still there to be used. And I think we need to address this. These banks need to issue MREL. And the second one is depositors are, by some member states, I get the feeling, considered as someone who is never ever bail-inable, but not every depositor is your grandmother or grandfather having their little savings, and they are anyhow protected by the DGS. Depositors can have various forms. So for us, the main part is for the banks under our remit to address also those banks to make sure that they are resolvable. And now the word is always tricky. Resolvable. Either we come to the conclusion that those banks can go without any risk to financial stability into insolvency procedure, the smaller ones perhaps more the ones under the national authorities, and the others under our remit should be really able to be resolved with our toolbox, mainly I would assume using transfer tools. You might have seen that we have expanded our public interest assessment in saying we are not only looking at idiosyncratic events, we are also looking at system-wide events. And I would expect that this will mean that also the remaining banks under our remit, with some exception, like promotional banks, should be prepared for being resolvable. My comment was only, you can't be neither nor. That would mean you compete with the big boys, but if something goes wrong, the taxpayer takes it all.
That's pretty clear. Andrea, the European Systemic Risk Board, which is separate from the ECB, but kind of hosted by it, published a report not very long ago, a couple of weeks ago, warning about the possibility of a tsunami of NPLs. I use the words as in the report. Is it outdated? Or, I mean, how do we reconcile the difference between that kind of wording from the ESRB and the picture you painted of moderate, a pretty benign risk landscape in at least the way I received it?
I think that the metaphor used by the ESRB was referring to a point on which I agree also in my assessment. So the possibility that you have a sort of, widening of the beach in a sense, so the water retiring, before having the water coming back to levels that were higher than before. So this effect is there in my view. So the fact that it is likely that once the support measures are withdrawn, there will be an increase in NPLs. What we see is that moratoria are being closed in many member states. We see that there is an uptick in the stage 2 classification, an uptick also in NPLs. Nothing major, to be honest, but of course the real evidence will be there only when layoff bans, furlough schemes, direct support to corporates and SMEs will be withdrawn. So that's the moment where you will see how much the NPL. I mean, I think that it's difficult to go either way. Either with the, I see our assessment is that the really important surge in NPLs that we were estimating in the summer last year, we view this now as less likely because the baseline scenario has improved and the adverse scenario has come closer to the baseline scenario. So we think that these type of figures are much less likely right now. But where the final dial in terms of the levels will be is something that will depend very much on how long and the support measures will stay in place. So it's very difficult to predict. So I try to take now the stance as a supervisor that I prefer not to put my reputation down there saying the industry is wrong, I have a better figure. I don't, honestly. What I do is invite the industry to more caution and say that this is the moment to strengthen the credit risk controls, because actually the picture could be worse than they currently expect. So that's where we stand right now.
You mentioned the expiration of moratoria, and if I'm correct, that's been the case in pretty much all member states, with the exception of Italy. That's or maybe I'm wrong, and please correct me in that case. I was very concerned about that, to be honest, and I've been surprised that there hasn't been more indication of credit trouble with the expiration of moratoria. What for you have been the lessons there more specifically, and was the observed outcome or behavior in line with your initial expectations?
No, I must confess, I'm completely aligned with you. We indeed expected that the expiration of moratoria would have been accompanied by a stronger increase in NPLs. I mean, our models are also backward-looking, so they predicted this on the basis of past experience, and the provisions were that there would have been a higher increase in NPLs. But this crisis is specific. I mean, not only because it has been the harshest recession in peacetime Europe, it has also been the largest and wider set of support measures that have ever been deployed in Europe. So it's clear that these support measures have been very wide. So if you have the government supporting directly the counterparts not to go insolvent, of course, let's say even if the moratoria expire, let's say the quality of the counterparts remain pretty good. I mean, there is an interesting. I mean, this is a bit for geeks, but there is an interesting point that caught our attention recently. We did a deep dive on the accommodation and food services sector. In terms, I mean, one of the sectors most hit by the crisis. One thing that surprised us is to see that the probabilities of default estimated by the banks went down for most banks. So you expect, I mean, all the literature tell you that, the internal models of banks are pro-cyclical, you have a recession, the probabilities of default increase, and therefore you have higher capital requirements calculated in the moment in which the recession hit. It's totally the opposite. RWAs are going down and the PDs are going down. And this is, I mean, we are digging down into that, but to a large extent is explained only, I mean, the only explanation we can find so far is the fact that the counterparts are actually directly supported by government support measures, and therefore the banks are estimating that their probabilities that they will default on this facility will be lower. So irrespective of the guarantees, no, because the guarantees of course go on the LGD parameters. So this I think is the odd situation of this crisis, which makes it difficult also for us to have a clear figure. So for us, again, I repeat it again, but the key point is banks, do your homework in terms of trying to look through the support measures and distinguish what are viable customers from unviable customers. That's the main challenge for the banks right now, and what we push them to do quite carefully.
I guess we're all geeks here, so this is really fascinating. Christian, there's a question from Sebastian Mack in the chat. So he's at the Law Center in Berlin, and it's a question for you. There's a recent position of the joint position of the Italian Banking Association and the German Banking Association in February 2021, calling for freezing of the NPL backstop regulation that is asking banks to adequately and progressively provision loans turning non-performing, which is pretty much an echo of what Andrea just talked about. Against this backdrop, I mean, how do you intend to ensure that banks address NPL problems early on, as Andrea reminded us and as repeatedly requested by the Commission, the ECB, the EBA, other authorities? So basically, what about banking associations promoting zombification here? This is my words, not Sebastian's. He says, don't you share the fears that procrastination in loan loss recognition is hampering the recovery and ultimately endangering the viability of banks themselves?
Three aspects quickly. I gave before some numbers on the progress that Europe made in terms of NPLs in the last 10 years. Enormous progress. That tells me we do not need a lot of change to the framework we are currently operating in, because with what is currently in place, we have achieved great progress. Second point here, the issue by tightening that further, that is medicine that you administer to banks in all member states. Germany being down to an NPL ratio of around about 1%. To administer further medicine has side effects, and I think that is detrimental. One side effect here is that you're pushing banks out of the secondary market for NPLs. And Andrea highlighted the risks that you see in the non-bank financial sector right now. I would strongly argue that through a tightening of the NPL rules, the one thing that you do not want to do is to force banks, for example, German banks, out of the NPL market, trying to be part of the NPL solution in some other countries.
Sorry. Let me stop you here, because I want to make sure I get that right. Are you saying that the fact that banks are incentivized to sell their NPLs to the market is a bad thing?
I'm telling you the fact that banks are prevented from acquiring NPLs is a bad thing, because banks should always be, especially international wholesale banks, they should be in the business of solving NPL problems of other institutions, and you should not leave that to a less you should not leave that to a less regulated.
Why should they be in this business? Just there's a point in the argument that I don't get.
Because you want to solve NPL problems in some countries, and banks in other countries can play a very important role in solving these issues.
Why does it have to be banks?
It does not have to be only banks, but banks should be able to participate in that. And through sharpening the regulation for banks and not really taking a stronger focus on the non-bank sector, you're excluding a very important part of the market segment from being part of the solution here.
But isn't it just that they are imposing requirements on banks in terms of risk management that don't apply to other players which are less leveraged and don't benefit from deposit insurance?
These are also imposing rules in terms of capital requirements, early provisioning, etc. If you really look at the proposals on the table, I can tell you effectively it would prevent banks being part of the secondary market in NPLs. And in part also, and that's also very important here, it will force banks to sell NPLs. And that means that the workout no longer takes place within an existing client relationship. In many cases, very well established. The workout suddenly has to take place in a non-bank financial investor relationship. That's also not very constructive in some instances. So that is why German and Italian banks coming from different positions here, but we come to very similar conclusions. And that is why we were raising the hand earlier this year. One last aspect really to look here at is where are the difference between the ECB approach, the Commission approach, that should really be aligned. It would be detrimental for the industry if legislative and supervisory actions are not really following the same rules here.
Thanks, very clear. We don't have the Commission on this panel, but we do have the ECB. So Andrea, let me get back to you on this, and also on the broader question of the NPL market and the role of banks versus non-banks in that context.
I mean, let's say the point that Christian is raising, I can see some issues for some banks, and there are a few, I think a handful actually in Europe, that have specialized models in being acquirers of non-performing loans, and they do raise deposits. I don't understand why an operator which specializes in this segment would need to raise deposits. I would prefer this not to be the case, but it's clear that the calendar provisioning is affecting negatively banks with these business models. As far as banks are concerned, I mean, I don't think, I mean, there is always this argument that the calendar provisioning pushes with the prudential backstop or our own requirement pushes bank to sell assets. Actually, I mean, the banks can very well, you know, take care or write down gradually the assets. If they think that these assets have a good recovery possibility, they can hold the assets and they can eventually regain the value increase at a later stage. I mean, the point is that during the crisis, we have seen banks that had assets that were non-performing since 15, 20 years, and they still were carried with a book value which was, let's say, excessively high. So I think that in terms of fastening, you know, the process of cleaning the bank's balance sheets, calendar provisioning has been a very, very important innovation in our supervisory and legal framework, and I would strongly advise not to touch it. Actually, we set it in place to avoid a pile-up of NPLs in the next crisis. It would be very unfortunate if once you may start be entering into the next crisis, you remove the rules that you set exactly to avoid that.
So how do you look more generally at this market for troubled assets in Europe? I mean, I look at it a bit remotely and I see a lot of transactions, which we didn't see like 10 years ago. Are you satisfied with the development of the market for NPLs, or do you think it's still problematic in terms of the structure, you know, number of potential buyers, things like that? There are many different points of view here. So what's your kind of holistic assessment?
Is it for me,
it is,
Nicolas? Yeah, well, I mean, I must say that the market has improved significantly in terms of both efficiency, liquidity, the amount of transactions that it has been able to process. There have been new players entering the market. So I think there has been significant improvements. Recently, we have had legislation approved that should also, you know, tweak even further and support even further the development of this market. There are important proposals on the table, which I don't know at which stage they are, but also on securitization of non-performing loans, which has been another important tool. So all in all, I'm quite pleased with the way in which the market is working. The point, I mean, you know that point, I've made it several times. The point on which I'm still a bit concerned is that when you do have really massive amount of NPLs, that's the point in which some form of public support is helpful to have the issue dealt with faster rather than slowly. And this has happened through asset management companies, has happened through guaranteed securitization schemes in Italy, GACS, Hercules in Greece, very effective, all of them. what concerns me is that, again, you have a tool which is tools which are still very national in terms of characteristics, and these to some extent might impair the level playing field within the banking union. So I would like to have a little bit more, common features on the way in which these systems are funded, guaranteed, and so that the bank, whatever the flag it has on its headquarters, can access to the same level of support when it needs to deal with these type of issues. But for the rest, I'm pretty pleased with the progress. I mean, the recent developments in Greece are to be praised, to be honest. In the middle of the pandemic, the most massive securitization of NPLs on record in that country. So it was very, very significant.
Thank you very much, and thanks also to Sebastian Mack for the question. I encourage others in the audience to put questions into the chat, as Sebastian did, or raise their hands, because, as I said already several times, I have questions, but the questions from the audience are probably better. But I do have a question to Thomas. You've mentioned, maybe that's too dramatic a word, but the collapse of discussions on banking union. You said we're a bit stuck. I guess there's a whole herd of elephants in that room, but one of the elephants is something we didn't discuss yet so far today, which is the question of concentrated domestic sovereign exposures of banks, and that's being reported in the media again and again and again as part of the debate and part of why so little progress has been made in the last 5 years. So can you give us a sense of what are the options, what are the discussions, a bit like you did very helpfully on crisis management framework, but on this other piece of the jigsaw?
Right. So indeed, it's an elephant in the room, and being an elephant, I need to be a bit careful how I speak about it. I don't want to scare an elephant in a china shop. The thing here is, I mean, the first thing to note is that the stakes have been going up on this one. I mean, you can look at this from two angles. One angle is that with the public debt ratios going up, you should be careful about doing anything that might destabilize the balance that is sort of there in the public debt markets and showing up in a fairly and very high level, low level of interest rates. On the other side, I mean, you can make the complete opposite argument that precisely because the debt levels are so high and concentrations are getting higher, this is precisely because why we need to tackle that now. Now, one thing I would say is that no one is looking for anything punitive, and I don't think anyone is suspecting anyone sort of wanting anything punitive, anything that would destabilize the markets. But the problem is that there is the concern that even the slightest, the most benign measure might be seen as opening a Pandora's box and creating escalating expectations, which down the road would then lead to instability. And that's why some are very hesitant to open this debate at all. So there is a range of options that we could put on a table with. I mean, you could start with just from information, better collection of information, which right now is not readily available. Just for monitoring purposes, you could think of Pillar 2 measures that could give the supervisors.
So just to be clear on this, sorry for interruption. You don't think the numbers in the EBA disclosure exercises are good enough, or do you mean that the scope of banks which report this kind of numbers should be broader?
Well, I mean, the numbers are there, but then there's a question of what are the exact policies that supervisors are applying. I mean, this kind of information as well. I mean, the supervisors already have the authority to tackle these things under Pillar 2, and to some extent they are, but we don't really know to what extent. There are no definitions of what constitutes an excessive concentration and things, these kind of things. But you could be more precise in Pillar 2, and then there's of course Pillar 1, which is the most sensitive of all. I mean, you could have concentration charges. You could have either non-risk-based or risk-based concentration charges, and these are, I guess, I mean, even here, it is partly a question of calibration. You could calibrate those concentration charges in a manner that would lead to very little real effects, but the principal step would be very large because I mean then after that it would not be a question of principle, it would just be question of calibration and numbers, and we would have crossed the Rubicon from the viewpoint of some. So this is something that is quite sensitive. My final point. There are also the question of there's also the question of small markets, small issuers, and which kind of are reliant on domestic banking sectors by definition. And then there's the question of non-euro area countries, which have their own challenges and are quite wary of not becoming collateral damage to something that is fundamentally a euro area issue.
Yeah, I agree strongly on the last point, but this is not about my opinions. I have to say, however, that I did cross the Rubicon once in Italy, and it's a really tiny river. So the question here is whether we don't have a new context, because there's next generation EU, now we have EU bonds, it's becoming a feature of the market, and I know that the legal basis and policy intent is that this is a one-off, completely temporary, but the market is seeing it as a new reality. And indeed, Gert-Jan Koopman, who is in the business of issuing those bonds, remarked in a recent Bruegel event that this is basically the new landscape and the new normal in the market. So he didn't make that point, but the kind of point that I inferred from that is that if it disappears from the landscape, then that's probably a destabilizing event. So given that there is this new reality of EU bonds, I mean, in principle, you could make an argument that this completely changes the debate on concentrated sovereign exposures, and that we're in a new era where there's an asset of reference and all the rest is kind of something that complements the portfolio. Do you see that change of perspective in the discussions, or do the discussions on regulatory treatment of sovereign exposures continue as if next generation EU was not happening?
I mean, the argument that you just made is occasionally made, but I don't think the discussion, the landscape has changed materially. I mean, there have been safe bonds. There have been bonds issued by the EIB. There's have been bonds issued by the EFSF and EFSM, the ESM as well. So next generation EU, of course, implies quite a chunk more of those. But I mean, in reality, I don't think. I mean, honestly, the issue that we are facing here is not the availability of safe assets. It's more about what you do with these safe assets and how permanent this is and how you use the proceedings. So, I mean, the short answer is that regarding this particular question, the next generation EU in the end changed very little, if anything.
So, Andrea, let me put you on the spot again. Thomas referred to Pillar 2 and the fact that we don't know much about how supervisors use Pillar 2 to decrease potentially dangerous concentrations of domestic sovereign exposures. Can you tell us more about that?
Well, of course, we look into sovereign exposures. We look into concentration of sovereign exposures. We include also widening of spreads in the scenario of the stress test, for instance, that we are going to report on in a few weeks. So there is an attention on sovereign exposures under Pillar 2, amongst other risks. But to be honest, let's say I find it a bit difficult. I mean, we cannot solve a problem which has such a hot political content via the back door of Pillar 2. I mean, we are ourselves in legislation asking banks to hold basically in treasuries more than 100% of their capital. So concentration on sovereigns is there basically in the legislation. And if you want to force the banks to diversify, I think that one of the tools that you should have pushed forward should have been something like the SBs, so the possibility of the European safe bonds. I can't remember what did it stand from. But so to have sort of baskets of European bonds that would enable, in any case, member states to to place their liabilities in that basket. The reason why the whole debate is becoming so difficult and the SBs has been pushed back as a proposal by member states is that, we might like it or not, maybe I'm not very fair in saying that openly, but public debt managers love to call their banks and to, when they have auctions, and to make sure that they are there when there is a difficult option. And this is of course particularly true for banks which have a high level of debt, but is true more broadly in a sense. So if we want to break this, I think that we need to have a honest, assumption of responsibility also from public debt managers, accepting that there is something which is more European in that space, and then you can more openly, I think, discuss this issue of the concentration of sovereign exposures.
My own observation, based completely on limited experience, is that what you said, public debt managers love to call their banks, is indeed universal and is not correlated to the level of debt. What may be correlated to the level of debt is the influence of public debt managers on the government's position, but that's a separate link in the chain. Rimantas, let me turn back to you, and since we're getting close to the end of this panel, maybe give you the concluding word, because you're in the business of assessment. So did this panel give you ideas for future things to look at?
To be very frank, no, because the landscape looks really very diverse, and we should give ourselves the account that going through this minefield, it only looks calm. It only looks calm. I think everybody who participated in the panel just gave support to this idea. This is really a minefield. We should be prepared. We should be prepared. On the other hand, of course, I was happy to hear that the work is going on. Of course, Thomas rightly noted that there are still hurdles which are unfortunate in the Council and in the Eurogroup. We all were expecting to have something by the June summit. Still some time to wait. What I would wish, on one hand, to avoid that again the work on say developments of existing banking union pillars and the work on this third, not completely built, would not be stimulated by the events like it was with single resolution mechanism in 2013, where just it was extraordinary situation for the policymakers to take decision. On the other hand, I can see really the space for auditors to look into the developments as they happen, more or less after they happened, to ensure better transparency, because I think this transparency and knowing what is happening where would be the biggest, the most valuable asset for entire society, not only separate sectors in the economy like banking, non-banking, but for the entire society, including politicians who should be aware and I understand our auditees not always will be happy with our conclusions, but I think we should give account to ourselves that we are still in this quite dangerous, although visibly calm period. So I see our auditors' role in this. So this is how I could summarize the discussion from Court of Auditors' perspective.
Thank you so much for that. And I see a last question, which is again from Sebastian Mack, and I think it gives us an opportunity to conclude in a crisp way. So Sebastian is referring to the temporary framework for state aid, which allows precautionary recapitalization without burden sharing, which is, of course, in exception of the normal rules of BRD, in which precautionary recapitalization does entail burden sharing under the bank communication. So Sebastian suggests this question for Elke, but let me actually ask it to all three policymakers, so Elke, Andrea, and Tuomas on this panel. And I would like you to respond just with yes or no, without any explanation, because we're at the end of our time. Is it time to withdraw the temporary state aid framework? Yes or no? Elke?
A clear yes.
Andrea? You're muted, but your body language says yes.
Yes.
Tuomas?
If we are talking about the 2013 banking communication,
no,
the broader temporary framework for state aid, I think this would be a bit premature to withdraw, given the situation with variants still going on. But as it comes to the banks, I think there is a need to reconsider the state aid framework.
Okay, on that, thanks very much to all panelists. Thanks very much to the European Court of Auditors for convening this in general in the public interest, and also for inviting me to participate. And back to you, Mihails.
Thank you. Thank you very much, Nicola. Really exciting session, I think, for all of us. We had over 150 participants on Microsoft Teams and YouTube, so I think the message is well spread. I am also very happy to see that this panel was really complementary and not overlapping, as we feared to some extent with the first session. But I see clear complementarity in a way that we have clearly identified in your session that, first of all, there are some measures that the implementation of which is still ongoing and the deadlines are not yet there. But on the other hand, I also heard interesting ideas whether we should adjust the sector to the system or the system to the sector. This was, I think, really important. I think to adjust the sector to the system is quite difficult, to say the least. So probably it's more about adjusting the system as we learn and as we go forward. So I really would like to thank all of you, Nicola, and our distinguished panelists. Very glad that you joined us, and happy to continue our cooperation in other dimensions, other fora. Thank you very much. Now I close this session. I just wanted to remind everyone that we still have one very interesting session to go that would start at 3:30 p.m. This session would be moderated by Maria de Merces, Deputy Director from Bruegel, and among panelists we will see Rimante Sagius, member of the court, Mr. Martin Verwey, Director General of DG ECFIN, the European Commission, Dr. Jörg Kukis, State Secretary from the German Finance Ministry, Mr. Martin Kazaks, Governor of Central Bank of Latvia, and also Mr. Rick Watson, Managing Director from AFME. We will address in this session the capacity, the ability of the financial sector to support the economic growth, both banking sector, but rather probably non-banking financial sector, whereby also the European Court of Auditors has recently contributed with a report on a capital markets union. So I will stop here. You may use the same link to connect in virtually half an hour to the third panel of this conference. Thank you very much, and looking forward to see all of you and more in half an hour time. Thank you. In financing the economic recovery. Before we start, I give the floor to Commissioner, I would like to give a couple of housekeeping remarks very briefly. First of all, for all participants, please keep your camera and microphone off all the time. We will have a question and answer session. In fact, you can post a comment or a question all the time using a Microsoft chat function. You can also there ask or indicate that you would like to speak so that then you would be able to ask your question live, which is also a nice option to make the event more interactive. Just to remind you also that the conference is being recorded and that later it will be put on the homepage of the European Court of Auditors. So these are the housekeeping remarks I would like to make. Now really I'm very honored to have Commissioner McGuinness with us to give a keynote address ahead of our last session. Really thank you very much for accepting our invitation to share your views. I know you are very busy because almost every week the Commission publishes very interesting proposals in the field of financial markets, financial governance. But that's why I appreciate even more that you were able to join and to share your views. So Commissioner McGuinness, the floor is yours, please.
Well, thank you very much. And indeed, I'm honored because I really appreciate being invited to contribute to this really important conference on a subject which is very close to our hearts and which is absolutely essential. So first of all, a big thank you for that. I said that this project is close to our hearts and our ambitions. And I think the CMU, this Capital Markets Union, is really much more important now in the context of the recovery from COVID-19 and also as we look to build a more sustainable economy and society. And, you know, the Commission is determined to continue acting in the direction of building a CMU. But I would say that building a European Union, Capital Markets Union, is something that we here in the Commission cannot do alone. We need support from member states, as well as the other institutions and bodies, including the Court of Auditors. And if you look at what a genuine CMU with all of its benefits for financing the EU economy will do, then we really should all work in the direction of making sure that we achieve the highest ambitions we have in this regard. But it does require all of us to shoulder our responsibilities. And you know, my experience is that everyone is very ambitious for a strong CMU. And I expect that's the message from today's very important event. But honestly, sometimes ambition is not enough. You need ambition. It is hugely important, but it has to be backed by concrete actions to deliver this CMU. The member states and the European Parliament are part of this important process, and they need to match the words of support for the Capital Markets Union with tangible action, particularly when legislative proposals are tabled by the Commission. And if we reflect on the times we live in, these past year and a half have not been easy for anyone because we faced this global pandemic. It has put huge strain on our society and our economy, and of course our public health systems also. We are beginning to see some light at the end of this tunnel, and we're talking about and looking forward towards a post-pandemic Europe. Of course, we still are cautious about new variants. But with our focus on economic recovery, we're also thinking about and preparing for the European Union that we want for the future. And as we rebuild, we have a chance to address problems that the pandemic has exposed. For example, I think we've seen very clearly that our economies and societies are not sufficiently resilient. If we were, COVID-19 would not have had such a tragic impact in terms of human life and illness, as well as the significant economic impacts that it has had on our economies and businesses. And we've also been reminded in a very stark way that we cannot ignore the natural world and our impact on it, and indeed its impact on us. Before the pandemic, I think we were beginning to get real about climate change and environmental degradation. We know that we need to build a more sustainable, greener world. Again, during the pandemic, we've seen the role of technology. It's been crucial in allowing us keep connected and allowing us to continue in business and personal transactions. Indeed, the pace of digitalization has accelerated. If we look to capital markets and the role that they can play in building a more resilient, sustainable and digital economy, I mean, there's a few points here. We need resilient capital markets to support the recovery and to build strong, job-rich economies. We need well-integrated capital markets to ease financing for the transition to a sustainable economy. And we need deep capital markets to fund innovation and ensure that we remain competitive in the digital era. And that's why the Capital Markets Union, as I said earlier, is more important now than ever. Let me look back a little in history. We started with the first CMU action plan in 2015. And while it's still too early to give a full account of its impact, as many of the measures in that plan were enacted relatively recently, and we don't have useful statistics immediately to hand, we do from our new CMO indicators know that EU capital markets have actually started to undergo structural change for the better. So, for example, European companies gradually increased their use of capital market funding. Corporate bonds have become an established funding tool for larger businesses. And this has freed up the lending capacity for SMEs at banks. And of course, banks remain the main source of funding for our SMEs. But equally, SMEs have also been able to rely more on alternative sources of funding, even if we are starting from a very low base. In particular, SME equity growth markets versus specialized in trading SME stocks, they've started to expand in the European Union, and the provision of venture capital has increased. But also, and let me be very frank, progress has been too slow. And that's why we have, if you like, tried to re-energize this discussion and action with our new plan in last September. And with that action plan of last September, we have a number of objectives. Firstly, to give European companies more funding opportunities so that they're less reliant on bank funding, so more diversity. Secondly, to make the European Union an even safer place for citizens to save and invest for the long term. A small investor base inhibits the capacity of EU capital markets to offer the funding that European companies need, especially in smaller member states. And indeed, many people who have been working through the pandemic have been saving a lot of money, but in banks, not earning much, and we need to try and unlock the potential of those savings. And thirdly, we want to integrate national capital markets into a genuine single market. And there are a number of deep-rooted obstacles in the way of this particular goal. And I'll mention withholding tax and insolvency laws. Really difficult issues that have to be tackled, but I'm very determined to do so. And later this year, we have a number of important proposals coming up arising from the action plan to develop the CMU. We'll review insurance rules so that insurance companies have more incentives to invest long-term. We will also review the framework of European long-term investment funds to support that very topic of long-term investments. We will review transparency rules in trading and set up a consolidated tape for investors. And we will work for a single access point, a European single access point, making it easier for companies to attract investors. And the single access point will provide investors with seamless access to company information across the European Union. And I think a really important point is that this access point will not just cover financial information, which is clearly really important, but also sustainability related information. And these two for the future go hand in hand. So developing our capital markets union will serve this broader purpose and objectives of helping investors that want to invest in green to identify clearly those investment opportunities, and in so doing contribute to the transition towards a more sustainable economy. And of course, that transition is essential, and capital markets will play a vital role in that objective. We need the financial system to play this part, to play a key role in building a more sustainable Europe, and in that way achieve the objectives set in the European Green Deal and climate neutrality targets. And we also want this transition to be fair, orderly, and of course, just right across society. Indeed, just this week, the Commission adopted a strategy for financing the transition towards a more sustainable economy. We also have proposed a European Green Bond Standard. And maybe first I'll deal briefly with the strategy based on 4 pillars: transition, inclusiveness, resilience, and the global perspective. And this transition will help the European economy transition towards sustainability. We need to support better and in a more coordinated way the intermediate steps. So we have green economic activities today, hugely important, but equally important is getting capital flowing towards those companies and activities that want to transition towards sustainability. We are looking at an intermediate taxonomy to complement the green taxonomy, and this would allow us to possibly develop transition bonds. The strategy will also build a more inclusive sustainable finance framework. And that means bringing along SMEs and indeed retail investors. So here we're exploring the approach to green mortgages and green loans. And we are also looking at social investments going beyond the climate discussion. But it is very true, and my task here in the Commission is to address stability, financial stability. And the truth is that climate change is a financial stability risk. So the strategy looks at how to improve the resilience of the financial sector itself and how it can contribute to sustainability. Because a financial system that fails to take account of the impact of climate change and environmental degradation will not be able to support the transition with strong financial flows. And finally, but a key part of our strategy is looking at the global picture, making sure that international work is both coherent and ambitious. And as you know, the European Union is a leader in sustainable finance, and we want more companies to come on, or countries rather, to come on board with us. And we're looking forward, for example, to COP26 this November in Glasgow, when climate finance will be top of the agenda. And of course, the truth is Europe alone, if we achieve all our ambitious targets, will not be enough if the rest of the world is not moving in a similar direction. Briefly, I want to mention the European Green Bond Standard. Again, in this area of green bonds, the European Union leads the way. About half of global issuance of last year took place in the European Union, and about half of green bonds are denominated in euros, making it the most popular currency for green bonds. This European Green Bond Standard will set a gold standard in the green bond market, helping companies and public authorities use green bonds to raise funds on capital markets while meeting the tough sustainability requirements of the EU taxonomy and protecting investors against greenwashing. This is a voluntary standard, signalling that a green bond meets strict environmental criteria. So together with the strategy and the green bond standard, this will ensure that the European Union remains the world leader on sustainable finance and will help bring the rest of the world with us because, as I've said, we cannot act alone. A global effort is essential in order for us to achieve those targets. We can, with all of these and other developments, move towards a green capital markets union with our sustainable finance and our CMU agenda, working together to direct investment towards innovation and the transition to carbon neutrality across the European Union. So in conclusion, strong European capital markets are essential as we look towards the recovery and building a resilient digital and green Europe. We in the Commission will continue to work hard to complete the Capital Markets Union. We very much look forward to the discussions during your conference and hearing ideas about how we can achieve our goals. Achieving our ambition on developing a Capital Markets Union is similar to achieving our ambition on climate. Both require collective action and sustained effort. And furthermore, our climate targets need capital, and a strong CMU can deliver that. Thank you.
Thank you very much, Commissioner. I was really excited to listen to what you had to say because it also tallies very well with what we discussed in the first sessions of the conference. We mentioned also Next Generation EU, which is a good sign of kind of more risk sharing that has finally become a reality in the European Union that might help in moving forward with some more difficult, parts of the agenda reform in terms of banking union and crisis management framework. But also, what we also need is a very solid financial market, because without this, the reform agenda would not go forward, and the economic recovery would not be adequately supported. And therefore, really, you outlined a very ambitious list of tasks that you have already delivered upon and that are still in front of you. And I think during the panel, our speakers would certainly delve deeper in some of the elements of what you have mentioned. So, Commissioner, again, thank you very much. And I know you have a very busy agenda. Some of your collaborators would probably stay with us and have a nice continuation of the day, and hope to see you in the future in our events.
Thank you very much, and have a very good discussion.
Thank you, Commissioner, again. Now it's time for me to give a baton to Maria de Mercis from Bruegel, Deputy Director of Bruegel, who has kindly agreed to moderate this interesting session. Really, the previous session was moderated by Nicolas Veron, whom you know very well, and I think it was a success. So I'm sure that your panel would be at least as exciting as the previous one, but maybe even more so. So please, Maria, the floor is yours to introduce the panelists and to manage your panel.
Wonderful, Mikhail. Thank you so much for including me in the conference and on a topic that I actually think is a very, very important topic. When we first started the conversation on banking union, capital markets union, the motivation for wanting to go in this direction was very much one of financial stability, financial diversification. That was the original motivation that generated the beginning of the discussion on capital markets union. I would like to resonate some of the facts that also the Commissioner raised and add to the urgency of making some progress with CMU. There is the future of productivity, the future of growth that is going to rely a lot on the digital agenda, on digital growth, on intangible capital, and the knowledge economy, which is the future, relies a lot on risky capital. Banks are not very well suited to finance the knowledge economy. And Europe is a bank finance system, and therefore one draws the conclusion that Europe is nowhere prepared to finance the next wave of innovation. Markets need to do this. And that is one, in my view, one element that adds to the urgency of actually making progress there. And actually, there is new evidence that is coming out that is telling us that the companies that rely a lot more on capital in the markets rather than on banks can actually do better in terms of advancing green objectives as well. So that squares very nicely with broader incentive, the broader agenda of the European Union. So I am really delighted to be here, and I can only add to the urgency of how important it is to talk about all the efforts to diversify the EU financial sector. And I have what I can only call a stellar panel to discuss this with. We're going to take introductory comments from my panelists, and then hopefully we will have a conversation between us and with the audience. So let me take perhaps 2 minutes to briefly introduce the panelists before I give the floor to them. I start with our host, Rimanda Sadjus, who is a member of the ECA, Martin Vevre, who is the Director General of DG ECFIN and Financial Affairs at the European Commission, Dr. Jörg Kukis, who is the State Secretary of the German Federal Ministry of Finance, Mr. Martin Kazaks, the Governor of the Central Bank of Latvia, and Mr. Rick Watson, who is Managing Director and Head of Capital Markets at the Members Events and Association FME. Let me then go back to start with my host, if ik possibly could. So Rimantas, you from the ECA, you have recently done an audit of the CMU, and what was your main conclusions coming from this exercise in terms of the ambitions and the objectives, and dare I say the achievements of the CMU agenda?
Thank you, Maria. Thank you. Thank you. Really, after the introductions, which were to note the importance of this project of Capital Markets Union, both importance of the project per se, but also importance of capital markets. I can say that, of course, the Court of Auditors undertook a risky thing to audit this flagship project, as it was understood in the European Union. I can share with you my impression. Sorry if this will a bit destroy your good mood, but probably, well, afterwards we will be able to look with more optimism into the future. What I shall say that my personal impression is that although the two slogans, banking union and full banking union, complete banking union, and true capital markets union, although these two notions go always together, there is a big difference between them. If I would say about banking union, very many people have very distinct opinions. It is quite clear what shall be done in different directions, but of course there are obstacles, there are decision-making procedures. I think about Capital Markets Union, very many people have very general understanding, absolutely, without looking concretely into the detail. And this is what Court of Auditors try to undertake, to look into the details, nitty-gritty of this big project. And I should say the picture is not rosy, absolutely not rosy. To start with, the first issue was what was amazing to me. Capital Markets Union, there is not simply financing issue. This is free movement of capital. And the first report in the European Union was issued. It was called Segre report. It was 1966. That outlined the need of free movement of capital. Then the first communication from the Commission on building Capital Markets Union, on trying to unite capital markets, it was issued in 1996. So it is a quarter of a century ago. 2015 was another attempt to do something, to put something into one plan. When we generalized our impressions, we said this by the title of our report, which sounds Capital Markets Union, Slow Start Towards an Ambitious Goal. So ambitious goal is still there. Start was slow. And here probably for the further discussion, we should keep in mind one issue, one important issue that is also frequently forgotten. What is and should be the role of the public sector in that? It is not true that European Union from NGEU or from some greening initiatives, common agricultural policy will pour money into capital markets so that they become more vivid and they're more active. Not at all. The role of the public sector is to play a role of catalyzer, of catalyst. For the processes of movement of capital in the private sector, because capital, what we are talking about, we need private capital to foster economic development. And the action of the public sector is quite limited. This is legislation, but also some non-legislative activities that should be shown by public actors. Legislation that we analyzed, unfortunately, did not have effect for, again, two reasons. One reason that Commissioner very properly raised is it's too early to assess. On the other hand, we found examples where, say, legislation designed to foster capital markets just was putting an additional label to some instruments that were already in the market, like EUSEF, EUVECA, which didn't have a noticeable effect at all, and probably will not have, let's be absolutely frank with us. So catalytic effects that we tried to find, was quite modest, to put it so mildly. Another issue that should be seen is that Capital Markets Union can be learned from different perspectives. And a very well-known high-level task force headed by Thomas Wieser, they looked from the point of view of retail investors, which is important, which is absolutely justified, how to mobilize retail investors with their small capital to join together the forces so that this machine would work. Our view was from another perspective, I think equally important, if not more important. Small enterprises, small innovative enterprises, whether all these legislative initiatives taking place before 2015 and after 2015, whether they improved their access to non-bank finance, be it bonds, which is loan again, or equity financing that we badly need in Europe, that is so underdeveloped in comparison with the other side of the globe, for example. So we looked at this and we saw, we looked also at the geography of capital markets. The simple idea is if we want to build capital markets union, genuine or whatever, we should understand that we are building from the blocks, from 27, at that time 28, now 27 different blocks. And when you look at the geography of capital markets in the European Union, it is so diverse, so diverse. In Western and Northern parts, it is no problem to talk to people about pension savings, for example. They understand that it is needed. Whereas in the eastern part of Europe, there is ongoing nationalization of the second pillar of pension reform, even second pillar of pension reform. So in terms of depth of the markets, huge differences. And of course, if we want to put this into one building, we didn't have an idea that all capital markets in all member states should be made the same. So we don't need 27 or whatever number of big exchanges. Not at all. Not at all. The less exchanges, the better. And this is what science, economic science, tells us. But what we really need, we need at least minimal tool set in each of the member states, which are very legally, but even culturally different between each other. So how to achieve this? How to achieve that the quite common instruments that are existent and almost everybody knows from school years in the Western Europe, that people would start to understand what it is and that it is really needed for, say, for equity financing in the eastern parts of Europe, that is very clear parts of the European Union. We saw good experience of the European Commission, and there is a structural reform support service there that is now transformed in the new financial perspective into DG reform. It is a really very important part of the Commission's services that is responsible for fostering structural reforms in the member states. What we saw that in the capital markets area, they don't agree to take proactive position. By the way, when we discussed our audit report, they refused to accept fully our recommendation. And our recommendation sounded that the European Commission, as an administrative body, should take proactive approach to developing or fostering or helping to develop capital markets in the member states that lack depth and that really need this instrumentarium. We recommended to have a strategic approach in this area. I insist on that, and I think I got also support of the European Council of the EU, where this report was presented. So indeed, some proactive position from the Commission is needed, the more so that at the Commission there are instruments how to measure the gaps of the local capital markets with the, say, minimum standard that we would wish to have. So I think this was, along with other typical findings that nobody objects, that everybody agrees, that there should be prioritization of the tasks in the Capital Markets Union plan. There should be indicators that we have to follow how this develops, not only by declaration, but in fact measuring things that can be measured. And the private sector, private associations, they are doing that. They are measuring from the left to the right, from depth to height, all the capital markets. So this can be done. There are positive examples, and I want to raise one to show one example that we also mentioned in our report. We always talk about cross-border barriers. One of the barriers is, as Commissioner also noted, legal barriers. So different legislation in the member states. There was a very good initiative in the Baltic countries. It was initiated by European Bank of Reconstruction and Development plus European Commission, technical assistance, there is catalytic effect, to issue in a coherent way the legislation on covered bonds. It was done in 3 Baltic states in parallel. So legislation is different formally in the different 3 member states, but it is coherent. And we see this as one of good examples. So this is one of good examples that we showed. But otherwise, of course, our view was quite skeptical. I think other panelists would point to the ways how to improve this situation. Sorry for taking a bit long.
Yeah. No, thank you, Rimantas. So actually, I'm hoping we will come back to, what do you think we should do next based on good examples and what would work and what would not work and how can we make progress. So thank you for that. If I may go to Martin Fevre. Martin, from where you sit, I'm tempted very much to ask you the role of the financial sector in supporting the recovery in general, but certainly in the context of a post-pandemic world. We had a very sobering story coming out from what Rimantas just told us, which means that, we cannot really rely on capital markets to help us there. What's your take on that?
And good afternoon to all. Indeed, what should be the role, or what will be the role of the financial sector in supporting the recovery and economic growth? Now, let me start by making an observation, which I'm sure has been made before today in the conference, that if you're looking at least at the bank part, banks have come a long way since the last crisis. They entered the crisis with significantly higher capital and liquidity buffers, and as a result, the role that was played this crisis by banks is very different from last time around. And as a matter of fact, this time around, they have been a very important channel of government support throughout the pandemic, and through a set of measures, so including the guarantee schemes, the release of prudential buffers, and accommodative monetary policy. A credit crunch has at least so far been prevented, as well as large-scale corporate insolvencies. Now, what is clear, however, is that the crisis has led to a significant increase in corporate indebtedness. And what is also clear, that is not evenly distributed. So it differs between sectors, between countries. And what one can see is that the corporations that were most in debt already before the crisis, they have increased also the most in debt, and now so far this has not resulted in corporate insolvencies, but it is to be expected that we will see more of that later on, as the support measures will be withdrawn. And with that, we would also expect an increase in non-performing loans. So the question on how the economy will be supported financially is an important one. So on that, I would have a few observations. Now, first of all, we believe that going forward, liquidity-focused measures, they should give way to solvency and investment-oriented support. And what we see is that member states, or at least some member states, are moving already in that direction. So focusing more and more on targeted equity support, or other forms of solvency support. Now, that said, it's not so straightforward to move in that direction, because the public sector is not particularly good in determining which corporates are going to be viable, which not. So in moving in that direction, it is very important to think about the incentive schemes, to have probably skin in the game, and find ways to have the right expertise on board. Now, a second point that I would mention is that as these support measures are phased out, banks need to actively monitor their credit risk and take timely action to deal with distressed asset. And that will be important to make sure that the financial sector remains also healthy. Now, a number of structural reforms also outside the financial sector are actually going to be very important to support that process. Clearly, we still see huge differences between member states in terms of their solvency procedure, the efficiency of their insolvency procedures, the efficiency of the judiciary, and we see a clear need for steps in that area to be able to deal with larger amounts of distressed assets. Now, in that sense, I am very happy that many of the measures that are necessary to deal with such issues, they found their way into the national resilience and recovery plans, and you probably all know that in the past weeks, the Commission has adopted first its assessments on these plans, and very soon we would expect the ECOFIN to adopt the first set of these plans. And in many of these plans, you will see actually combinations of measures to improve insolvency procedures, combined with reforms of the judiciary, and so the judiciary systems, or also measures to improve out-of-court settlements, etc. So they can be found in the plans of Croatia, Greece, Italy, Portugal, Slovakia, Spain, just to mention a few of them. And this real progress on this will be really critical, I believe, to ensure that the entrepreneurs get a second chance, these procedures also help to preserve value in the companies, and very importantly that losses are also allocated quickly, and not that it doesn't take years to get clarity. Now then, indeed, we do believe that the banking union should be completed. I can be short about this. I'm sure that a lot has been said about this before. Maybe a brief word on the capital markets union. I think this is indeed, I think most people, if not all people, they would agree that this is actually a very important objective to pursue. I would fully agree that with the previous speaker that this has been a slow process, and if you think about it, it is maybe not so surprising that it is slow, because, as was very rightly remarked, I mean the architecture of capital markets, we start from indeed 27 different national positions, and it's not that you can change it with one or two regulation. No, it requires really the adaptation of and harmonization of a whole range of issues, including critical and difficult issues related to taxation, indeed national insolvency procedures, which link into also national organization of the law system. So it's not an easy undertaking, but nevertheless very important. Now, in a way, I was grateful that you mentioned actually the structural reform support service. By sheer coincidence, I used to be the head of that service when actually we did this project that you alluded to, the covered bond initiative, and it was indeed a very interesting example, because it was actually a rather small project, but if you do these projects, you start to realize how many things you actually need to address to make something make progress here. But I think it is the way to go about it, to really look almost area by area and try to and here we need to have a bit of patience and try to address the bottlenecks as they come along. I think I'm not sure, maybe I'm over-interpreting, but my reading of what you were saying was that it is important to have these demonstration projects to show what can be done, to develop approaches that also can be copied. Now, last thing that I would say, I'm really quite optimistic, and now going back again to the RRF, because that's what I spend my time on these days mostly. having looked at the plans very carefully, I am actually quite optimistic that in a number of important areas, or a number of areas that are important for the also for the Capital Markets Union, we will be able to make progress in the coming years. Thank you.
Thank you very much, Martin. And let me just go straight to Georg Cookies, because I also am aware that you need to leave at 4:30. So we are moving to the country perspectives now, and we start with a big country, Germany. And you know, tell us your view on how well prepared the German financial sector is to support the recovery in a post-COVID world. Georg, I think your mic is muted.
Maria, I think he's reconnecting. He just left, and he would connect probably in a while.
Oh, that's okay. Then I see there is actually my colleague Nicholas Veronis wanted to address a question to Martin. Nicholas, would you like to raise the question yourself, or shall I?
Hi, I'm back.
Oh, you're back. Okay, okay. Nicholas, just wait for the question. Georg, why don't you go ahead, because I know you need to leave. I think we are having connection problems.
Yeah, yes, probably maybe it's better to ask a question and then wait until Georg reconnects.
Okay, then let's do that. Then Martin, there is a question for you. Oh, Georg is back. Georg, maybe if you switch your camera off, it's better.
I'll try this way, but I mean,
yeah, we can hear you.
I've gotten kicked out both with and without camera about 12 times now already in the last 50 minutes. So I don't know what's going to work, but
yeah, we can hear you
now.
Yeah, yes, we can hear you. So that's great. Try now.
Okay, sorry. What was the question? I didn't hear anything because I was constantly connecting and reconnecting.
Yeah, so I was just saying that we are moving into maybe some countries. We've had broader comments coming from the point of view from the Court of Auditors, and then from the point of view of the Commission. You're coming from Germany. If you could tell us something about how well prepared the German financial sector might be to support the recovery in general, in particular with a view to having capital markets supporting the recovery.
Yes, so I think we've, of course, helped things out quite a lot with our various state guarantee programs. So in that sense, I think it's really hard to tell in isolation how well capital markets are prepared and how the banking system is prepared, because of course a lot of the lending that has happened since the outset of the crisis was facilitated through the programs that we had with KfW. But overall, I think the system has shown a huge amount of resilience. And I think that's the case across the EU. On the one side, the banking system has really helped to funnel funds to corporates, both small and large, of course, helped and facilitated by KfW. But in many cases, we've also seen that the guaranteed programs have only served sort of as a backstop, and very often corporates have asked for a line of credit through the KfW guarantee programs, but we actually see that a huge amount of the credit lines remain unused. So in that sense, they've, I think, served the purpose of signaling to private financiers that if worst comes to worst, there is sort of an ultimate source of funding available, but the corporates have used that to tap both capital markets through corporate bond markets and lending markets. So in that sense, I think that's very good. We've also seen, I mean, literally just 2 days ago, that one of the biggest recipients, or the biggest recipient of funding through the government guaranteed programs, namely Lufthansa, has once again been successful at tapping private sector capital markets through a 1 billion bond issuance. And that's been now the third time they've been able to do that. And again, the same case goes that they've so far only drawn on a fraction of our state guarantee programs, and actually they've repaid the KfW lending. So in that sense, we are seeing gradually a revival and repayment, even in very stressed sectors such as aviation. The same goes for TUI in the tourism sector. We have seen an ability to tap both private capital markets and bank markets. And I think what has been said, I've only heard fractions and always being interrupted by getting my link being interrupted. But what I have heard from participants is this whole complementarity of bank and capital markets that really works. And I think the system has really shown its resilience through the complementarity of bank funding and capital markets funding. What we have seen, though, and that I think goes again in the direction that we need much more resilience of our capital markets, that you know, the participation of investors in all of these private sector replacements of government funding. You know, EU-based investors are only a minority of the money coming in. I mean, that's no different than in, you know, when you look at books of standard bond markets, the UK still tends to be one of the biggest origins of funds. The US is one of the biggest origins of the funds. Asia and the EU comes somewhere, you know, bronze medal, if even that. So in that sense, I think you know, it goes exactly in the direction of what Martin was saying on the need to strengthen our capital markets. And I think it has to go through pension funds as a big source of funding for the asset management industry. And what we also have to think about very hard is, how do we manage to increase the size of asset management industries in the European Union? Because of course this is one of the issues. While we've seen a very large movement of banks from the UK to the EU as a consequence of Brexit, we haven't really seen that to the same extent in the asset management industry, and very often, quote unquote, only some parts of the businesses have moved. So the European Union just has to get more attractive. I don't think it works through prescriptive measures. It doesn't work through giving the asset management industry orders. It works through increasing the amount of assets that can be invested into capital markets from our pension systems, and making the capital markets union bigger and more attractive. Then the incentive is there for the asset management industry to get much bigger in the European Union. So I think that will be one of the biggest tasks, and we're quite proud during our presidency that we were able to get unanimity within the council to make a very, very ambitious proposal and give the Commission a very broad mandate based on, I heard Thomas Wieser's excellent group being quoted. That really is a very, very broad and very ambitious target that we have there. The Commissioner has taken that on board. I heard that at the beginning. So we're very happy that the Commission will now shortly come out with proposals. We think the proposals on sustainable finance are very complementary to this. We think that what the Commission is about to propose on AML is very complementary to it. We think that MiCA DORA, by the way, as payments-related projects are extremely complementary to both capital markets and banking union. So we think we have to think very holistically about the three steps and the three pillars of banking union, capital markets union, and the retail payment strategies. And by the way, also from everything that we're discussing with the ECB, there's another very interesting complementarity that's extremely strategic, I think, with the ECB's project on central bank digital currency. And of course, last but not least, the points that Martin made. I think we can be very, very proud that Europe now has a safe asset of massive size that is only going to increase. And we can see from the very, very substantial demand that we're getting, both for the SURE funding instruments and from the Next Generation EU instruments, that the capital markets have been thirsting for a European safe asset issued by the European Commission. So I think that's an extremely important and also very complementary building block to banking and capital markets union. And of course, we're all very anxious to see the own resources proposals by the Commission, because I think also talking about complementarities, as the EU now develops its own resources, that will also, of course, strengthen the cohesion within the EU and also help us to build a much stronger capital and banking union.
Thank you very much, Georg. And I'm aware that you have to leave in 5 minutes. So if you allow me to ask you one question while you're still connected, you know, you've touched on many issues. A lot of them are extremely interesting. I'd really take your point about the backstop, how important it is to have a credible backstop. It also reduces the need for using of the funds if you have a credible backstop, which is big and available. But I wanted to ask you about, you know, how we're going to do all of this. You know, ambitions notwithstanding, if you look at the trends of where, you know, the money from the big pension funds or the big insurances, or indeed the money coming out of the investment funds, that the trends is that the money is leaving the euro area, is going outside the euro area. So the money is there, but it's not staying in the euro area, is invested at an increasing rate outside the euro area. You know, how do you stop this? How do you make sure that the euro money that is available in the euro area actually stays in the euro area and it gets invested in risky projects? I think Georg, it's a bit. I think Georg is not there anymore. Perhaps he comes back. Later. I'll keep the question for the rest of the panelists. If you have ideas of how you can reverse this trend where, you know, money that it is available, market money that is available in the euro area actually prefers to go elsewhere. But before we do that, I want to turn to Martin, who is the governor in the Central Bank of Latvia. We actually heard from Rimantas that there isn't really one story in the EU and in the euro area. There are different stories, and I wanted to ask you, from where you sit, from Latvia, what is the situation in the Baltic states, and you know, with the non-banking sector, and you know, how to finance again the recovery, but this time from the point of view of a small country.
Thank you, Maria. But I see that Georg is back, so I could perhaps give my turn now so that we can listen to his answer before he leaves.
Georg, are you back, and did you hear my question, or?
Okay, maybe, well, there's a picture of him, but anyway, okay. If he's not back, I can take, of course, the question. Thank you, Maria, and I would like, of course, first to thank for having me in this discussion. I very much appreciate it. And before I answer your question, I would like to touch upon one of the things, reflect on what the commissioner said about recovery that is fast and sustainable. And by all means, we would all benefit if it would come out to be like that. Touching upon the sustainability, of course, it very much links to the climate change. And as you very well know, yesterday the ECB published its new updated or strategy review. And in our strategy, monetary policy strategy, of course, we are also including elements of climate change. We read it through the price stability, but also it, of course, affects financial stability. So this is all part of the stability of the financial sector, of course, and ability of the financial sector to price and appreciate risks correctly, and therefore also support economic growth going forward. So just to stress this climate change issue, I think that is very critical. Coming back to the question that you posed with respect to Latvia, but perhaps more widely with respect to the Baltics, all three small economies, all three part of the European Union, all three part of the euro area. Of course, it is similarly to the European Union overall, it is very much dominated by banks. And if we talk about the current recovery, post-COVID recovery, I think let's be realistic. Okay? The non-bank financial markets will not replace bank lending as the major form of financing in the post-COVID recovery. Of course, it does not mean that we should not strive for non-bank sector. We would all benefit from more vibrant and more developed and deeper capital markets. But it is unlikely, at least in the Baltics, to be a major story to support recovery this time. Okay. Overall, of course, dynamic capital markets are critical, and without them, Europe risks more underinvestment going forward. And the element that you mentioned, Maria, in terms of intangibles is critical. And if we'll have time, I'll come back to this. But without more diverse financial markets than we currently have, of course, we risk with less vibrant economic recovery, we lost opportunities for our citizens. Coming back to the current situation in the Baltics and Latvia for that matter, I would love to say that the things are improving, but they are improving from a very low level, unfortunately. So the capital markets are still very weak. Let me just give you some examples. Rimantas mentioned the issue on the covered bond story. It is still far from success. Okay? Yes, there's been an agenda on the table for some time, but not all three Baltic countries have been successful yet to implement them. So it is happening somewhat slowly. Another issue where the central banks, and my central bank as well for that matter, have been trying to chip in is to support development of commercial papers market. We did the analysis on the three Baltic countries last year, and the EBRD has started a program to support this. And there is the first, if I may say so, graduate from Lithuania retail chain that managed to issue commercial papers. But by and large, still this is only one incident so far. Nordic Investment Bank is about to join this memorandum of understanding, but it's still very early stages. If you take a look at the stock markets, well, still very weak. Capitalization at best at about 10% of GDP. In Estonia, Lithuania, in the Latvian case, even less than that. IPOs are few and far between. Last year as well, let me mention the Lithuanian example of Ignitis Group that came out with IPO. No other success stories so far. Yes, a couple of cases perhaps in Estonia. The politicians, unfortunately, have been very weak to issue IPOs for state or municipal companies that would support the liquidity in the market. If we take a look at another element that Rimantas mentioned is the second pillar pension reform. We know the Estonian example when the proposal has been to cut down on the second pillar pension. One of the reasons for that is that there's simply not enough domestic instruments where to invest this money. So yes, we are improving with this capital markets story, but it is relatively slow and painful. So when we talk about the post-COVID recovery, by and large, we're back to two issues that I will mention. Two major points. One is on banks. It's good to mention that in sharp contrast to the global financial crisis, banks are part of the solution, not part of the problem in the Baltics at the moment. Banks are well capitalized and their profitability is strong. Okay. Yes, last year with the recession, we saw profitability suffer, falling to, and I think that many European countries would say enviable 7% return on equity. Okay, 7% during COVID years. Okay, now back to about 10%. So the banking sector is very profitable. At the same time, if you take a look at the recovery after the global financial crisis, it has been creditless recovery. Okay, even if banking system is very strong, I would very clearly say that it is punching below the weight when it comes to being part of the solution. We need banks to become much more aggressive in terms of lending. We cannot afford yet another creditless recovery like we had last time. So I would, by all means, expect banks to become much more aggressive and active in terms of lending. They can do it, and they should do it. Okay? This time we can only hope very much with respect to the private sector on banks. So far, they've been relatively hesitant. The second point is on public finance. And with respect to the Baltics and Latvia for that matter, there is a huge difference comparing this crisis with the previous crisis. And the name of the difference is the euro. If during the global financial crisis, it was by and large impossible to borrow for the government and local corporates to live through the crisis, this time the story is absolutely different. Being part of the euro area is a massive benefit to the three Baltic countries. Okay. And of course, we have very much benefited from the monetary policy of the euro area. The rates have been low, TLTROs have been available. By and large, if I would paraphrase an old saying, central banks, of course, can make sure that there's plenty of water in the river. I would say we have even brought the water to the horse, but the problem is we cannot make the horse drink. Okay? We need more funding to flow into the economy. And of course, public finance here is critical as well. We've seen deficit going up, supporting the economy, which is good, but at the same time, we would love to see much more support to the structural improvement of the economies, more structural reforms, more investment-based support rather than consumption-based support. Okay. Let me, by and large, finish this first intervention by saying that without front-loaded investment geared fiscal support, both at the national level, but also at the EU level, and RRF is a very nice point to stress that it's a step in the right direction. Still relatively small, but the right direction. Okay. We are unlikely during the crisis to find a good match between monetary and fiscal policy. Okay. We have to integrate these things much closer, and to do that, I think a much stronger common fiscal capacity on the part of EU would be very helpful. Thank you.
Thank you very much, Martin. If I may take this opportunity to ask you directly a question, what is the space for capital markets to help in this recovery? Because if I listen to what you say, the space is very little. You rely very strongly on the banks, the capital, the size of the capital markets. If you look at the market capitalization of listed firms in countries like Latvia, as you said, they're very small. Is there space? And if you wanted to create more space, what would that be? What would the one thing that you would need for that space to be created?
Of course, the Latvian companies and the Baltic companies overall, with some exceptions, are small and medium-sized companies for the European market. Okay, these are small companies. Our largest companies, are medium-sized for Europe. I would say that getting out of the national silos of capital market unions, of capital markets, and creating a true capital market union with little judiciary differences would be very, very helpful. So developing national capital markets in small economies, I think one can try, but unlikely to have any reasonable result. I think integration is the answer Streamlining judiciary issues is the answer. Making, one initiative, what the Commission mentioned, is, in terms of one-stop access to the data about companies. That would be very helpful as well when it functions fully. We should not strive at creating or mimicking numerous capital markets. Let's create one single working capital markets union in the whole of the Europe. That, to my view, is the only possible solution to have diversification away from the banks.
Wonderful, thank you very much. So that's very useful. And we will perhaps come back to this discussion, but I would like to thank Rick first for his patience. I think let me give the floor to you. You come from the markets. The only person perhaps in the panel who comes from the market. So what would you like to see change for the markets to contribute stronger in the recovery?
Thanks very much, Maria. I'd like to mention a couple different things. And for those of you who aren't familiar with what our association does, our association represents the capital markets side of the European and global banks. So they're the intermediaries. We don't represent the lenders, but rather the intermediaries between the corporates of various sizes and the different types of investors, both in Europe and globally. There's two things I'd like to focus on. One is industry perspectives on CMU, since that's been such an active part of this discussion as well as the prior panel. Our membership is very supportive of CMU, and unless we are all continuing to make tangible progress toward creating a more integrated, truly pan-European market, the market will continue to be expensive and full of frictions that are restricting the flow of capital the prior speaker rightly cited. And just to pick two or three things and to complement what Commissioner McGuinness was saying earlier. For example, things that promote awareness across Europe of a single capital market, such as a consolidated tape, our members are very supportive of. It's important to think through rightly how it works, how it's calibrated, transmission speeds and all that type of thing. But we do think that a consolidated tape will democratize access across European markets because it provides investors, regardless of where they are or sophistication or their resources, with a comprehensive and standardized view of trading activity. We think that's really important, so we think that's an important ambition to really think through carefully. But we do think it could have a lot of benefits in terms of integration. Another recommendation of the Commission is the European Single Access Point, which our members do think as well, like Edgar has done in the US, which is a single access point for SEC-registered transactions. A European single access point, as long as it doesn't duplicate existing work, could serve a real function by making data easier to access for investors in Latvia or France or Greece or the Nordics to understand what's on offer across various, both exchanges and non-exchange type of offerings from corporates and trading activity. We think that could really help a lot as long as it does not duplicate expense, particularly for the corporate issuers who would be the ones who would be taking data and be basically providing input into the portal. We do think that MiFID is actually an important part of the CMU project because it defines European equity and fixed income market structure. And at the moment, there's still a lot of cross-border frictions for trading that make, whether it's data fees, in certain cases, data costs are very high in Europe as compared to other jurisdictions. It's important, and I know the Commission's looking at this, ESMA's looking at this. ESMA, for example, just came out today with a study on, as part of MiFID, what data should be looked at. And we're pleased that they're going to be taking a look at how, for example, equity trading data is defined. The feedback we're hearing from investors is they like choice, they like competition. They want to be able to trade wherever they want to trade and get the best price on behalf of their funds. You need different types of execution to do that, and it's important to keep that flexibility open, and high quality data from ESMA and others is really important to that process. We also have two or three other important areas in fixed income. For example, the whole issue of data through APAs as part of the whole MiFID projects. It's important to take a look at that and actually what's worked, what hasn't worked during the first part of MiFID. For example, government bonds, there are vast amounts of government bonds traded, which actually dwarf equity trading sizes. And it's important to get the calibration of how those bonds are traded, deferrals, those things like that. And it's really important to define what's liquid, what is illiquid, particularly now that the UK has left the EU, and how that impacts some of those calibrations. That's really important. The other thing I'll mention is importance of focusing on a few pieces of unfinished business from the first part of CMU. Securitization, we very much welcomed a number of the different initiatives, the legislative side, the SDS regulation and others. However, some of it just doesn't quite work yet. And one of the things that we're trying to point out to officials, both in member states as well as at the EU institutional level, is the math no longer works for securitization issuers and investors in many cases, due to the regulatory treatment of certain important aspects between both investors, insurance companies, and banks. It's really important to think that through carefully, because if the math doesn't work, people aren't going to be securitizing. In particular, the banks won't be able to free up capital to support SME business, which is so crucial for economic growth. There's another 2 or 3 important things which need further work. Insolvency reform certainly has made some progress. However, there's still more work that can be done in making that more of an integrated market across Europe. And also on the clearing and settlement side of things. There's lots of things in terms of the post-trade infrastructure that still require further work. The second thing I'd like to point out is how capital markets are looking at the post-COVID recovery. And I wanted to point out a report that we and our members produced earlier this year together with PwC that focused on how the markets can help corporates impacted by COVID recovery. And the 2 or 3 things which might be of interest to people. PwC estimated there's still roughly €1 trillion of losses to be incurred by European corporates of all sizes as a result of COVID in different industries. What we did was actually try to then reconcile how much equity is it. Now, that basically is a direct hit to equity. And because member state governments, which of course have had very helpful guarantee programs on loans, loans are debt. And if loans are expected to be repaid, it is going to leverage considerably the credit profile of corporates across Europe. So what Europe needs is €1 trillion, obviously a big number, of equity to plug that gap as state support systems roll off throughout the summer. In some cases, they've already started. Over the next 2 or 3 months, many of the state support programs stop in many major member states. So I think we'll be beginning to start see some of the losses trickle through later this year. Although there's been very good discussion about, in positive discussion, it seems to be a bit less severe than people had feared. We did in this report take a look at how much equity is actually available to plug that €1 trillion hole. And we calculated there's roughly 400 to 550 billion euros of both private sector capital and public sector capital available, which leads clearly a very big shortfall to fill. And the way we calculated that very quickly, and if it's of interest, there's a few figures we presented in the report of where the equity is coming from. And I think this addresses how how capital markets can help address some of the growth issues that are still missing in Europe. Last year in 2020, there was about 77 billion euros of common equity distributed inside of Europe, plus an additional 19 billion euros or so. This is within the EU 27 of equity. So there's roughly 100 billion euros of equity raised in the European markets, both in the public markets and the public meaning listed markets, and private markets and private equity markets. In addition to that, a lot of people aren't aware there are hybrid instruments, which are probably a lot more appropriate for SMEs and small mid-caps who are simply too small to access, and probably always will be, in many cases, too small to access the public markets. Last year, there was roughly 25 billion in corporate subordinated debt issued. There's about 20 billion in convertible bonds, another 12 billion or so in payment in kind bonds, effectively parts of the high yield market. So there's about 56 billion euros of hybrid instruments issued last year. From what we can tell, that pace is actually growing this year, and there are more hybrids issued this year. And we think actually the overall equity raising figure will be slightly higher as well. That mechanic is really important because one of the things that PwC did in this report was talk to the SMEs and small mid caps who really don't want to give up their businesses. And this is not news. SMEs and small mid caps across Europe for years have been saying, we want equity, but at the same time, we really don't want to give up control to outsiders who are going to interfere in many cases, family businesses or privately owned businesses. And we certainly understand that. We do think it's important to take a careful look at the hybrid market, particularly the subordinated debt market, which basically does achieve equity accounting treatment within IFRS in many cases, depending upon the structure, but in many cases that can be achieved. In many member states, but not all member states, it also is achieved under national equity accounting principles. But most importantly, it does not require the corporate to give up voting control. That's a really important cultural aspect, and I think that's a major box that this product ticks. One of the things we're doing in the industry at AFME is working with PwC to provide some more specific data. We hope to be able to release this report in the early autumn. And in some of the major member states, what specifically is required to achieve that equity accounting treatment for hybrid instruments in terms of dates, maturity dates or no maturity dates, conversion features, call options, put options, things like that. We're writing all this down so that information can be shared across member states about what might we be able to put together for customized support programs. One of the things that I want to caution is in some cases, these SMEs and mid-cap corporates are simply too small to access institutional investors, whether in Europe or elsewhere, which actually, when you step back and think about it, makes a lot of sense. Most of the major fund managers in Europe can already buy, if they want to, equity from SMEs and small mid-caps on a private basis or public basis. However, it's an awful lot of work. And I think many of them, and this came up through the PwC study, would say that it's not cost effective for large fund managers to invest in very small pieces of 1 or 2 million euros each of equity, or even as 3 to 5 million. What they really are looking for is chunks of at least 10 to 20 million euros per investor to invest in to justify the extensive credit and due diligence work required. We do think there's a role for the public sector in providing support, partially guaranteed programs, definitely not fully guaranteed programs, but partially guaranteed programs, in a similar way that the French government over the last 2 or 3 months have been promoting through a 20 billion euro, very specific and in our view, a very good program focused on a partially guaranteed program. They actively worked with the European Commission state aid officials, from what we understand, on providing partial credit enhancement to sell instruments to investors, which are investment grade, but they're not AAA. They shouldn't be AAA. We're trying to get investors invested in risk capital. And that's a very successful program that our members support. We are aware that in the Netherlands, I think last week, a smaller program was announced. I think it's a debt-focused rather than equity-focused program. But again, it's not fully guaranteed, but it's intended to attract private capital into those smaller SMEs and smaller mid-caps and SMEs. And with that, the last thing I wanted to mention is let's not forget about the bond markets, the corporate bond markets. They're big and have really, I think, been very successful during the COVID crisis. Last year, there's about 320 billion euros of investment grade corporate debt issued, plus an additional 60 billion of high yield corporate debt. Combined, that's providing a lot of cash through the COVID crisis and beyond that's complementing the funding available from European banks. But that's, again, it's different types of investors, but I think that's what the industry really feels is going to be helpful for the European economy longer term. And that I'll stop.
Sorry, my microphone was out. Well, thank you, Rick. Thanks very much for that and for the numbers. I think this is it's wonderful to hear some of the numbers, understand the size of some of the issues. And in fact, you raise the point that also I think Nicholas is addressing to Martin, this idea of, you know, what is the gap there as we're beginning to phase some of the measures. You know, are we going to see massive insolvencies or not? And you know, if we were to see whatever we see, how do we support that? And in fact, the question that Nicola is asking is should we move from credit support to solvency support? So we'll come back to this. But before I come back to say a second round of questions, Rick, if I could ask you, it's interesting to look at one of the numbers that the variables that I like to look at when it comes down to investing in risk terms. I always look at the country risk premium to try to understand some of the differences of the geography. And if you plot the country risk premium, which is effectively the difference between the market return minus the safe return, if you plot that for European countries versus the US, all European countries are consistently above in terms of riskiness, and by about 3 to 4 percentage points, and that is consistent if you compare this to the US. And the question is why? Why is it that all European countries, and if you take Germany, which we traditionally, certainly when it comes to the safe asset, we consider that to be the safest of all, you actually have the risk premium equally deviating from the US, and actually in the past 5 to 6 years, it has been increasing. That, of course, may be driven by the fact that the safe asset return is decreasing. But in any case, the premium is what it is. And therefore, if you're an investor in Europe, you prefer to go to the US, wouldn't you? I mean, and the question is, how can we, you know, here we are discussing how can we increase investments in the euro, in Europe, in the euro area. How do you do that? How do you close some of the gap, the spread between the two?
That's a really important question. I think you hit the nail on the head of the economics of CMU. Personally, I would say that risk premium of Europe is because of a lack of a CMU. And it gets back to my earlier comment about the need for CMU to also consider MiFID as part of the overall market structure, because that impacts liquidity and trading. Because I think it's important to separate out credit risk premiums versus capital markets equity, let's call it risk and trading risk premiums. There's lots of very safe countries in Europe. There's no question about from a credit perspective. Many, if not most countries in Europe are pretty safe from a credit profile perspective. And I think most, for example, American or Asian investors, when they're looking to invest in Europe, they certainly would look at US. It's an enormous market, and it is still the global benchmark because it is simply so big and liquid. Any market will have a premium, I think, in terms of liquidity. Simply, it will by definition be smaller than that. However, if you look at the EU27 as a pot, the population of the GDPs of the EU27 and the US are pretty close. We're actually fairly close. Now, the bit that's not the same, of course, is market capitalization or market liquidity. And I hadn't heard that statistic you quoted before, but I can understand why that would be the case. I think from our members' perspective, I think they would objectively say, because they trade bonds anywhere in the world or equity anywhere in the world. And for them, once they enter I would call it geographic European space, I don't want to separate out the EU27 from the UK or Switzerland or others. When they look at the geographic Euro space, it's not one single market from a market liquidity perspective, because you do have these national frictions. You still have incumbent institutions in some of the major member states that have existed prior to the formation of the euro. They've been around for decades, which understandably are promoting their national interests. They're doing their job. However, I do cite that this is one instance where an institution which is lurking in the national interest of its own large country may be working against the interests of the pan-European project. Because to promote, and one of the things I think, one of the reasons why our members are supportive of both the consolidated tape and the single access point, is that if you're an investor in France and Germany and Italy, Spain, or the Netherlands, if you're an investor, or particularly a retail investor, are you looking, in addition to what's trading on the Amsterdam Stock Exchange, are you looking to see what's also trading in Latvia, or in Sweden, or in Finland, or Greece? And probably not. Now, there are a number of frictions. Part of it might be a language issue. It might be as simple as that. Are the documents from the exchanges, it readily available to that Dutch retail investor to say, aha, I see a company in Latvia that I like, that's in the business I like. However, I'm not sure about the language, if there's a language issue, and also are the accounting principles consistent? Are the insolvency principles consistent? So if this company goes bust, do I know what's going to happen? Probably not. So there's a lot of work that a portal, I think, can help in harmonizing that information. So that's why our members are so supportive of CMU. We do think that could reduce that national friction premium that's currently, I think, addressing that cost issue that you rightly raised.
Great. So what I take from what you just said is that if we are monitoring the country risk premium to the extent that we converge to the US, will be progress in forming a capital markets union. Here is a leading indicator.
I would think so.
Yeah, wonderful. So thank you very much for that. Perhaps I can go back to Martin, if you can react to what you've heard, also to the question that has arisen, some of the numbers that risk raised. I think there's a lot here to touch upon. Why don't we start with you, Martin?
Yeah, thank you very much, Maria, and thank you also to Nicholas for a very good question. Now, just to say up front, we strongly believe that public administrations need to be complementary to the market. So if it is the case that the market can take care of it, well, I'm the first one to say, please go for it. Huh? That's now. I would like to point out a few things though here. First of all, and that I already alluded to it in my introductory comments. There are big differences in the union between countries. But also between sectors, between big companies, small companies. So whereas I think on average, everywhere the prospects are certainly improving, but I would not deduct from that automatically that in all circumstances very easily the market will take care of it. Now that brings me to the next point, and that is on the issue of the courts. Now, ideally, in an ideal world, the courts would function perfectly efficiently, and you would have a very quick resolution of any problems. And as I mentioned before, this is what the objective should be. But we're not there, and as a matter of fact, probably those countries which have suffered from underinvestment already in the run-up to the crisis, they probably have the longest way to go to actually to come to courts that are indeed efficient and are ready or can offer solutions very quickly. So I would be afraid that if you would rely fully on that today, that you would see large economic losses, because but again, it underlies again the need to reform the court system, to reform the insolvency systems. But that is not we start with that and we support that very much. But that is not done from one day to the other. And then another issue, and I have listened with great interest actually what Rick Watson was saying, and here it's about the incentives also of entrepreneurs to take to actually take equity. And so for us, or for me, it's not just an issue of equity to avoid insolvency. No, if a company needs to, if there's no future for the company, then the natural course of things is that ended these businesses. What I'm really worried about is essentially companies that have survived, that are surviving, but have nevertheless seen their equities position usually deteriorating in the crisis, but do not want to take more equity simply because they want to keep control over their company and prefer actually to function at lower levels of capital with lower levels of investments than they otherwise would have had, simply to stay in control. And that last point, that links also to capacity issues. I would fully agree with Rick Watson that the solution to that is probably the hybrid type of instruments, but the capacity of that market is rather small. So I think for all these reasons together, I think we would see still a need probably for public action. But again, if it's not necessary, great. Huh? Then we should not do it. Thanks.
And any views on? And do you have any views on this? Should we phase out some of the support as we move? As we are sort of, we are the economy starting up. Should we move on to the from credit support to solvency support?
Is this to me again?
Yes, Martin.
Ah, okay. No, I think ideally. Now, what we have always said is don't go too fast. I mean, that said, we also very much agree with everybody to say, look, we should not keep companies on life support forever. But I think it's important to look in the design of these schemes, and that is happening more and more. That automatically, I would say, the companies that see their turnover increase, that there are incentives there that actually make sure that almost automatically these companies do not are not eligible anymore, so that they can, in a way, grow out of these systems. But our general message has been so far: be careful with withdrawing the support too quick, because if everybody withdraws the support at the same time, then we can be facing very unpleasant cliff edge effects, and we want this recovery to be firmly established first before we face that.
Yeah. And not to forget that actually Europe is predominantly an SME type of environment. So, if you were to withdraw support very fast, you might also have consequences on employment, which could be quite drastic, irrespective of how productive or unproductive the firms are. Rimantas, can I go back to you? You were quite sober to begin with your views about progress with CMU. How do you feel now about what you've heard? Do you think that we are making progress there, and what do we do to make progress in this respect?
There were quite a number of issues that, of course, arose also during our audits, and then we discussed this not only internally but issued the corresponding recommendation. I like what Martin just told. Incentives to entrepreneurs to have this more wide, to select from wider scale, wider scope of options for financing, and especially, of course, as I think we all agree that equity financing is something that we should care very much about. I like what Rick said, and this is also nothing new. The French practice, but I think in other countries, developed countries, there are methods of equity financing, not depriving the owners of this small enterprise from full control of that enterprise. So incentivizing them to get equity financing, not losing the control, could be an option. A very clear hurdle on this way is a very primitive and very trivial thing. That the small enterprises, especially those who are the most inventive, who, for example, know everything about semiconductor physics, they know almost nothing about finance. And what we are talking here about, these terms, these notions, they are completely terra incognita for them. Thomas Wieser Group, they posed one of the purposes of this way forward, or this toolbox that they proposed to the European Union, improving financial literacy. What they had in mind is promoting financial literacy at schools, first of all, which is clearly a very good thing. Nobody would disagree with that. We had one of the recommendations in our report, because since we looked at these smallest enterprises and their possibilities to enjoy the instruments in the their own national capital market or somewhere else, but in Europe, is financial literacy of these enterprises. The funny thing is that we also got not very positive reaction from the Commission side. Commission was our auditee. They can agree or disagree with the recommendations. In this case, they were quite reluctant to take on board this recommendation, but I think we do have in the European Union, again, I'm talking about the role of the public sector. Private sector can make things moving in different ways, but in the public sector, the European Commission does have programs financed from European budget that could be shifted a bit to increase knowledge between entrepreneurs, how to move forward with their crazy ideas. And here, probably the most exciting thing, most exciting argument why we do need all that. I heard, this is not invented by myself, I heard in one of the roundtables on this topic, is that in more and more cases, the owners of this small enterprise, innovative small enterprise, simply do not qualify by their age for bank loan. And in this case, it is particularly important to have this knowledge spread to this kind of entrepreneurs, for them to be able to employ other tools. And one small remark also to what I heard from Martins. Martins, I agree with many things that you said. I would a bit disagree with your absolutely negative view on developing the capital market in a small country. Anyway, the small country, you will react. The small country, it is an interesting entity, and all small countries that we do have in the European Union, out of 27, majority are small countries. Let's admit it. There are huge cultural differences between them. These cultural differences also exist in business area, in legal systems, in understanding how things move in the real legal processes, like, for example, insolvency proceedings. Insolvency problem, differences in insolvency between the member states lies not only in legal regulations of insolvency or the order of creditors, not only at that, but also in the tradition, how fast this process is. In the country I know best, which is just a neighbor of Latvia, represented by Martins, insolvency, bankruptcy of the firm is rather exception than the rule. Can you imagine? Rather exception than the rule, because this is the culture. So we should care about integration. I agree that we should integrate our countries into a larger pot of other countries. And probably reception of law is one of the ways, which would be difficult because your parliament will never agree just to rewrite German law. There will be issues, but this is what I meant, that we should develop the toolbox in the member states, in each and every member state, especially in those least developed. And here again, we had a recommendation. It would sound probably, well, very bureaucratic, but the Commission also mentioned this, and I think Martin also mentioned this. We recommended to include the structural reform development of the capital market into country-specific recommendations, European semester, and this has been done for a number of countries in the recovery and resilience plans, and this is very good. This is very good. With only small issue that we again should invent the method to measure the progress, because it is needed for recovery and resilience facility. So I think development of the country's capital union, country's capital market, also integrating regions together like Baltics to this or that extent successfully, not from this day to another, and then trying to integrate these regions into a bigger mechanism. This is a realistic way forward, very difficult, very boring, but this is another way to overcome reluctance of the Council to approve general and unique union legislation, which would be the best outcome from my point of view, but I understand it is not always feasible. So such kind of workarounds and working with the cultural issues, cultural differences, to my mind, would help. So this is my takeaway from the discussion. I don't know, does it sound optimistically or not, but
well,
for my colleagues in the panel to judge.
Yeah, well, I'm delighted that you raised the issue of financial literacy, which is a topic that is very close to my heart. I'm a bit surprised that you found a cold reception from the European Commission, because the European Commission actually has an initiative on financial literacy in the DG FISMA. And actually, it's a pity the Commissioner is not here, because she's very excited about this issue, and without wanting to put words into her mouth, but I have heard her being very excited about financial literacy, and I believe that strongly myself. I would like to
maybe our recommendation helped.
Oh, I'm sure that's true. I would like for Martin to react, but I would like to pose one last question to all of you, and that is that we need to make progress with Capital Markets Union, irrespective of where you are on the scale of optimism or pessimism. Everybody agrees that we need more on the CMU. And my question to you, and I will go one to you, is if you were to pick just one thing, and I mean one thing, what would that be? In terms of trying up and push, making progress, breathe new life into the CMU initiative. But before we do that, Martin, do you want to react to some of the things that Rimand has said?
Yes, I absolutely disagree with everything what Rimand said.
Oh dear.
Of course not. But I don't see much differences in what I said and Rimand said. What I'm talking about here is that of course, we are not talking about corner solutions here, one or the other, okay? We are looking at a process that is moving forward towards more interlinked, more developed capital markets union. And this very kind of clearly links together what I mentioned also, Rick mentioned before that in terms of the fractions, okay? Oh, sorry, frictions, in terms of frictions. If we can remove those national border frictions, it is by all means going to be helpful. Of course, it cannot happen in one day. We wake up in the morning, it's a brand new world. Okay? It's going to be a stepwise process. But removing those frictions and looking at the market as a regional market, and for instance, if we take a look at the capital markets, in the 90s, the 3 Baltic states tried to develop their own capital markets. Then we realized that we are too small. Then there was a step to develop regional Baltic capital markets, so all three countries. And now we see that it seems to be lacking the breadth, kind of depth and breadth as well. So we should expand more, integrate more in the Scandinavian markets and so on. So just streamlining the differences, kind of taking away the differences, streamlining the regulations and taking away those frictions will be very helpful. And of course, it's not going to be easy. Can we do something about it? By all means. And I think very clear example here is services trade. Okay? That's one big thing that the European Union has not been able to fully use to its benefit. That has to be used. Same things in terms of capital markets union. If we can reduce those hurdles, if we can reduce those frictions, would be very nice. Coming back to the banks here, of course, banks are going to be, at least in the Baltics, by all means, the major financier of the recovery. Okay, because we need private sector to assess risks and all these things. The public sector is only helping at the time of trouble, but the private sector should be taking over these things. And this is very much about the health of the banking sector. And if we take a look at the Euro area and the European Union overall, of course, we already heard it mentioned that the banking sector is much more stronger, with much stronger capital base in this crisis than in the previous one, which is good news. At the same time, if we take a look at the profitability of the banking system, okay, there are many segments where banking sector profitability is weak, to say it politely. Okay? And here again, those national borders perhaps is one element that allows for this. More integration, cross-border integration within European Union would be helping and helpful to strengthen banks, to make them more able to meet the digital challenges and all these related things. So stronger institutions, I think, in this case, of course, require also lower national border frictions. And remind us, of course, it's not tomorrow morning, okay? But that's the way forward. Thank you.
And if you were to pick just the one thing that you would want to recommend to the Commission in order to, give a boost to CMU, what would that be?
The same thing. Cut down on frictions, be it insolvency procedures, aligning them, be in any other things. That would be very helpful. The ambition is very good, but let's follow it through on national level. Okay, let's streamline it. Thank you.
Thank you very much. Rick, what of the many measures that you have talked about, which one would you like to see through?
I would agree that I think in terms of reducing frictions, we do think that's probably the biggest priority. That there's a lot of different ways to do that. Maybe as one category, it's looking at it's data frictions, data consistency, competition. It's effectively, how do you make the cost of trading cheaper and more cost effective to motivate inward investment and cross-border liquidity?
Well, I mean, cutting down on data frictions is a lot easier than cutting down on insolvency frictions. So I think that might be,
yes,
it is. That might be what I would call a low-hanging fruit. So are you recommending this? Of course, that might actually get us somewhere. Okay, thank you very much. Remind us, if you were to pick one thing, is that financial literacy?
No. First, let's divide this thing into two parts, in serious and less serious. If we look at this seriously, unfortunately, this CMU project does not so simply divide into parts differently from banking union, where you did have single supervisory mechanism, the single resolution mechanism, deposit insurance. We heard about fourth pillar financing and resolution. In capital markets union, unfortunately, this simply does not divide so easily. So all things, whatever you take, they imply many other things. And the proposals by my colleagues, for which I would subscribe, that the cost of frictions into member state frictions should be somehow, should be avoided, and their cost should be diminished. It's true, but this is a huge project, would be a huge project of harmonization of the corporate law. Absolutely unrealistic, given all circumstances. I can tell you as a lawyer by education, it is absolutely not realistic. So No silver bullet, no silver. This was serious part. Since we are at the very end of our discussion and long conference day, if I were to vote from the whole list, you know, I thought if I were much younger, much younger, several times younger, what I would choose from all the list of the measures. One that was mentioned but was not discussed, European single access point, and smuggled to the social media in the member states, so that it would be taken by many people and free of charge, financed by the public sector. Probably I would give my vote for this measure, but this was a joke. Unfortunately, there is no silver bullet.
Okay, no, thank you. That was the question. Thank you very much. Martin, you have the last word. How are you going to do it?
Well, first of all, I'm not going to do it. So it's for my colleague Sean Berrigan. But I would say here that, look, the Commission has put an action plan on the table. Let's start with implementing that, because the CMU is, and it has been remarked before, there's many people talk about it, but it needs to be done. And let's start with the action plan now, and then in parallel, and that's more personal, and I alluded to it already. I think there is a need, quite apart from the CMU, to start improving these insolvency systems across Europe. Let's also start with that. We have now the opportunity to make good progress on that, and that further down the road would certainly facilitate also the move to capital markets union. Thank you.
Okay, that's great. Thank you very much. I think we're coming close to the end. I mean, I don't know that I can summarize what we have heard. Perhaps I can point to a few keywords that I've heard that might help concentrate some of the key messages. I've heard about minimal tool sets that came at the beginning. I heard scale in one market and eliminated frictions in whichever shape and form they appear. A holistic approach, combining the CMU with BEU as a one financial market. I've heard about the need for standardization so that investors know what they're getting at different jurisdictions. Data accessibility and removing frictions on data. Hybrid instruments, that was kind of an interesting thing, in particular for small firms to try and incentivize them to give away a bit of their baby. I've heard also the issue of partial guarantee systems, which I think is always helpful in the context of again, providing the right incentives for investors to come in on the other side of that game. And then finally, the European single access point. I think that is not a dream. It's something that we should aim at, and it would really provide some of the certainty that the markets are asking for. Now, I don't know that I have done justice to what I've heard. This is, I think, some of the key messages. I think I would agree that, and I think the panel agrees, that there is great need for CMU. I'm still not sure what will be that one thing that is going to breathe new life into the CMU. I think Martin is absolutely right that we have action points, but we don't have implementation, and I don't really know what will be the one thing that is going to speed up some of this implementation that we actually need in the recovery phase and well beyond the recovery phase. With that, let me thank you for joining me this afternoon, to talk about this issue. Rick, Martin, and Georg, who is unfortunately not here anymore, and Rimantas, and in fact the European Court of Auditors, for hosting us and carrying out this discussion. I hope the next time we meet, we will have seen a little bit more progress on this. And with that, I will pass the floor now to Alex Brennickmeier for final remarks.
Yes. Alex, are you with us? You are muted, Alex. Could you unmute, please?
Yes.
Yes,
Okay.
yes, Alex. So now the floor is yours to actually try to draw a conclusion, which I know is immensely difficult. Before that, I would just like to thank Maria and our panel, Maria for very eloquent moderating the panel, and all the participants for really insightful views. I mean, we saw many good ideas from my side. I would just like to add that, I mean, what is important is really implementation, and I think we all converge on the need to adopt more and more European level solutions as opposed to national ones that might enhance also trust in what we do. So thank you very much again to all our distinguished panelists, to Maria, to Bruegel, and now Alex, you will now conclude the conference. I mean, you are Dean of our Chamber 4 that is dealing with these economic and financial issues, and you have vast experience in various policy areas and also in the academic world. So I'm sure you will bring us to a nice close of the day. So Alex, please.
Thank you very much, Michael, for this chance to summarize this conference. My first words are very kind in the sense that I would like to compliment you, Michael, with this initiative and the preparation of a very good conference, and also your team which supported you. I have seen during 6-7 hours today a very dense discussion on very topical issues, and indeed, if you announce me with it's a hell of a job to summarize this, then you are perfectly right. However, the question of this conference is the European Union financial sector ready to face the financial crisis and the recovery of the economy after the COVID crisis? And in answering this question, it took 6 hours, 7 hours to answer this question. We can make maybe a shortcut in the direction of more than 400 million European citizens, because it's all for European citizens. And the question is, what is the message in the direction of 450 million European citizens? And I believe that the summary of the conference can be that this question can be answered in the affirmative. The last part shows that there is a discussion about the capital market, and the capital market is in progress, and there are many important questions related with the further development of the capital market. But on the whole, we can say that during the different cycles of this conference, we get a positive picture of the development of the financial sector and the readiness to face crisis like we have seen in the past. If we look at the developments after 2008, when the crisis started, we can observe enormous developments. And I would like to quote or summarize the contribution of Luc van Middelaar, the philosopher Luc van Middelaar, to this kind of process in Europe. And his observation was that from the tradition, the European Union is a well-organized bureaucracy with agriculture policy, with cohesion policy, with natural resources, etc., etc. But the European Union is challenged with many crises. So now the European Union is becoming an institution which should be fit for dealing with crisis. And we discussed today the economic crisis and the response to the COVID pandemic. There is also a climate crisis, the pressure of globalization on the European countries. So there is a lot of work to do for the European Union if it comes to crisis management. And crisis management is from its nature improvisation. In saying this and translating the results of this conference to EU citizens, one can say, well, it's correct to say never waste a good crisis. The crisis has offered many, many chances for the European Union to develop to a higher form of cooperation, and this is a very interesting process. This is also a process, and that was the summary I gave to Michael Koslovs on beforehand when he asked me, well, what's your view on the subject? And I said, well, what we are observing is not a blueprint, and we are handling according to this blueprint for, let's say, the financial stability of the European Union, etc., etc. No, what is happening is emergent from what is happening and the responses and the constellation of responses. And in fact, in the last part of the discussion, we have seen it, that also building a capital market is not drafting it and making it. And inter alia rimanter saties asked attention for the complexity in all different European countries to cooperate in the field of the upcoming capital market. One can also observe that doing this, one can say, well, this is a step-by-step development. But I believe a step-by-step development, even a stepping stone development, is not the right characteristic of what is happening. And in listening today, I got the impression that the best picture of what is happening with regard to the EU financial sector and all instruments which are installed, it is more or less a cakewalk with moving steps. And that you have to find the right timing to take this stair in a proper way. And I must say that many actors in the European Union have acted in a correct way, sometimes too late. Indeed, some countries have suffered that because the response of the European Union to what happened was too late. However, on the whole, the rhythm is found, and if I observe the discussion, today's discussion, I observe, well, it's not a troublesome discussion. No, it's building further on what is happening. So for that reason, the message to EU citizens can be, yes, the EU financial sector is ready to face the financial crisis and next financial crisis, and also the recovery. One of the keywords, and Maria mentioned some keywords from the discussion in the last part, but one of the keywords I have in mind is complexity. If we look at the discussion, today's discussion, it is a discussion which is extremely complex, about a very complex phenomenon. One of the elements of this complexity is mentioned during the discussions, and that is the multicultural context. The many member states, but also the cultures in the member states, north, south, east, west. And these are not only words, these are also sentiments. And when the COVID pandemic came up, we have seen how important these sentiments were and what sentiments are doing in society. And this brings me to the observation that complexity is faced quite often by reduction of the complexity. And I must admit today, the discussions were not a reduction of the complexity, and I'm happy with that. Because if you reduce complexity, you can easily shift into the direction of populism or nationalism. And that's an interesting issue in the sense that nationalism is not an answer to the problems we are facing in Europe. We can admit that the lesson from 2008 till now, and even for the future after the pandemic, is that European cooperation is extremely important, and that the development of the financial sector in this is particularly extremely important. And another aspect of this European cooperation, and I have the feeling that this is something which is not mentioned and not identified, but if we look at the answer to the euro crisis, it was the European support on basis of an entry to the credit market. And if we look now at the development of Next Generation EU and the Recovery and Resilience Fund, it is also based on loans by the European Union. And this is the strength of the European cooperation in the sense that they have a very good and strong position in the capital market. And for that reason, we can confirm that EU citizens can be confident that the financial support for the European cooperation is very strong. So again, to close the circle of this conference, the question is, can we face the next crisis? The answer to this question is yes, in the sense that past performance shows that the European cooperation is able to face crisis, but also that there has been a learning process how to deal with crisis. And for that reason, I'm confident that the European cooperation will deepen, and this story should contribute to countering populist sentiments and also nationalist-oriented sentiments. European cooperation is extremely important for the future of EU citizens. Thank you very much.
Alex, thank you very much for concluding at this inspiring note. Really, you have been able to aggregate the discussions we had throughout the day into kind of more conceptual issues at the European level, and I can only agree that with you that the future of Europe is in Europe and probably not so much at other levels. Also, our previous speakers mentioned the concept of Europeanization of solutions. So I think with that in mind, I would like to thank you, Alex, again. Also, our previous panelists, I see some of them are still with us. And I would like now to close the conference and to invite you all to follow the European Court of Auditors homepage, social media, and public presentations of our reports. I think you would learn some interesting facts and things, conclusions and recommendations from this report. Last but not the least, certainly thank you to all team of the European Court of Auditors who have been instrumental not only today but throughout a couple of months. And actually, we had this, the idea to organize this event around half a year ago, and now it came to successful fruition. So thank you all colleagues who are here and who are online. And I now close the event and wish you nice weekend, sunny weekend, and enjoy the football match on Sunday. I think we're all looking